Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, today we're going to dive into something really powerful. We're breaking down the core ideas from Anna Couling's fantastic book, A Complete Guide to Volume Price Analysis. We're going to see how a method that's over 100 years old can literally change the entire way you see the markets. Let's get right into it.
So let me ask you, does this sound familiar? You find a trade, it looks absolutely perfect. You pull the trigger, and then bam, the market just rips in the other direction. It's this incredibly frustrating, emotional roller coaster, isn't it? It makes you feel like you're playing a game where everybody else knows the rules except for you. But what if there was a way to peek behind the curtain? A method that doesn't need a bunch of complicated indicators, but instead relies on the two most basic, most fundamental pieces of data in any market. It's a secret that's been hiding in plain sight for over a century.
First things first, let's talk about the problem this whole approach is designed to solve. What I like to call the emotional trading trap. The one that gets so many of us.
For so many traders, the daily grind is just defined by stress and emotion. You end up making decisions based on hope, or even worse, fear, not logic. And when you don't have that logical foundation, your confidence just evaporates, which makes finding consistent success feel next to impossible. This is the exact cycle that volume price analysis is designed to completely shatter.
So, what is this secret weapon that can replace all that emotion with pure, cold logic? Well, it's a method that has a really long and, frankly, a pretty legendary history.
It's called volume price analysis, or VPA for short, and it's a beautifully simple but really profound method. It's all about analyzing the relationship between the price of an asset and the volume being traded. That is it. No magic formulas, no secret algorithms, just the pure, unfiltered dynamics of the market.
And look, this is not some new fad that just popped up. We're talking about the biggest names in the history of trading, absolute legends like Charles Dow, Jesse Livermore, and Richard Wyckoff. They all built their fortunes on this exact principle. You could say they were the original masters of VPA. And what's really incredible is that these titans didn't have fancy software or supercomputers. They had this, the ticker tape, just a simple stream of paper that gave them two and only two crucial pieces of data, price and volume. And from that alone, they could read the market's true intentions. It's amazing. As Anna Coulling writes in the book, once you really grasp this concept, it's a genuine aha moment. Seriously, the whole story of the market, which probably seemed like total chaos before, just suddenly starts to make sense.
So, how does this actually work in practice? Well, VPA is all about one thing and one thing only: learning to see what the insiders, or the smart money, are actually doing.
A core premise of the book is that markets are, let's face it, manipulated to some degree. The insiders, the big market makers, they can create rumors, they can trigger news events, all to push the price around. But, and this is the key, there's one thing they can never hide: their activity. To execute their massive orders, they have to participate, and it always shows up in the volume. Volume is their footprint in the sand. The book uses this brilliant little story to explain it, called the parable of Uncle Joe. So imagine Uncle Joe is the only person who sells widgets. He starts a rumor there's a shortage, which creates a ton of demand. As people scramble to buy, the price goes up and he sells off his entire inventory at those high prices. Then, his warehouse is empty. So what does he do? He starts a new rumor, this time about a competitor with a better widget, which creates a panic. All the people who bought high now panic sell. And who's there to buy all the widgets back for cheap? Uncle Joe. He just bought low and sold high by manufacturing the whole cycle. This is the game in a nutshell. And listen, this isn't just a fun little story. The author quotes a market analyst named Richard Ney, who exposed this very thing decades ago. He described market specialists as being like merchants, whose goal is to buy their inventory, stocks, at wholesale prices, and then sell them to us, the public, at retail prices. The parable is really just a simplified version of reality.
So how do we decode their activity? How do we see what they're doing? Well, it all comes down to a logical framework from that pioneer we mentioned, Richard Wyckoff. He laid out 3 universal laws that govern all markets.
Okay, law number 1, supply and demand. This is just basic economics, right? When buying pressure is stronger than selling pressure, prices go up, and vice versa. Simple. Number 2, the law of cause and effect. This just means big trends don't appear out of thin air. A long period of accumulation, that's insiders quietly buying up shares, is the cause that leads to a big uptrend, which is the effect. The bigger the cause, the bigger the effect. And number 3, and this one is the real secret sauce, the law of effort versus result. Think of volume as the effort being put in, and the price move as the result. These two things should always be in sync. If they're not, it's like the market's lie detector test is going off.
So let's get down to the most practical part. How do you actually apply this? How do you start reading the market using VPA?
When you look at your charts, you are now only ever looking for one of two things. First, is there confirmation? This is when price and volume are in sync, they're telling the same story. That's your green light. Or second, is there an anomaly? This is when price and volume disagree with each other. An anomaly is your signal that a move might be totally fake or that a trend is running out of steam. It is the market's warning shot.
And this illustrates the difference perfectly. On the left, you've got confirmation, a big, strong move up in price on high volume. This shows real buying pressure. The effort matches the result. That's a healthy, genuine trend, and you can trust it more. But on the right, you see the anomaly. A big move up in price, but look, it's on low volume. That is a massive red flag. There's no real effort, no conviction behind that move. It suggests the smart money isn't participating, and the whole thing could fall apart at any moment. This is the logic of VPA in action.
Ultimately, this all boils down to one simple but incredibly powerful idea. The price on your chart tells you what is happening. The market's going up, down, or sideways. But the volume tells you why. It reveals the conviction, the force, the truth behind that price action.
And so, the final question is really for you. The market is constantly communicating its real intentions through the language of price and volume. So now that you know the basics of that language, are you going to start listening?
So, what if I told you that the biggest secret to understanding today's crazy, high-speed, algorithm-driven markets wasn't cooked up in some Silicon Valley lab, but on Wall Street over 100 years ago? It turns out the key to the future of trading is actually buried deep in its past.
And this idea right here, from Jesse Livermore, one of the most legendary traders of all time, well, it's the key to everything we're about to unpack. He wrote this back in 1923, and you know what? It's probably more relevant today than it was even then. Human nature, he said, never changes. Now, if you're thinking this is going to be some new, complicated indicator, you're in for a surprise. This isn't about some black box algorithm. Nope. This is about a timeless method called volume price analysis, a way of seeing the market that built fortunes and iconic institutions. And it's all based on principles that are hiding in plain sight on every single chart you look at today.
To really get this, we've got to go back, way back, to the beginning. We need to meet the two guys who first looked at all the chaotic noise of the market and saw, they saw a language that could be learned, read, and understood.
So on one side, you have Charles Dow. Yeah, that Dow. You know his name from the Dow Jones Industrial Average and the Wall Street Journal. He's basically the grandfather of all technical analysis. And then there's his contemporary, Richard Wyckoff. This guy's story is incredible. Started as a stock runner at just 15 years old and became this passionate teacher, totally dedicated to helping the little guy understand the real game being played on Wall Street. Dow's main idea was actually super simple, but wow, was it profound. He believed that price, all by itself, can lie to you. But when you see a price move that's backed by high or rising volume, that was the confirmation. That was the proof that the trend was the real deal.
And Dow didn't stop there. He saw that every big trend plays out in 3 acts. First, you get accumulation. This is where the insiders, the smart money, are quietly buying up everything they can. Then comes public participation. That's when the trend becomes obvious and everybody else starts jumping in. And finally, the big one, distribution. This is when the public, they get that fear of missing out. They all pile in, and guess what? The same smart money that started the trend is now quietly selling all their shares to them at the top. And the key to seeing all of this, it was all revealed by the volume. Okay, so how in the world did they see all this? They didn't have fancy computer screens, right? No charting software, nope. All of these incredible insights came from this one simple clattering machine, the ticker tape.
Yeah, for almost 100 years, this was it. This narrow strip of paper was the entire window into the market. The original real-time data feed, just spitting out every transaction second by second. For traders like Dow, Wyckoff, and Livermore, learning to read the tape wasn't just, a neat skill to have. It was everything.
I mean, just look at this thing. It seems so ancient, right? But this little strip of paper, this is the raw data that built some of the greatest fortunes in Wall Street history. They didn't just see numbers. They saw the story of supply and demand, the battle between buyers and sellers. The tape, as they used to say, was talking to them.
And if you want to see its power, look no further. This is the actual ticker tape from the morning of the Wall Street crash in 1929. While the entire world was panicking, Jesse Livermore was calmly betting against the market. He reportedly made over $100 million that day. That's like billions today. All because he was listening to the story the tape was telling him.
And it really was its own language. The market moved so fast, they had to create this kind of shorthand to keep up. Dropping zeros, using letters to separate numbers. It was a dense code, for sure. But once you mastered it, you could see the market's entire story unfolding in your head, in real time.
Okay, so this is where Richard Wyckoff really steps onto the stage. He took this art of tape reading and he basically turned it into a science. He boiled it all down into 3 simple, universal laws that explain all market movement. And believe me, they are just as powerful today.
The first law? It's literally the most basic rule of economics on the planet. When more people want to buy something than sell it, the price goes up. Simple. When more people are trying to sell, the price goes down. Wyckoff put it perfectly. Think about a department store having a huge winter sale. They lower prices to get rid of their oversupply of coats and all the buyers rush in. It's that simple.
His second law tells us that big trends don't just pop up out of nowhere. A long period where smart money is accumulating or distributing, that's the cause, will lead to a big, significant trend. That's the effect. It's like a wave in the ocean. A tiny ripple isn't going to do much to a big ship, but a huge wave, one that's been building up for miles, well, that's going to cause a violent roll. The size of the cause creates the size of the effect.
And Wyckoff's third law, I love this one. It's like a harmony check. Think of it like Newton's law. For every action, there's a reaction. In the market, the effort is the trading volume, and the result is the price move. The two should always be in sync. So if you see a ton of effort, like massive, insane volume, but the price barely budges, whoa, that's a huge red flag. It's telling you something is out of balance and a change in direction is probably right around the corner. So these 3 laws give us this amazing framework for seeing what's happening. But then another key figure comes along, Richard Nye, and he starts asking why. He took Wyckoff's ideas and added a twist, arguing that these big moves weren't just the market being the market. They were often deliberately orchestrated.
And look, this wasn't some wild conspiracy theory from the fringes. This is a quote from a United States Senator, Lee Metcalf, writing in the foreword to Richard Nye's book. He put it right out there. The game is controlled for the benefit of insiders.
So, this creates a huge problem, right? If the whole market is just a game controlled by insiders who want to sell us stock at high prices and buy it back from us at low prices,
How can any of us possibly stand a chance? I mean, if the deck is stacked against us from the get-go, what's even the point of trying to play?
well, there's an answer, and it's a good one. Because according to all these pioneers, the insiders have a fatal flaw in their master plan. There's one thing they absolutely have to do to make their plans work. One footprint they just can't help but leave behind.
Volume. That's it. Volume. To accumulate or distribute massive amounts of stock, they have to actually transact. And every single one of those transactions, big or small, shows up as volume. It's the one thing they can't fake. It's the lie detector test for the market. It reveals the truth.
And that brings us full circle, right back to today. We've gone from the 1880s all the way to now. But the fundamental story, it hasn't changed one single bit.
Just look at this. On the left, you've got that chaotic mess of paper from 1929. On the right, a clean, modern digital chart. The technology is worlds apart, obviously. But the game, the underlying game of supply and demand, of effort versus result, of accumulation and distribution, all revealed through price and volume, it is exactly the same. The game hasn't changed, which means the rules for reading it haven't either.
So everything those traders figured out by staring at a clattering machine, it's just as true for us staring at our glowing screens. A modern chart is just a new kind of ticker tape. It's always telling a story, always revealing what the biggest players are really up to. The only question left is, are you listening?
Hey, welcome! Today we're going to pull back the curtain on a secret that the biggest players in the market really hope you never figure out. We're talking about a way to read the market's mind. And no, it's not a crystal ball. It's a simple, powerful tool that's been hiding in plain sight this whole time. Let's dive in.
You know, Warren Buffett absolutely nailed it here. Trading is an information game, plain and simple. The pros, the insiders, they have this massive advantage because they can see things we just can't. They see the entire market's supply and demand. So how are you, the regular trader, supposed to compete when you're always a step behind?
Well, that's the million-dollar question, isn't it? What if I told you there's one signal, one footprint they leave behind on every single chart that gives away their true intentions? It's the key to knowing if a big market move is for real or if it's just a trap.
To really get this, we're not going to start with complicated charts or fancy algorithms. Nope. Instead, I want to tell you a story. It's a simple little parable about a man named Uncle Joe and his unique business. And believe me, buried in this story is the entire secret to reading the market.
So let's meet Uncle Joe. He owns the one and only company in the whole state that distributes widgets. He's got a government license, a total monopoly, and for years his business has been, well, it's been stable, it's been predictable, and honestly, it's been kind of boring.
Uncle Joe started thinking, just buying and selling these widgets for a tiny profit? It's just not cutting it anymore. He's got a warehouse, staff, bills to pay. He wants to make some real money. And here's the crucial part. He doesn't need a better widget. He just needs to make more money from the ones he already has sitting right there in his warehouse.
So he cooks up this really clever two-part plan. Part 1, he needs to create some buzz. He knows his neighbor is the biggest gossip in town, so he casually mentions to him that he's really worried about a big widget shortage coming up. Even begs the guy, please don't tell anyone, knowing full well that rumor will be all over town by sunrise. For a few days, crickets. Nothing. But then, after about a week, it starts to work. More and more people are showing up, buying more widgets than they usually do. And as Uncle Joe sees this demand picking up, he starts nudging his prices, a little higher, then a little higher. And people keep buying. They're terrified of that shortage he made up.
But, a problem starts to brew. His plan is working a little too well, and his warehouse shelves are starting to look pretty bare. But then he spots something subtle, a tiny clue. Even as he's pushing prices higher, the number of widgets being sold each day, the volume is starting to go down. Fewer people are buying. The whole move is running out of steam.
And this leads us to part 2 of his plan, the really devious part. He needs to get all his widgets back, and he needs to get them cheap. As luck would have it, his gossipy neighbor comes running to him with a hot new rumor. A massive new widget company is moving into town. Instead of denying it, Uncle Joe puts on his best act. He looks devastated and basically confirms that, yeah, widget prices are about to completely crash.
And this is just a masterclass in using fear. Within days, his customers are literally lining up outside his door, begging him to buy back their widgets before they become totally worthless. So what does he do? He slashes his prices, fueling the panic even more. And he happily buys back every single widget for pennies on the dollar. Just like that, his warehouse is full again.
So things go back to normal. That big competitor never shows up, of course. And Uncle Joe, who's just made a fortune on both the boom he created and the bust he engineered, is left with one single, chilling thought. This wasn't a one-time thing. This is a repeatable business model.
Okay, so why on earth are we talking about a fictional widget salesman? Because Uncle Joe isn't just a character in a story. He is the perfect analogy for the most powerful players in the real financial markets. It's time to meet them.
See, in the real world, Uncle Joe, he represents the market makers. These are massive licensed financial giants. Think major banks. Their official job is to provide liquidity. Basically, they're the wholesalers of the market. They are legally required to fulfill your buy and sell orders, managing their inventory of stocks and currencies, just like Uncle Joe managed his widgets.
The parallels are just, they're striking. Just like Uncle Joe, the market makers control the inventory. They're in this unique position where they can see both sides of the market, all the buy orders and all the sell orders coming in. And just like him, they can use news and events, sometimes relevant, sometimes not, to move prices around and create opportunities for them to buy low and sell high.
So this sounds pretty hopeless, right? I mean, they've got all the information, all the power. But they leave one clue behind. That little subtle signal Uncle Joe spotted? That is our secret weapon. It's volume.
So here's how it works. It's actually pretty simple. When you see a price moving up and the volume of trades is also moving up, that tells you the big operators, the Uncle Joes of the world, are participating. They are buying right alongside everyone else. This is a healthy, valid trend. This move has gas in the tank.
But here's a signal that can save your skin. If you see the price continuing to creep up, but the volume is starting to drop off, just like Uncle Joe saw with his widgets, that's when the alarm bells should be going off in your head. It's a huge warning sign. It means the big players are quietly slipping out the back door. The fuel is running out, and a reversal could be right around the corner.
Okay, I can hear you thinking, that's great for stocks, but what about the Forex market? It's the biggest market on the planet, but it has this one big problem. There's no central exchange, so it doesn't report true volume. So are we just flying blind? Well, not exactly. There's a really clever workaround we can use. It's something called tick volume. So instead of counting how many actual dollars or contracts are traded, it just counts how many times the price changes, or ticks, up or down in a certain amount of time. It's basically a measure of market activity. And get this, a bunch of studies have shown that this activity level is about 90% correlated with true actual volume. It's a fantastic proxy.
Think about it like this. Imagine a big auction in a major city on a sunny summer day. The room is packed. People are yelling, the bidding is frantic, and the price is just jumping all over the place. That's high activity, right? High tick volume. Now, picture that same auction, but it's in a tiny town on a rainy Tuesday in February. The room's empty, one person makes a bid, and bam, the hammer falls. That's low activity, low tick volume. The number of price changes tells you everything about the level of interest. Look, understanding the mechanics of volume, that's one thing. But the real aha moment, the real breakthrough, comes when you make a fundamental shift in your perspective. You have to stop thinking like a retail trader, and you have to start thinking like the wholesaler.
And this just perfectly illustrates the difference. When the market absolutely plunges on massive, massive volume, what does the average retail trader do? They panic, they sell, they're afraid it's going to zero. But what is the wholesaler, the market maker, doing at that exact same moment? They're seeing a buying climax, a massive fire sale. They are happily, quietly buying up everything the panicked sellers are dumping. Our job is always, always follow the wholesaler.
Now, I want to be clear, this isn't some magic trick you learn in 5 minutes. The legendary trader Richard Wyckoff said it perfectly. This is an art, not a science. There are no shortcuts here. It takes time, it takes practice, and it takes a lot of sweat of the brow to really master the skill of reading the relationship between price and volume correctly.
But the path forward is clear. The insiders, the Uncle Joes, the market makers, they can't hide their actions completely. Their footprints are right there, visible in the volume on every chart, in every market. They have shown you their hand. The only question left is, are you going to learn how to read it?
You ever stare at a price chart and just get this feeling that you're missing something? You know, like you're only seeing part of the picture? Well, turns out you're probably right. Today, we're going to track down the trader's missing sense.
So let's kick things off with a word from a legend, Jesse Livermore. He said this more than 100 years ago, and it's so true it hurts. The technology changes, for sure, but the game stays the same. Why? Because it's driven by people, by fear and greed, and that stuff is timeless. Now, in today's world of screens and algorithms, there's this really popular strategy called price action trading, or you'll hear it called PAT. The idea behind it is pretty clean and simple. You make all of your decisions based only on what the price chart is telling you. The theory is that everything, news, sentiment, you name it, is already baked right into the price. But that leads us to the big question, doesn't it? Is that price chart all by itself really the whole story? Or is it kind of like trying to watch an epic movie with the sound completely muted? You see the action, but you're missing all the context. To really get the answer, we've got to take a trip back in time. Forget your quiet home office. I want you to picture the old trading pits, like the life floor in London. This was not a calm, orderly place. It was a chaotic, sweaty mess of people yelling, screaming, using frantic hand signals. It was a literal soup of human emotion.
And that's where you see this huge difference. See, in the pit, traders didn't just see the market on a screen. They felt it. They could feel the weight of buy orders coming in. They could hear the panic in the roar of the crowd. Today on our screens, we mostly just see one thing: price.
That physical feeling, that sixth sense for the market's flow, that was their edge. It was their human version of volume. And you know what? It's the very reason so many of those incredible pit traders washed out when everything went electronic. They lost one of their senses, and without it, the price action on the screen just felt empty. So what does it actually feel like to lose a sense like that? Let me put it this way. Let's use an analogy pretty much everyone can get. Just imagine you're at an auction and you're ready to bid on something you really, really want. Okay, so you're in a real room, right? You're soaking up tons of information. You can see how many other people are bidding. You can see that guy across the room who's starting to hesitate, which tells you he's probably at his limit. You can feel the energy, the excitement building. You have all this rich context. Now, let's switch gears. You're at home bidding in an online auction. What do you see? A number. That's it. Just the price ticking up and up and up. All that human context, it's gone. Poof. You're basically flying blind. I mean, think about what's missing. You have no clue if you're in a bidding war with 10 people or just one other person. You can't see their confidence or their fear. And here's the kicker. You don't really know if all the bids are real. An auctioneer could be taking fake bids off the wall just to push you higher. All that crucial info is just invisible. And that right there is the danger. Trading using only the price chart is exactly like being in that blind online auction. You see the what, the price is moving, but you have no idea about the who or the how much. You're missing the conviction behind the whole move. Okay, so I've been hammering this idea that price is only half the story, but let's be super clear. It is a very, very important half. Every single one of those little candles on your chart is like a mini story. It's the fossil record of a battle that happened between buyers and sellers. So let's do a super quick breakdown. You know the basics? A candle shows you the open, the high, the low, and the close for a period. But the real drama, the part that gives away the secrets, that's in the wicks. Those thin little lines that stick out from the body of the candle, the wicks, they are incredibly important. They basically represent a failed attack. They show us a price that was reached, but then it was rejected. The wicks tell the story of a turning point in the battle. All right, let's watch how this works. Over on the left, you see the sellers are in control at first. They're pushing the price down. But then something shifts. The buyers storm in with so much force that they push the price all the way back up. And the result of that skirmish? It's the candle you see on the right, with that long tail on the bottom. So what's this candle yelling at us? It's telling a story of rejection. It's saying, hey, the sellers tried to take over and drive this market down, but they got stuffed. The buyers soaked up all that pressure and came back even stronger. It's a clear signal that the bulls won that session. And of course, the same thing happens in reverse. Here, the buyers start out all confident, pushing the price higher, but they hit a brick wall. They run out of steam, and the sellers see their chance. They come in hard and shove the price right back down. And this creates the candle on the right, the one with the long upper wick. The story here is all about exhaustion. That initial bullish push, it was totally rejected. This candle is telling us that the buyers just couldn't keep it up, and by the end of the round, the sellers had taken firm control. It's a really clear sign of bearish pressure. So we can read these stories, we can see the fight, we can see the rejection, but, and this is the million-dollar question that the price chart can't answer on its own, how do we know if it was a real heavyweight battle or just a tiny little skirmish? How do we know if the move is genuine? This is it. This is where we get our missing sense back. The answer is volume. Volume is the tool that lets a modern screen trader get that feel for the market back. It's the confirmation. It's the piece of evidence that validates the story the price candle is telling you. Think of it like this. Price shows you the footprint. Volume tells you how much the thing that made the footprint weighed. It measures the force, the commitment, the conviction behind a move. It's how you tell the difference between a real shift in the market and just a bunch of noise. Look, here's the bottom line. Price action can tell a really compelling story. But sometimes that story is a complete work of fiction. Volume is the truth serum. It adds that second, crucial dimension that tells you whether the story you're seeing is fact or fantasy. It reveals the truth.
So by putting these two things together, the story from the price and the validation from the volume, you're not bidding blind in that online auction anymore. You're giving yourself that missing sense back. So the only question left is, now that you can see the whole picture, what truths are your charts going to reveal to you?
Welcome to The Explainer. Today, we're going to decode the secret language of the market. It's a technique called volume price analysis, or VPA for short. All right, let's dive right in. So, to really get a grip on VPA, we've got to understand the story behind the price. And that story, well, it always kicks off with a classic problem that, every single trader has to deal with.
Okay, picture this. You see this big, exciting price move on your chart. Your first thought is to jump in, right? But hold on. How do you really know if that move is the real deal? With actual conviction behind it. Or is it just a trap? Something designed by the big players to fool you into a bad trade.
And that's where VPA comes into play. It's this incredibly powerful technique, and it's all based on a simple, brilliant idea from a market legend named Richard Wyckoff. He said you have to analyze the relationship between the effort, and by effort we mean the trading volume, and the result, which is just the price change you see right there on your chart.
Really, when you strip it all down, VPA is about asking one simple question over and over again. Does the volume validate the price move, or is it showing us an anomaly? That's it. We're always on the lookout for one of two things. Either the volume confirms what the price is doing, which is great, it tells us the trend is healthy, or it reveals some kind of disconnect, an anomaly, which is a huge warning that things might be about to change. Okay, so that's the theory. But how do we actually crack this code in the real world? Let's break it down. We're going to start by looking at just a single price bar and 4 basic scenarios. First up, 2 examples where the story the chart is telling us makes perfect sense. All right, have a look here. We've got this wide blue candle. It's showing a pretty big move up in price. So that's our result, right? And on the surface, man, that looks super bullish. But here's the all-important question. Does the effort match the result? I mean, does the trading volume actually support this big move? Is it genuine? And the answer is yes, it absolutely does. Just look at that high volume bar down below. We've got a big result, that wide price candle, and it's matched by a big effort, the high volume. This is what we call a validation. The story checks out. It's telling us this bullish move is legit, with real money and real participation behind it. Okay, now let's flip the script and look at the opposite scenario. Here we've got a really narrow price candle. The result was tiny. I mean, the price barely moved at all. And again, the story makes perfect sense. The low volume underneath it confirms that, well, not much effort went in, which logically led to a very small result. So, a narrow price spread on low volume? That's another perfect validation. Nothing to worry about here. It all adds up. All right, now we get to the really juicy stuff. This is when the story the chart is telling you just doesn't add up. Check this out. A big, wide price candle. A huge result, right? But now look at the volume. It's tiny. This, my friends, is our first big anomaly. This should set off alarm bells. It's a massive red flag. Why? Because a big price move without the volume to back it up just screams no conviction. This is often a classic trap move. The big players are just pushing the price around to suck people in before they slam it in the other direction. And the second type of anomaly is just as powerful, but it's the complete opposite. Here, you see a huge amount of effort. I mean, look at that massive volume bar. But the result? A tiny, little price candle. The market put in all that work and basically went nowhere. This is just a beautiful illustration of a market that's running out of gas. I love this analogy. It's like a car trying to drive up an icy hill. The engine is absolutely roaring, the wheels are spinning like crazy, that's our high volume, but the car is just not moving. It's a clear sign that the trend is exhausted. This often tells you the top of an uptrend or the bottom of a downtrend is right around the corner. So let's just recap the code we've cracked here. It's simple, really. You are always looking for one of two things. Either the effort and the result match up perfectly, that's a validation, things are good. Or you spot a glaring mismatch, a disconnect, and that's your anomaly, your warning sign.
Okay, so we've got the single bar down. Now let's zoom out a little. We're going to see how this exact same logic applies not just to one bar, but to reading the health of an entire market trend.
And you'll see it's the exact same principle, just stretched out over multiple bars. Take a look at the chart on the left. You've got prices climbing higher, and they're supported by rising volume. Effort and result are in sync. That's a healthy, happy, validated uptrend. But now, look to the right. Here, prices are still going up, but the volume is falling. That is a major anomaly. It's a huge warning sign that this trend is running out of steam and is probably very weak.
And you guessed it, the same thing is true for downtrends. A really strong, convincing sell-off needs effort, right? So it's confirmed by rising volume, just like you see on the left. But if you see prices falling and the volume is just drying up, just disappearing, like on the right, that's telling you the selling pressure is pretty much exhausted. The move is probably over.
Okay, so you get the patterns now. But to use VPA effectively, you need more than just recognizing shapes on a chart. You've got to have the right mindset. So let's go over a few key principles that will really make this work for you.
First things first, you have to be patient. Seriously. You might spot a textbook anomaly, a perfect warning sign, but the market, it has momentum. Think of it like a giant supertanker. It can't just stop and turn on a dime. It takes time to slow down and change course. So whatever you do, don't just jump in on the very first signal. Wait for the turn to actually be confirmed.
And this is super important. Remember that VPA is an art, not a science. It's a skill you develop over time, not some precise formula you can just plug into a computer. Your analysis is always going to be a bit subjective. And remember, you're just comparing one volume bar to the ones right before it. On your chart, it's all relative. So don't get hung up on having the perfect data feed. Consistency is way more important than absolute accuracy.
And to keep your analysis organized, just follow this simple 3-step process every time. I like to think of it like using a camera lens. First, you start at the micro level, zoomed way in on the current price candle and its volume. Then, you zoom out a little to the macro level and look at the last few candles to see the immediate context. And finally, you zoom all the way out to the global view to see the big picture, the entire long-term trend. Wow, we've covered a ton of ground, haven't we? From single bars to entire trends. So let's bring it all home and boil it down to one final, crucial takeaway.
From now on, I want you to try something. Don't just look at price anymore. Look at every single chart you see through this new VPA lens. Ask yourself that simple question. Does the effort validate the result? Is the story this chart is telling me consistent, or is there an anomaly hiding in plain sight? I promise you, once you start asking that question, you will never ever see your charts the same way again.
All right, let's dive right in and talk about what really drives the markets. We're going to pull back the curtain on the campaigns that insiders use to control price action, turning what looks like chaos into a predictable and, for them, very profitable cycle. You know, we're always told that the market is unpredictable, right? That all these price moves are just random reactions to news and events. But what if that's not the whole story? What if there's a deliberate, repeatable pattern hiding behind all that noise? A hidden logic that, once you see it, kind of changes how you view everything.
To get a handle on this, you have to start thinking like a merchant with a warehouse. It's this fantastic analogy used by market veterans like Richard Nee, and it's really the key. The insider's goal is shockingly simple. Fill their warehouse with stocks at wholesale prices, and then turn around and sell that inventory to the public at retail prices. That's it.
So the whole campaign kicks off with phase 1, accumulation. This is all about stocking that warehouse when prices are low and, frankly, when nobody else wants to touch the stuff.
The main goal here is just to get their hands on a massive amount of stock before they can even think about a big selling campaign. I mean, think about it. A real wholesaler wouldn't launch a huge ad campaign with empty shelves, right? Same idea. They have to fill their warehouse first.
So how in the world do they get all this cheap inventory? Well, they pretty much weaponize the news cycle. They use any bad news they can find, political drama, bad economic numbers, you name it, to really stir up fear. That fear triggers panic selling from the public, which pushes prices way down to those wholesale levels, where they can just sit back and quietly buy it all up.
And this is what that process actually looks like on a chart. See how the price gets stuck in that sideways congestion zone? They push it down to buy, they let it pop back up, then they push it down again. This back and forth, this whipsaw action, it's like shaking olives from a tree. They just keep shaking and shaking until every last nervous seller has finally let go of their shares.
Okay, so once the warehouse is completely full, the whole campaign just flips on its head. The tough part, the buying, is over. Now it's time to start selling and lock in those profits. The goal now is the complete opposite of what it was before. It's all about unloading that entire inventory onto eager buyers at the highest possible retail prices. They bought it low, and now they need to manufacture the hype to sell it high.
And to pull this off, they totally switch tactics. The bad news machine gets turned off, and suddenly it's replaced with this constant fire hose of good news. They build that bullish momentum, but they do it slowly, carefully, creating that classic fear of missing out. FOMO. They want every single person convinced the market is headed straight to the moon.
And this just illustrates that distribution phase perfectly. As prices are hitting their peak, the public, totally driven by greed and FOMO, is rushing in to buy. And of course, the insiders are more than happy to sell every last share they have to this wave of demand, which creates another one of those congestion zones right at the very top of the market as they empty out their warehouse.
When you put it side by side like this, the playbook is just crystal clear, isn't it? The entire campaign is built on playing with the two most powerful market emotions. They create fear to buy from you at the bottom, and then they manufacture greed to sell to you at the top.
But here's the thing. Insiders don't just guess when it's time to make a big move. Oh no, they're way too precise for that. Before they really commit, they always run a little secret test to see if the market is actually ready for what's coming next.
So after they've been accumulating stock and the price is just starting to look good, they'll suddenly slam it back down. And you might ask, why would they do that? Well, this is their test for supply. If hardly anyone sells on that dip, if the volume is super low like you see on the left, that's a green light. It proves all the sellers are gone. But if volume is high, like on the right, it tells them, oops, still some sellers left. They've got more work to do.
And they do the exact same thing at the top. After they've distributed their shares, they'll give the price a little push upwards. This is their test for demand. If nobody bites and volume is low like on the left, it confirms the buyers are exhausted. The market is ready to drop. But if a bunch of buyers rush in on high volume, they know they can probably squeeze out a few more sales.
All right, now let's see how this all comes together in the final, climactic stages of the campaign. This is where you get the real fireworks. Right at the very end of that accumulation phase, you get what's called the buying climax. This is one last violent shakeout. They crash the price one last time on huge volume just to scare the absolute last, most stubborn people into selling. This is them sweeping up the very last shares before they launch the new uptrend.
And at the top, you see the perfect mirror image, the selling climax. This is the final party. They surge the price one last time on massive volume, sucking in every last FOMO-driven buyer just as they're selling the last of their inventory. It's the grand finale right before they pull the rug out.
And here it is, the whole playbook in a single picture. It starts with accumulation down at the bottom. You get a buying climax and a successful test. Then comes the markup, where they build the uptrend. At the top, you get the distribution phase, capped off by a selling climax. And after one final test for demand, they send the market right back down again. For them, it's really just another day at the office.
Now, look, I know this all might sound a little bit like a conspiracy theory, but check out this quote from Richard Ney. He describes how market insiders literally used a national tragedy, a terrible one, as the perfect cover, the perfect alibi to crash prices, fill their warehouses, and kick off a brand new accumulation campaign.
So you see, this isn't just about understanding what happened in the past. It's about giving you a new lens, a new framework to look at what's happening right now. Once you understand this playbook of fear and greed, of accumulation and distribution, you can start to ask the most important question there is. Looking at today's market, which phase of the campaign do you think we're in right now?
Let's be real. You've stared at a price chart, you've seen a sudden spike or a big drop, and you've just felt completely lost, right? You're wondering what on earth is actually driving this move. Well, today we're going to decode a method that really pulls back the curtain on what the market is really thinking. Ah, yes, the classic dilemma. It's the question every single trader has to ask themselves. You see that price just shoot up and that fear of missing out, it just kicks right in. So you jump in and bam, the market slams into reverse and you're caught. Answering this one question correctly, well, that's the difference between a fantastic trade and a really, really bad day. And the secret to solving that dilemma? It's right here. Just think of it like effort versus result. Price, that just shows you the result. It's the final score. But volume shows you the effort. It tells you the story behind the move, the power, the conviction, the why. Without looking at volume, you're honestly trying to read a book with half the pages ripped out. Now, when you put these two together, you get what we call volume price analysis, or VPA for short. And look, this isn't some new fad. It's a way of reading the chart that's been around for over a century, and for a very good reason. It's all about figuring out what the professional or smart money is doing, not just what they want you to see.
So, to get started, we need a code book. Think of it like that. There are 5 basic principles that everything else is built on top of. Once you get these down, the charts just start to speak a completely new language.
First up, the wicks. I want you to think of a long wick like a footprint in the sand. It shows you exactly where the price tried to go, but got pushed back. So if that long wick is on top of the candle, you know the sellers won that little battle. If it's on the bottom, the buyers fought back and won. It's your very first clue about the balance of power.
On the flip side, what about a candle with no wick at all? This is a sign of pure total dominance. It means that from the moment the session opened to the moment it closed, one side, either the buyers or the sellers, was in complete control. There was no fight, no back and forth. It was just a clear, undisputed win.
Okay, third, we've got to look at the body, the thick, solid part of the candle. A nice, wide, long body shows real conviction. It means price moved a long way from its open and closed with authority. But a tiny, narrow, squat little body, that suggests hesitation, maybe even boredom. The market just didn't really go anywhere with any purpose. Now, principle number 4 is maybe the most important of all. Context is king. You have to remember, no candle just exists in a vacuum. A big warning sign of weakness that appears at the very peak of a long uptrend, that's a huge deal. But that exact same signal appearing in the middle of a messy, sideways market, it probably means nothing. You always have to ask yourself, where are we in the bigger picture?
And that brings us to the golden rule of VPA. You might have heard this one. Price proposes, but volume disposes. You see a move happen on the price chart, and then your eyes immediately flick down to the volume bars to see if they agree. Does the volume validate what you're seeing? Or is it telling you that something is off? This right here is where the real detective work begins.
All right, so now that we have our code book, let's see how these principles come together to create the 3 most important, high-priority signals you're going to see on any chart. If you can master these 3, you are well on your way. So first up is the shooting star. The story it tells is pretty simple. Buyers tried their best to push the price way up, but then the sellers came in with overwhelming force and just slammed it right back down. Now here's the cool part. Volume totally changes its meaning. On low volume, it's a minor warning, maybe a little pause. On average volume, okay, pay attention. But on ultra high volume, that's a blaring alarm bell that big money might be dumping their positions. So you see a shooting star like this after a really nice run-up. Is it time to sell everything and run for the hills? The answer is not so fast. A single candle is just a clue. It's a warning shot. The market almost never turns on a dime. We have to wait and see what happens next. Does more weakness follow, or do the buyers show up again? This first signal just tells us to start paying very, very close attention. Now, the opposite of the shooting star is the hammer, and here, the sellers tried to push the price down, but the buyers stepped in, absorbed all that selling, and drove the price all the way back up. The name is just perfect. It literally looks like the market is hammering out a solid base. And just like before, volume tells us how strong that buying really was. Big volume means big money is probably involved.
And our third key signal is the long-legged doji. This candle just screams indecision. You can see price swung wildly up and down during the session, but ultimately closed right back where it started. Bulls and bears fought to a draw. It's a potential turning point, but here's the trap. You have to look at the volume. If you see this massive price swing on low volume, it's a huge red flag. That means it wasn't a real battle. It was probably just insiders shaking the tree, trying to hunt for stop-loss orders before they make their real move.
Yeah, this idea of an anomaly or a trap is so important. Let's really dig back into that effort versus result idea to see how the market can disguise its real intentions and set traps for everybody else. Take a look at this. When you see a big, wide candle, a huge move in price, you expect to see big, high volume to back it up. That makes sense, right? That's validation. But what if you see that same huge price move happen on weak, pathetic, low volume? That's an anomaly. The move has no real fuel in the tank. It's often a trap set by professionals to suck retail traders in before they reverse the price. Okay, now let's flip it around. A little, narrow candle means the market didn't really move much, so we'd expect to see low volume. Simple enough. But what if you see huge climactic volume on a candle that went absolutely nowhere? That is a massive red flag. It means an epic battle is taking place under the surface. A tremendous amount of effort is being used, but the price is totally stuck. This often happens right at a major turning point, as one side completely absorbs all the pressure from the other.
All right, we've been looking at individual candles, looking at the trees. Now let's zoom out a bit and see how VPA can reveal the very beginning and end of major trends, how we can see the turning of the tides in the whole forest. This is honestly the perfect analogy. Major market trends have incredible momentum, just like a giant oil tanker. They don't just stop instantly and whip around. No way. First, they have to slow down, they churn, and then, gradually, the process of reversing begins. VPA helps us see the very first signs of the brakes being applied. And this illustrates that process perfectly. The market is in a free fall, right? Panic selling is everywhere. Then, you start to see these candles with deep lower wicks. And at the same time, the volume starts to rise significantly. This is what we call stopping volume. It is the visual evidence of professional money stepping in and absorbing all that panicked selling, literally putting a floor under the market.
And you guessed it, the exact reverse happens at the top. The market is in a euphoric uptrend. Everyone's excited. But if you look closely, the price spreads are getting smaller. The candles are developing those deep upper wicks, and all of this is happening on very high volume. The market is clearly struggling to push higher. This is topping out volume. It's insiders selling their positions to the excited crowd, and the oil tanker's engines are being thrown into reverse.
So, what's the bottom line here? What does this all actually do for you? Well, it gives you a solid framework for making decisions with real confidence. It helps you spot those high-probability entries when the professionals are getting involved. It helps you stay in a good trade during those scary little pullbacks because you can see if the volume confirms it's just a pause. And maybe most importantly, it gives you clear signals when the trend is running out of steam, helping you get out at the right time. At the end of the day, price by itself is really just noise. But when you combine it with volume, it becomes a narrative. It's a story of effort, of conviction, and sometimes of manipulation. The chart is always, always talking. The only real question is, are you just listening to the headline, or are you actually reading the full story? Have you ever stared at a price chart and just wondered, why? Why does it get stuck moving sideways for days or sometimes even weeks at a time? Well, it turns out there's this invisible framework, kind of like a hidden map that's guiding all that action. Today, we're going to make that map visible. We're going to really dig into the core concepts of support and resistance. So here's the game plan. We'll start by decoding that sideways dance prices do. Then, we're going to get into the psychology of it all, the fear and greed that actually build these levels. After that, we'll get practical and learn how to spot these zones early. Then, we'll cover the exciting part, the anatomy of a breakout. And finally, we're going to wrap it all up with a really powerful mental model that'll make this stuff stick. All right, let's jump right into part 1, the market's invisible map. We're going to decode that sideways dance you see all the time on the charts. This is really the foundation for everything else. So this is the big question, isn't it? Why do markets get stuck? Because, if you can figure out why a market takes a pause, you can start to get a real edge on where it might be headed next. The best way to think about this is like a ball bouncing in a room. The price hits an invisible floor, we call that support, and it bounces right back up. Then it hits an invisible ceiling, we call that resistance, and it gets knocked back down. It just keeps oscillating back and forth inside this channel. And here's why you absolutely have to understand this. Markets spend roughly 70% of their time in this sideways grind, this congestion phase. They're only really trending up or down about 30% of the time. So if you don't get this, well, you're missing the market's default state. It's the most important skill you can have. Okay, but what's actually creating these floors and ceilings? Are they just random lines somebody drew on a chart? Absolutely not. Let's get into the human psychology behind it all. It is so important to get this. These levels aren't some kind of magic. They're the real, tangible result of thousands and thousands of people making decisions based on two really powerful emotions, fear and greed. Think of these levels as the market's memory, written right onto the chart for everyone to see. And this right here just illustrates that emotional cycle perfectly. It doesn't matter if the market is at a top or a bottom, the pattern is exactly the same. Greed sucks traders in at the absolute worst moment, right at the peak. And then fear forces them out right as the market turns around, locking in their losses. It's a painful cycle. This really brings us to two kinds of traders. First, you've got the weak hands. They trade purely on emotion. They see prices rocketing up, get a huge case of FOMO, fear of missing out, and they buy at the top. Then when it reverses, they panic and sell at the bottom. On the other side, you've got the strong hands. They're patient. They wait for the price to come back to that floor of support, and they calmly enter there. The battle between these two groups is what literally builds these support and resistance zones. Okay, so we know the why behind these zones now, but let's get to the practical stuff. How do we actually find them on a live chart as they're happening? I mean, it's super easy to look at a chart from last week and draw perfect lines, right? Hindsight is 20/20. The real skill, the money skill, is spotting a congestion zone just as it's starting to form. So how do we do that? Well, the answer lies in these simple little patterns called pivot points. They're usually just 3 candles or bars right next to each other. A pivot high is just when that middle candle's high is higher than its neighbors. And a pivot low is the exact opposite. These are the first little breadcrumbs, the building blocks of a range. And the process from here is incredibly simple. Step 1, you wait for a clean, obvious pivot high to form. That's your potential ceiling. Step 2, you wait for a clean pivot low to form. And that's your potential floor. And boom, just like that. With those 2 simple points, you've just drawn the very first lines on your map. You've defined the initial boundaries of that congestion zone. And now you have a framework. You can watch how the price acts inside this brand new channel. Of course, no market stays cooped up in a range forever. The tension builds, and eventually the price has to break free. So let's look at the anatomy of that exact moment. This is like a law of physics in the market, cause and effect. Think of that congestion phase as coiling a spring. The longer the market goes sideways, building that cause, the more energy it stores up. And that means the eventual breakout, the effect, is going to be that much more powerful and dramatic. So what is a breakout? Well, it's pretty much what it sounds like. It's a decisive, powerful move where the price doesn't just peak above the ceiling or below the floor. It has to actually close firmly outside of that range. That's the signal that control might be shifting. But, and this is a huge but, not all breakouts are the real deal. You need 2 key things to feel confident. First, you need that clear close outside the range. We just talked about that. Second, and this is absolutely non-negotiable, you must see strong and rising volume. It takes energy to break through a wall, and in the market, volume is that energy. And this quote just says it all, doesn't it? A breakout that happens on weak, low volume is a massive red flag. It's often just a fake out, a classic trap designed to catch emotional traders on the completely wrong side of the market. You've got to remember, volume is the ultimate truth serum. Okay, to bring every single one of these ideas home, let's use one final, incredibly powerful analogy. This is the thing that's going to cement this concept in your mind for good. I want you to imagine the market isn't a chart. It's a house, a big house with multiple floors. All those support and resistance zones we've been talking about, they're just the floors and ceilings of the different rooms in the house. And the price? It's just a person walking from one floor to the next. And here is where the real magic of this whole concept just clicks into place. When the price breaks up through the ceiling of the ground floor, what happens in a real house? That old ceiling, that old resistance level instantly becomes the brand new floor, the new support for the room on the second story. And it works exactly the same way in reverse on the way down. An old floor becomes a new ceiling. So why does this matter so much? Well, for a trader, this is huge. Once you break out, that old resistance level gives you a natural floor of protection. It provides a launch pad, a support area for the price to continue moving higher. And it creates this perfect win-win situation where you have a logical place to manage your trade, all thanks to the market's own structure. You see, these zones are like the market's DNA. They tell its history, its psychology, its story, all rolled into one. So the next time you pull up a chart, don't just see a bunch of random zigzags. Look for the floors, look for the ceilings. Ask yourself, what story is this chart telling me right now? And where is it likely to go next? All right, let's talk about trend lines. We're about to flip one of the most common ideas in trading completely on its head. Forget using them to see where the market has been. We're going to dive into how you can see where it's going, pretty much as it's happening. It's a whole new way of looking at the market. You know, this quote from David Einhorn, it just hits the nail on the head, doesn't it? The loss was not bad luck, it was bad analysis. It reminds us that successful trading, it's not about luck. It's about having a solid analytical framework that actually works in the real world. You know, not just in some dusty old textbook. So, that brings us to this huge question. We've all heard it 1,000 times, right? The trend is your friend. But what if? What if that's actually bad advice? I mean, what if that one simple phrase is the very thing that's getting you into trades way too late and maybe out even later? Let's dig in and find out. Okay, so to really get to the bottom of that, we first have to deconstruct the myth that's been built up around traditional trend trading. Okay, so this is the classic picture, right? It's in every single trading book you'll ever open. They all say the same thing. Wait. You got to wait for the market to make a series of higher highs and higher lows. Then you connect at least 3 points on top, 3 on the bottom, and boom, you've drawn your perfect little channel. It seems so simple, doesn't it? Well, here's the massive problem with that. By the time you've actually got those 6 perfect little points all lined up nice and neat, the big move, it's probably already happened. You are literally just showing up to the party as the insiders, you know, the smart money, are quietly slipping out the back door. You're not just late, you're showing up when the party's already over. So if waiting around for an established trend is the wrong move, where should we be looking instead? Well, the answer is pretty simple, actually. We need to look at where trends are born. And the answer is right here. It's in what we call price congestion. Now, these are those kind of boring sideways periods on a chart that, let's be honest, most traders just completely ignore. But this is the most important area on the whole chart. Why? Because this is where the insiders are either accumulating assets, getting ready for a big move up, or they're distributing them, getting ready for a move down. This is the market coiling up like a spring, just building up energy for its next big run. Okay, but how do we know what's actually going on inside that congestion zone? Are they buying or selling? That's where volume price analysis, or VPA, comes in. Think of volume as a kind of lie detector for the market. It confirms if a price move is the real deal or just a fake out. It tells us if the big players are truly buying or selling. And this is how we can start to anticipate the trend before it even begins. To really understand how to build these trends dynamically, we need to get back to basics. We've got to understand their fundamental DNA, and that takes us all the way back to the very foundations of technical analysis. So Charles Dow, pretty much the father of trend analysis, he laid out these 3 stages. First up, you've got the accumulation phase. This is when the smart money, the insiders, are buying, but they're doing it quietly. Then comes the trend-following stage. This is when the public, the media, everyone catches on and jumps on board. And finally, you get the distribution phase. This is where those same insiders start selling their holdings to all the latecomers. Our goal, our entire goal, is to spot that first phase and avoid getting trapped in the last one. Now, to build our trend in real time, we only need 2 really simple building blocks. Super simple. The first one is called a pivot high. It's just a 3-candle pattern where the middle candle pokes up and makes the highest peak. And the second is a pivot low. You guessed it, the exact opposite, where the middle candle makes the lowest little valley. These small peaks and valleys, these are the markers we're going to use to build our roadmap. All right, so now for the fun part. Let's put all these pieces together. Let's see exactly how we can use these little pivots to build a trend line proactively in real time instead of just drawing it after the fact. Okay, step 1. It all starts here. We're not looking for a trend that's already moving. Nope. We're looking for a market that's just moving sideways, consolidating, and basically getting ready for whatever's next. This right here is our new area of focus. Next up, we wait for the breakout from that sideways action. And this is absolutely crucial, we need to see it happen with a big surge in volume. That rising volume is our confirmation. It's what tells us the move is genuine and not just a trap. This is our trigger to pay attention. Now, we all know markets never, ever move in a perfectly straight line, right? So after that initial surge out of the gate, the price is going to pull back a little. It's totally natural. And the peak of that very first pullback, that forms our pivot high. This isn't the end of the move. No way. This is our very first marker, our first point of reference for the brand new trend. So after that little pullback, the market finds some support and bounces higher again. The bottom of that bounce creates our pivot low. And just like that, we now have our first two key markers, a high and a low, that are starting to define the boundaries of our new trend. See how we're building it?
And from here on out, the process is actually really simple. As the trend develops, we just keep connecting the new pivot highs and the new pivot lows as they form. I want you to think of these pivots like they're lights on the side of a highway, dynamically building the trend channel for you in real time. We are no longer drawing lines based on old, stale data. We're building them as the story is unfolding right in front of us.
So the really crucial point here is that this isn't just a slightly different technique. It's a completely different way of seeing and interacting with the market. It's a total mindset shift.
And the difference really couldn't be clearer. The old way? It's reactive. You're always looking in the rearview mirror. This new method, though, is proactive. You're building the trend in real time, looking ahead. One method pretty much guarantees you enter late, while the other gives you the opportunity to get in right as the trend is being born. It's a game changer.
So what's the big takeaway from all this? Well, here's your new toolkit. First, change your focus. Start looking at the congestion phase. That's the trend's breeding ground. Second, use volume as your truth detector for every single move. Third, build your trend using those little pivots as real-time markers. And the ultimate goal here? It's to shift from being a simple trend follower to becoming a trend anticipator. So the next time you pull up a chart, I want you to ask yourself this one simple question. Are you looking at the part of the story that's already over, or are you watching the blank page where the next chapter is just about to begin?
You know, in trading, it's often what you can't see that ends up hurting you. Well, today, we're going to pull back the curtain on a tool that reveals the market's hidden roadmap, and it all comes down to looking at one crucial metric, volume, in a completely new way.
Seriously, just think about that for a second. What if you could see the exact price levels where the biggest battles between buyers and sellers have already been fought? I'm talking about the hidden walls and floors in the market. Knowing where they are, that can change literally everything about how you trade.
Now look, most of us know volume is essential, right? It's the fuel that moves the market. But the way we usually look at it, those little bars at the bottom of the chart, it has a huge blind spot. Okay, so here's the critical difference. Traditional volume, it tells you how much was traded over, say, an hour or a day. But it doesn't tell you at what price most of that trading actually happened. And that right there is the blind spot. The solution is a tool called volume at price, or VAP. It literally flips the whole idea on its side to show you volume at specific price levels. And trust me, it's a total game changer.
To really get this, let's actually step away from the trading charts for just a moment. Let's think about a simple business idea that honestly everyone understands.
So picture a wholesaler, right? They're testing the market. On this chart, you've got price along the bottom and the sales volume on the side. It's pretty straightforward. As they jack up the price, the sales volume drops. This is your classic supply and demand curve, just mapping volume against price to find that perfect sweet spot.
Now, check this out. Here's the aha moment. If we take that exact same chart and just rotate it 90 degrees, we get this. All of a sudden, price is on the vertical axis and volume is on the horizontal. You see that? That is the core concept of volume at price. It's a histogram that shows you exactly how much business was done at each specific price.
And that super simple rotation, that is the key to unlocking one of the most powerful things VAP can do, making hidden market structures completely visible.
So let's put an official definition on it. Volume at price, or VAP, is just a horizontal histogram that sits right on your price chart, not below it. Each one of those bars sticking out shows you how much volume was traded at that exact price level over whatever period you're looking at.
And this is where the magic happens. Those long bars, they show you where a huge amount of shares changed hands. These are areas of high agreement, of intense fighting. They are the market's invisible barriers. We call them support, which is kind of like a price floor where buyers jump in, and resistance, a price ceiling where sellers tend to take control. VPAC literally paints these battle zones right onto your chart.
Okay, theory is great, but let's see how this actually plays out in the real world. We're going to take a look at a chart of Microsoft and read the story that VAP is telling us.
All right, let's start at the bottom of the chart. See how over those 3 days the price was just stuck in a really tight range? Now look left at the VAP histogram. You can see a huge concentration of volume was exchanged right there. This built a massive, really dense platform of support. It's like a concrete foundation.
Now, as the price starts to move up, look at how the VIP bars in the middle get much, much shorter.
What does that mean? It means the market just sliced through these prices really quickly, without a lot of trading, without a lot of agreement. We call these low volume nodes, and they are super weak zones. If the price were to fall, it could drop through here like a rock, because almost nobody established a position there to defend it.
Okay, now this is where it gets really interesting. Look at the top. Do you see that massive VAT bar? An absolutely extreme amount of volume was traded in that little price zone in just one day. But, and here's the alarm bell, despite all that frantic activity, the price isn't going any higher, it's just churning. That is a huge warning sign that an equal and opposite force, heavy selling, is meeting those buyers and absorbing every bit of their demand.
And the result? Well, it's pretty much exactly what you'd predict. All of that volume churning at the top was a crystal clear signal of weakness. The sellers completely overwhelmed the buyers, and the price just fell off a cliff. The VAP histogram gave us a clear, visual warning of that drop before it ever happened.
So, that Microsoft example just brilliantly illustrates how powerful this tool really is. Let's quickly break down how you can use this to get a new edge in your own trading.
And you know, this whole idea isn't unique to Microsoft. It's a universal market dynamic. Just look at these other two examples. On the left, you've got Alcoa. See that massive high volume area at the top? That became a powerful resistance ceiling. It stopped the rally cold every single time the price tried to push through. And now on the right, look at Procter & Gamble. It built this huge support floor, a super dense area of volume where you can tell buyers were just accumulating shares. That became the launchpad for a major breakout higher. It's the same tool, telling different stories, but with the same universal patterns.
So here's really the bottom line. VAPE helps you see where the real market battles are being fought. You can clearly mark key support and resistance levels. It gives you way more confidence to trade breakouts from these strong volume zones. And it helps you analyze future risk by showing you exactly where the price is likely to get stuck or find a helping hand.
You know, one analyst put it perfectly. They said VBAP gives us a visual representation of these areas on the chart through the prism of volume. The main thing to remember is that you're replacing guesswork with a clear, data-driven picture of the market structure.
So I'll just leave you with this thought. For years, these price barriers have been totally invisible to most traders who are just using standard tools. But now that you know how to see them, what new stories are your charts going to start telling you?
All right, in this explainer, we're going to unlock a really powerful technique for seeing what's actually going on inside the market. It's called volume price analysis, and it reveals the real story behind the price movements you see on any chart. So let's get right into it.
You know, you look at a price chart, you see the ups, you see the downs, the trends. It tells us what happened. But does it really tell us the why? There's this whole hidden dimension, a clue that reveals the real strength or weakness behind every single move. And that is the missing piece of the puzzle we're going to find today.
And that solution is volume price analysis, or VPA for short. Now think of this less like some magic cure-all indicator and more like, well, a way of thinking. It's all about looking at the relationship between the price and the volume to figure out what the big players, the smart money, are really up to. This slide just simplifies the core idea perfectly. I want you to think of it like this. Price shows you the result, what happened. But the volume shows you the effort that went into it. So if you see a massive effort, right, huge volume, but you only get a tiny result in the price, well, something's not right. VPA is all about spotting these little inconsistencies.
Okay, enough theory. Let's get practical. First up, we're going to look at how VPA helps us spot the signals of real, genuine market strength. And it all comes down to one simple idea: validation.
So here it is, the core rule. For any price move to be considered legit, it absolutely has to be backed by healthy, rising trading volume. When you see price and volume moving together like that, in harmony, that shows real conviction. It's telling you the big money is participating and actually driving the move.
And this chart shows that principle in action. Just focus your eyes on that spot labeled Breakout High Volume. You see the price pushing up to a new high, and right below it, look at that volume bar. It's way taller than the ones before it. That's your confirmation. That tells you this isn't some fake out, it's a breakout with real power behind it.
Now, VPA also gives us some amazing clues when a market is falling. A key signal you want to look for is something called stopping volume. This happens when you see a huge spike in volume during a price drop, but the price itself, it barely moves any lower. It's another one of those anomalies. So what's really happening there?
Let's look at the same chart again. Find the stopping volume candle. The price tried to fall, right? But notice how crazy high the volume bar is for such a tiny price move. This tells us that even though there was a ton of selling going on, an even greater amount of buying stepped in to absorb all that pressure. It literally stopped the decline in its tracks.
Okay, now for the flip side. Just as VPA can signal strength, it is incredibly powerful for spotting weakness. It's like having these flashing warning signs that a trend is running out of gas and is probably about to reverse.
This is one of the most important signals in VPA, so really lock this one in. If the price is climbing higher and higher, but the volume is actually getting lower, you have to stop and ask yourself, who is actually pushing this price up? This kind of split, this divergence, it suggests the move is weak, it doesn't have professional support, and it's super vulnerable to a reversal. Let's look at a real example here. See where the chart marks the first signal of weakness? The price pushes up to a new high, but look at the volume underneath. It's falling off. It's not confirming the move. The price tries again, but each new little peak has even lower volume. You can see the effort is just dying out, which leads to a, well, pretty predictable reversal. Okay, here's another huge red flag. You see ultra-high volume, just massive activity, but the price goes nowhere. It's just churning. This is often a sign of what's called distribution. It basically means the informed insiders are quietly selling off their huge positions to all the enthusiastic retail buyers who are piling in right at the top.
Just look closely at this chart. You see those three enormous red volume bars right at the very top of the trend? I mean, despite all that trading, all that activity, the price itself is just stalling out. It can't go higher. This tells us supply is just overwhelming demand. For every eager buyer, there was a professional seller waiting. The buying pressure is completely exhausted.
And this brings us to what might be the most fascinating part of all, spotting the traps. Because let's be honest, markets aren't always straightforward. Sometimes moves are specifically designed to trick retail traders. And VPA is the tool that lets you see these insider games for what they really are.
This quote just hits on such a key idea. The market open is emotional, it's volatile, and that makes it the perfect time for professionals to create these tricky, deceptive moves. But no matter how clever the trap is, they always, and I mean always, leave their fingerprints behind in the volume data.
So here's what that trap looks like in the wild. The market opens and the price just shoots higher. An amateur trader sees this, they get that fear of missing out, and they jump right in. But the VPA trader, they immediately look down at the volume and see it's really low. And that's the red flag. A real, genuine move needs high volume. This is a classic trap.
And this slide just makes the point perfectly with a direct comparison. On the left, you've got that low volume trap move we just talked about. Now look to the right. Here, the market also gaps up, but this time it's on strong, high volume. One is a deception. The other is a genuine signal. You see? Volume is the lie detector.
So we've seen the practical signals, strength, weakness, traps. But successfully applying VPA isn't just about memorizing a bunch of patterns. As this section highlights, trading is really an art, not a science, and it definitely requires the right kind of mindset.
I love this analogy of an oil tanker. It's just perfect. When you spot stopping volume or a sign of weakness, the market isn't going to turn on a dime. A major trend has a ton of momentum. It takes time to slow down, to stop, and then to turn around. And this is where patience becomes your absolute greatest asset as a trader.
So it really all boils down to two keys for using VPA effectively. First, taking the correct action. That means basing your decisions on the logic of VPA, not on fear or greed. And second, patience. Waiting for the price to actually confirm what the volume is telling you. Don't jump the gun. So why does all of this work? Well, ultimately, it's because these charts aren't just lines. They are the collective footprint of human psychology. VPA is so powerful because it helps us decode the fear and the greed that's driving the market. It transforms a seemingly random chart into a logical story of effort versus result. And that, my friends, is a story worth learning to read.
You ever stare at a financial chart and it just looks like a bunch of random noise? Totally unpredictable, right? Well, what if I told you that it's not random at all? Not even close. See, beneath all that chaos, the market is actually telling a story. It has its own hidden logic. And the secret to cracking it? Well, it all comes down to reading the odds.
I think this quote just nails it.
This isn't about getting lucky or trying to guess. It's about figuring out the probabilities. The market, just like a battlefield, gives you these little clues, these hints about what's probably going to happen next. So, how do you actually spot them?
And that's really the big question, isn't it? How do you get ahead of the game and see where the market is leaning before everyone else does? Well, believe it or not, the answer isn't some super complex algorithm. It's actually right there on your screen, hiding in plain sight.
This is it. This is the core idea. It's the relationship between what the price is doing and how much trading volume is actually pushing that move. This is the foundation of something called volume price analysis, or VPA. Think of it as the language the market speaks. And today, we're going to learn the basics of that language.
So where do the really big, explosive market moves come from? Well, a lot of the time, they start in these quiet, almost boring-looking periods. The source material has a great name for it, the spawning ground of trends. And that brings us to our first huge concept, price congestion.
Now, here's what's so important to get. When you see a market moving sideways like this, it's not just doing nothing. It's building up energy. It's a preparation phase. And if you can learn to spot this, you have a massive advantage, because you can plan for a move with really low risk before the rest of the herd jumps in.
And here's a perfect example. Take a look at this 15-minute chart for the British pound versus the US dollar. You can see it clear as day. The price is just bouncing around between a solid floor of support down below and a ceiling of resistance up top. It's stuck in this channel, just coiling up, building energy.
Okay, but here's the really interesting part. What's the volume doing during this whole sideways dance? It's low. And that low volume is a huge clue. It's telling you that the insiders, the big banks, the major players, they're not in the game yet. They are, as the source puts it, sitting on their hands, just waiting for the right catalyst.
I just love this analogy. It's so vivid. Imagine salmon gathering in a calm pool, just resting and building up their strength before they make that powerful surge upstream. That is exactly what's happening here. This quiet phase, it's where the next big trend is about to be born.
Okay, so understanding congestion helps us figure out why a move might be on the horizon. But to really get the full picture, we need some perspective. We need to know where we are in the grand scheme of things. And that means we have to stop looking at the market like it's flat.
Right. If you're just staring at one chart on one single time frame, it's like looking at a flat photograph. Sure, you can see what's happening in that one instant, but you're totally missing the depth, the context, and most importantly, the dominant underlying trend.
And this is where the telescope analogy from our source comes in, and it's brilliant. It's all about using multiple time frames to first zoom out and see the big picture, and then zoom right back in to catch the tiny details. This gives you a powerful three-dimensional view of what's really going on.
Just look at this. It's fascinating. Up top on the 30-minute chart, you just see one candle, what traders call a shooting star, which signals weakness. But look down at the 15-minute chart. That same period is made of two separate candles. And the 5-minute chart, it's 6 candles. You see? Each chart is a piece of the same puzzle. Put them together and you get the whole story. This is so crucial for not getting faked out by a small move on a fast chart that's actually going against the real trend.
So how do new trends actually get started? The source compares it to dropping a pebble in a pond. The first sign of a real change, that's the pebble, it hits your fastest chart. If it's legit, it creates ripples that spread out to your main, medium-term chart. And finally, if it has real power, it becomes a full-blown wave on your slowest, dominant chart. That's when you know the trend is confirmed.
So we've got congestion, we've got multiple time frames. The final piece of the puzzle is learning to spot specific patterns on the chart. Think of these as visual shortcuts that tell you at a glance what the market is feeling.
First up, the falling triangle. See how the market keeps hitting that flat floor of support? But notice the rallies. Each one is a little bit weaker than the last one. You get these lower highs. That's a classic sign that the sellers are getting more and more aggressive. They're slowly starting to take control.
And on the flip side, you have the rising triangle. This time, the market is bumping its head against a flat ceiling of resistance. But look at where the price finds support on the pullbacks. Each time, buyers are stepping in at a higher price, creating a series of higher lows. That tells you the bulls are building momentum, and a breakout to the upside is getting more and more likely.
Now this one's the pennant. Look at how the highs are getting lower, and at the same time, the lows are getting higher. The price is getting squeezed into this tiny little point. The source calls this a coiled spring, and that's exactly what it is. A ton of tension is building up,
and you can be almost certain it's going to lead to a huge, explosive move. The only catch? You don't know which direction until it finally breaks.
And finally, we have these two powerful reversal patterns. On the left, a triple top. The market tries to break through a resistance level 1, 2, 3 times and fails every single time. That's a huge red flag that a top might be in. And on the right, you've got its mirror image, the triple bottom. Sellers try to push the price down through a support level 3 times and can't do it. It's a powerful signal that buyers are drawing a line in the sand.
Okay, we've gone through the 3 key layers of analysis from the source material: congestion, multiple time frames, and chart patterns. So how do we actually put all of this together into something we can use?
All right, let's tie this all together. Think of it like a simple 3-part checklist for any potential trade. First, you identify that congestion phase and look at the volume. That's your why. Why is the market even preparing to move? Second, you zoom out with multiple time frames. That's your where. Where does this potential move fit into the bigger trend? And finally, you spot those specific chart patterns. That's your win, your signal for when to actually get in or out. Why, where, and when. Simple as that.
Now let's be really clear about something. This isn't some magic get-rich-quick system. The source is very direct on this point. Learning to read a chart is a skill. And just like any other skill, whether it's playing the guitar or learning a sport, it takes time and a lot of dedicated practice to get good at it. But the good news is, it absolutely is a skill that can be learned.
At the end of the day, every chart, every single price bar, every tick of volume is part of a bigger story that the market is telling. The ideas we've talked about today, well, they're the grammar and the vocabulary of that story. The only question left is, are you ready to start listening?
Welcome to The Explainer. Today, we're going to move beyond the standard charts we all know. We're going to explore 4 really innovative ways to visualize the relationship between trading volume and price. This idea, and it's a powerful one, comes from Richard Arms. He developed a pretty unique charting technique, and what he's doing here is challenging something we all take for granted on most charts, that rigid, man-made concept of time. So, what if we just stopped measuring the market in minutes and hours? What if the chart itself could show us the real rhythm of activity? Well, let's dive into an approach that does exactly that. It puts volume right at the heart of the chart. Okay, so our first technique is called equivolume, and it's a radical redesign, for sure. It literally replaces the time-based x-axis with volume. This gives us, a much purer look at the activity that's actually driving the price. Think about it like this. Instead of time just ticking along evenly at the bottom of your screen, the chart itself breathes. It expands when there's a lot of trading, and it contracts when things are quiet. The focus shifts completely, right? It's all about the relationship between price and the volume that made it happen. So instead of your usual candlesticks, you get these boxes. The height of the box is pretty simple. That's just your price range, the high to the low for that period. But the width, that's where it gets interesting. The width represents the total volume. So every single box is telling you a unique story. And this is the really cool part. The shape of the box tells you everything you need to know about the market dynamics. See a tall, narrow box? That means you got a big price move, but on really low volume. That's a red flag, right? It's an anomaly because there's no real conviction behind the move. Now, what about a short, wide box? That's the opposite. Tons of volume, but the price barely moved. That's a classic stalemate. Buyers and sellers are just slugging it out. And then you have the big one, a box that's both wide and tall. That's what they call a power box. That signals a potential breakout where you have high volume and a big price move all working together. That's powerful stuff. Okay, but there's a problem, right? The source material points out a pretty big drawback. If you get rid of the time axis, it's really hard to tell how long a market has been going sideways, how long it's been consolidating. And if you follow guys like Wyckoff, you know that the length of that consolidation, the cause, is super important for predicting how strong the next trend, the effect, is going to be. So that begs the question, doesn't it? Is there a way to get the best of both worlds? What if we could combine that awesome visual power of equivolume with the essential data we get from a traditional chart? What would something like that even look like? Well, that brings us to our next technique, candle volume charts. And this is a hybrid approach that tries to do exactly that, give traders the best of both worlds. The concept here is actually pretty simple. You take that main idea from equivolume, the variable width, and you just apply it to a normal candlestick. So the fatter the candle, the higher the volume. And the best part, you get to keep your familiar time-based x-axis. And this visual just nails the difference, doesn't it? Over on the left, you've got those pure equivolume boxes. But on the right, you see the candle volume chart. It brings back the wicks, it brings back the candle bodies, it reintroduces all that crucial high, low, open and close data that traders are so used to looking at. All right, so let's peel back another layer of the onion here. So far, we've seen how much volume there is. But what if we could actually see who's in control? The buyers or the sellers?
And that, my friends, is where delta volume comes in. See, total volume just tells you there was a lot of activity. But delta dissects it. It shows you the net difference between the aggressive buyers hitting the ask price and the aggressive sellers hitting the bid price. It's all about figuring out who won the battle inside every single bar.
So what you're usually going to see is a histogram right below the main price chart. If the bars pop up above the zero line, that's net buying pressure. If they drop below the line, that's net selling pressure. It just gives you this super clear bar-by-bar picture of who's being more aggressive in the market. And the way it's calculated is conceptually pretty simple. You just take all the contracts that were bought at the ask price, and you subtract all the contracts that were sold at the bid price. That result is your delta. It's the net difference that tells you, straight up, who won the fight inside that one candle. Now, building on that idea is something called cumulative delta. So instead of the count resetting with every new bar, this one keeps a running total of all the buying and selling pressure all session long. This gives you a much bigger picture, right? You can see who's really been dominating the market for the entire day. So what's the big takeaway from all this? Well, the goal isn't to find the one single best chart out there. It's about building a toolkit, right? It's about having different lenses you can use, where each one reveals something unique about what the market's doing. So we've looked at 4 really distinct lenses today. You've got equivolume, which just gets rid of time completely to focus on effort versus result. Then candle volume, which brings time and our familiar candlestick patterns back into a volume-weighted view. And finally, delta and cumulative delta. They're the ones that peel back the curtain and show us that hidden battle between the buyers and sellers. And ultimately, the evolution of these tools really highlights a key idea. The core principles of the market, supply and demand, they're timeless. They don't change. But our ability to see them, to visualize and interpret what's happening, that's constantly advancing. Which, leaves us with a pretty fascinating question to think about for the future. Look, every trader wants to hit that winning trade, right? But what's the real risk you're taking? Is it high? Is it low? Honestly, figuring that out, that's what separates the pros from everyone else. So in this explainer, we're going to build a framework to help you see the complete picture of what the market is really thinking. You gotta love this quote from the legendary trader Jesse Livermore. It just hits the nail on the head. The market is basically a master magician, It's designed to fool you, to make you feel super confident right before it yanks the rug from under you. And that really is the million-dollar question, isn't it? Well, the answer, surprisingly, isn't finding some magic indicator or a secret formula. It's about completely changing the way you look at the market. It's about stopping, looking at one tiny piece of the puzzle and starting to see the entire board. And that brings us right to what we call the trader's dilemma. It's this really common fundamental mistake in how we approach the market, and it almost guarantees you're going to get caught on the wrong side of a trade. So let's break it down. Okay, so here it is. This is probably the single biggest reason so many traders fail. They're just sitting there staring at one chart, one currency pair, one stock, totally fixated, and then they wonder why it moved against them. They're trading in a vacuum, completely blind to the huge currents of money flowing through the broader market that are actually pulling the strings. And as if that wasn't hard enough, the entire game has changed in recent years. The old playbook? Just toss it out. We're not in a world anymore where you can just look at interest rates to figure out a currency. Now you've got governments playing politics with their money, central banks printing trillions, and all these things creating weird distortions that a simple, one-dimensional analysis will totally miss. So if the old way of looking at the market is basically broken, what's the solution? Well, if the old one-dimensional view isn't cutting it, we need to add more dimensions to our analysis. We need a way to see the full picture and understand the real story the market is telling us. So this new approach, it's really built on 3 key pillars. We've got technical analysis, that's your charts and patterns. Then there's fundamental analysis, that's all the economic data. But the third one, the one that most people completely overlook, is relational analysis. And that is the key. It's all about seeing how different markets are connected by tracking the flow of money between them. And that's what we're going to focus on today. And I absolutely love this analogy of the three-stranded rope. Think about it. One single strand, pretty weak. You could probably snap it. But when you weave those three strands together, the rope becomes incredibly strong, way, way stronger than just adding up the strength of each strand. And that's exactly how you build a solid, unshakable view of market risk. So let's dive into this idea of relational analysis. At its core, it's really about understanding the four major capital markets that the entire global financial system is built on. Because if you can get a handle on how money flows between these four, you're going to start seeing things so much more clearly. And here they are, the four big ones: bonds, commodities, equities, and currencies. Think about it. Every single dollar, yen, or euro invested anywhere in the world, whether it's to try and grow wealth or just protect it, involves moving money between these four markets. They're all deeply, deeply connected. All right, now for the fun part. Let's break down each of these four markets one by one. We're going to decode the specific signals they're sending out about risk, about fear, and about optimism, so you can actually start piecing together that bigger picture. Let's start with bonds. This is the market most traders just flat out ignore, because it seems boring or complicated. But really, it's super simple. A bond is just an IOU, a loan, nothing more. But this market is gigantic. It dwarfs even the Forex market. And it is the single clearest indicator of what the big money is feeling. It's the ultimate safe haven. This slide just perfectly lays out the fundamental tug of war in the market. On one side, you have bonds, safe, stable, low risk. On the other side, you have equities or stocks, much riskier, volatile, but with that potential for a much higher return. So when investors get scared, where does the money go? It floods into the safety of bonds. And when they're feeling optimistic, it rushes right back into equities, chasing those bigger gains. All right, next up, commodities. And these are really interesting because they act as a bridge between all that paper money flying around and the actual, physical, real-world economy. We're talking about tangible stuff like oil, copper, corn, and just think about how they're all connected. If oil prices spike, that's not just a commodity story. It hurts airline stocks, which hits the equity market, and it could even boost the currencies of oil-producing countries. See? That's relational analysis right there. And finally, we get to currencies. This is the big one. Think of the currency market as the central hub, like the main train station that everything else has to pass through. Every single transaction, whether you're buying a German stock or a barrel of Saudi oil, eventually has to flow through the currency market. It's the most liquid, it's the most complex, and it's where all these different risk appetites come together. Okay, so now we know the four pillars. Let's put this all together and see how you can actually start using this framework to read the story of global money flow as it's happening. So let's kick things off with a classic risk-off scenario. Let's say there's some big, scary geopolitical news or some terrible economic data comes out. All of a sudden, global fear just spikes. So what does the money do? Well, suddenly, the goal isn't about getting rich anymore. It's about not getting poor. The number one priority for big investors becomes capital preservation. They're not trying to make money, they are desperately trying not to lose it. So they go looking for a safe haven. And this is what happens. You see this massive tidal wave of money pouring out of risky stuff like the stock market and flooding into the safe harbor of government bonds. It is the classic flight to safety, and you can literally watch it happen across these capital markets. Now, let's flip the scripts. Imagine the opposite. The sun is shining, economic news is great, companies are reporting huge profits, and everyone's feeling confident. We call this a risk-on environment. In this kind of environment, that motivation totally flips. Hiding your money in a low-yield bond, that just feels like you're missing out on the party, right? So investors are much more willing to take on risk because they believe the potential reward is totally worth it. So what happens? You see the exact opposite flow. Money starts leaving the safety of bonds and jumps right back into riskier assets like the stock market, chasing after those higher returns. This is what a healthy, optimistic market looks like, and the money flow confirms it. And this quote really sums it all up, doesn't it? No market is an island. They are all connected by this constant ebb and flow of capital. And once you learn to actually see that flow, you stop getting faked out by the noise on a single chart, and you start to understand the real story. So I'm going to leave you with this one question. The next time you're staring at a chart, about to click that buy or sell button, are you going to keep trading in that vacuum, just looking at one isolated little piece of the puzzle? Or are you going to take a step back, look at the entire map of money flow, and finally see the full picture? All right, let's talk about a corner of the financial world that most people, even a lot of traders, find kind of intimidating: the bond market. But here's the thing, it's where the really smart money talks. And by the end of this, you're going to understand its secret language. You know, the political strategist James Carville said this, and he was not kidding. The bond market is an absolute giant. It's so powerful that its subtle shifts can literally force governments and central banks to completely change their plans. It's the force that decides how much it costs for anyone, from Apple to America, to borrow money. But what if all that intimidation could be turned into information? What if you could listen in on what the bond market is saying? Well, that's exactly what we're going to do. We're going to crack the code on this thing so you can see the powerful signals it's sending out every single day. So what is this market, really? When you strip it all down, it's actually incredibly simple. It's just the market for loans, for debt. When a government or a big company needs to borrow money, they issue bonds. And by just watching how those bonds trade, we get this amazingly clear picture of what the market is really thinking about risk. Just think of a bond as a fancy IOU, one that you can buy and sell. A company needs cash, right? So it sells you a bond. Boom, you've just loaned them money. They promise to pay you back in, let's say, 10 years, and they'll pay you interest along the way. But the really crucial part is that this IOU, it's tradable. It has a price that goes up and down. Okay, now listen up, because this next part, this is the absolute secret. This is the decoder ring for speaking the bond market's language. It all comes down to this one simple relationship between a bond's price and something we call its yield. The yield is, well, it's just the return you're getting on your investment. But you don't need a finance degree to get this. In fact, forget the formulas. Let's use a super simple analogy that'll make this click instantly. Okay, picture this. You're a real estate investor. You find two houses, totally identical, and you know for a fact that both of them will bring in $6,000 a year in rent. The only difference? House A costs 75 grand. House B? It's only 50 grand. Which one are you buying? It's kind of a no-brainer, right? Well, let's just do the quick math. For House A, you take your $6,000 in rent, you divide it by that $75,000 price tag, and you get a rental yield of 8%. Hey, not bad at all. But now, look at House B. You've got that same $6,000 in rent, but this time you divide it by that much cheaper price of $50,000. All of a sudden, your yield jumps to 12%. Same house, same rent, but because the price was lower, your return, your yield, is way higher. It's obviously the better deal. And that right there, that is the fundamental law of the bond market. When a bond's price goes down, its yield goes up. When its price goes up, its yield goes down. This inverse relationship, this seesaw, is everything. Remember that. Now, just when traders had this all figured out and were using it to make great calls, the 2008 financial crisis hits, and the entire game just changed. A massive plot twist got thrown into the mix, and it made reading the bond market a whole lot trickier. You see, the financial system nearly collapsed, and that forced central banks, especially the U.S. Federal Reserve, to do some things that had never been done before. And in the process, they accidentally broke the most reliable risk gauge traders had. For decades, U.S. Treasury bonds were the gold standard. Their yields were seen as a pure, unpolluted signal of what the market was thinking. But then, quantitative easing, or QE, happened. To pump up the economy, the Fed basically started printing money to buy its own government's bonds, by the truckload. This created this huge artificial demand that messed with the prices and made the signal totally unreliable. So, what did the smart traders do? They adapted. They found a new benchmark, a market that the Fed wasn't messing with, the U.S. municipal bond market. These are bonds from states and cities. This gave them a much cleaner read on risk. But to see the bigger economic story, traders turned to another powerful tool, one that wasn't quite as affected by QE, and that's the yield curve. So beyond those day-to-day risk signals, the bond market has this incredible long-term forecasting tool. It's called the yield curve. And believe it or not, This one single chart tells a pretty compelling story about where the entire economy is likely headed. So the yield curve is simple. It just plots the yields of short-term bonds against the yields of long-term bonds. And its shape usually falls into one of 4 buckets. Each shape tells a totally unique story about our future. So first up, we've got the normal yield curve. This is the one you see most of the time. It slopes up gently, because, it makes sense. Investors demand a higher return for locking their money away for a longer time. When you see this, it's a sign of a healthy, stable, growing economy, business as usual. Then you've got the steep yield curve. This is what you see when the economy is about to put the pedal to the metal, usually right after a recession. Investors are expecting growth and inflation to come roaring back, so they demand a much higher yield for those long-term loans. This is a very, very bullish signal. And now for the most famous and most feared shape of them all, the inverted yield curve. This is when things get weird. Short-term yields are actually higher than long-term yields. This is a massive warning sign. It means investors are so nervous about the near future that they're all rushing to lock in today's long-term rates before they think everything goes south. This is the yield of fear, and it's predicted almost every single U.S. recession. And finally, we have the flat or humped curve. This shape is basically the market shrugging its shoulders. It signals a ton of uncertainty. The market isn't sure what's coming next. You often see this when the economy is starting to slow down, sometimes right before it flips and inverts. Think of it as an early warning light on the dashboard. Okay, so we've learned the language of price and yield. We've seen how the curve can predict the future. So what? How do we actually use this? Well, let's connect the dots and see how money flowing in and out of bonds can tip you off to big moves in things like currencies.
Think of it like a giant seesaw of money. When markets get scared, we call that risk off. Investors dump risky stuff and they pile into the safety of government bonds. All that buying pushes bond prices up, which, as we learned, pushes their yields down. And this rush into safety also makes safe haven currencies like the US dollar or the Japanese yen get stronger. Now, when markets are feeling confident, risk on, the seesaw tips the other way. Money flows out of safe bonds and into things like stocks. Bond prices fall and their yields rise. This flow boosts the riskier currencies like the Australian or New Zealand dollar. So by watching bond yields, you're not just looking at some boring debt market. You're looking at a real-time gauge of global fear and greed. You can now speak the market's secret language. So the only question is, what's it going to tell you about the next big move?
So, let's talk about commodities. I know what you might be thinking. Raw materials, right? Stuff we dig out of the ground. And yeah, that's part of it. But there's so much more than that. They are, in fact, a window, a shop window, really, that lets us peer directly into the health of the entire global economy.
You know, the famous economist John Maynard Keynes once said something really profound. He said that money is the link between our present and our future. But for that link to mean anything, for it to hold up, the abstract world of money has to connect with the real, physical world of today. And guess where that connection happens? Right in the commodities market. And that's the big idea we're going to run with today. Think of commodities as the shop window of the world. It is the one place where all the numbers on a screen, all the abstract financial stuff, has to come face to face with real, tangible, physical goods. All right, so let's dive in. First up, what exactly makes this marketplace so unique, so powerful?
Okay, simply put, the commodities market is where the financial world has to get its hands dirty. It's pretty much the only place where money is swapped directly for physical stuff. We're talking about the link between the digits in a bank account and the actual steel that goes into a skyscraper, or the wheat that makes our bread. Because of that, it's an absolutely critical barometer for how the whole global economy is doing.
So how did this whole thing even get started? Well, it was born from a really simple problem. Picture this. You're a farmer in the U.S. Midwest. You've got crops growing, but you have no idea what price you'll get for them in a few months. That's a ton of uncertainty, right? So they came up with a brilliant solution, the futures contract. It's just an agreement to lock in a price today for something you'll deliver in the future. Boom! Instant stability for their business.
And that simple idea? It just exploded. I mean, it went from local farmers markets to the crazy shouting pits of the Chicago exchanges. You've seen the movies. And now, it's all digital. 24-hour global electronic trading. And that transformation, it turned basic physical goods into a massively powerful financial asset class all on its own.
Okay, enough theory. Let's see how this plays out in the real world.
For our first case study, we're going to look at the super-sensitive, often dramatic relationship between two giants, gold and the US dollar.
So in one corner, you've got gold. It's the ultimate hard asset, the classic thing you run to when you're worried about inflation. And in the other corner, you have the US dollar, the world's main currency, the place everyone runs to when things get shaky. So when investors get nervous, they're often stuck with the choice. Which one do you trust more?
And this is their classic dance. It's like a seesaw. The relationship is typically inverse. Here's why. Gold is priced in dollars, so if the dollar gets weaker, it's suddenly cheaper for someone in, say, Europe or Japan to buy gold. That extra demand pushes the price of gold up. So one goes up, the other goes down. Simple, right?
But, and this is the really important part, the most interesting moments, the times that tell you the real story, are when that simple seesaw relationship breaks. So what on earth is going on then? Okay, take a look at this. This is that breakdown in action. Zero in on that period between February and September of 2010. You see it? For months, both gold and the US dollar started rising together. That reliable old seesaw, gone. So what was going on?
Let's walk through it. First, you had a massive debt crisis brewing in Europe. This totally spooked investors, and they panicked. They ran for safety, but they ran into both the dollar and gold. Then the US Federal Reserve signals it's about to start quantitative easing. In simple terms, printing more money. Well, that raises fears that the dollar itself will be devalued. So now investors have a new choice to make. And what did they decide? They decided gold was now the safer of the two safe havens. Money poured into the metal, and just like that, the old inverse relationship snapped right back into place.
All right, let's switch gears and talk about oil, because black gold isn't just another commodity trading on its financial merits. Oh no, it is a hugely powerful geopolitical tool.
First, a few key things you gotta know. Number one, for oil reserves, Saudi Arabia. No surprise. But number two might surprise you. It's Canada. Also, and this is huge, oil is not a free market. Not really. Supply is mostly controlled by the OPEC cartel. And crucially, all of it is priced in US dollars. When oil prices go up, inflation goes up. And that forces central banks around the world to sit up and pay attention.
So, remember how Canada is an energy superpower? Well, its economy is tied at the hip to its oil exports. It's pretty simple. When the price of oil goes up, the Canadian dollar, which traders call the loonie, gets stronger. That means the US dollar versus the Canadian dollar currency pair goes down. So we have another one of those powerful inverse relationships to watch.
Now, check this out, because this is where it gets really interesting. That inverse relationship on the left becomes a direct relationship on the right. Why? Well, think about it. Japan has to import pretty much every drop of oil it uses. So when oil prices spike, the currency of an oil-rich country like Canada naturally gets stronger against the currency of an oil-poor country like Japan. It's a tale of two economies.
All right, for our last case study, it's time for an economic checkup, and we're going to see a very special physician. I'm talking about Dr. Copper.
Now, why the nickname? Why Dr. Copper?
Well, it's because this metal supposedly has a PhD in economics, and the reason is simple. Copper is used in everything. We're talking construction, manufacturing, all our electronics, it's everywhere. So because its use is so widespread, demand for copper is seen as a fantastic leading indicator for the health of the whole global economy. If people are buying copper, it means they're building stuff. The economy's growing.
And here's the doctor's diagnosis, right on the chart. Look at that. There is a remarkably tight, positive correlation between the price of copper and the S&P 500 stock index. Traders watch this relationship like a hawk because it suggests that what's happening in the real, physical economy often leads what happens in the financial markets. But like any good diagnosis, there's a complication. A huge one, actually. And its name is China. China's appetite for copper is just off the charts. It's so massive. For both its incredible infrastructure projects and as a physical hedge against a weak dollar, that it can actually distort the signal Dr. Copper is trying to send. China's relentless buying can sometimes mask slowdowns happening everywhere else in the world, making the doctor's diagnosis a lot trickier to read these days. So, after all that, let's bring it all together. When we're looking into that shop window of the world, what are the key signals we should actually be watching for? Well, it really boils down to three main things. Number one, if you want to gauge global economic health, keep your eye on Dr. Copper. Number two, if you're looking for clues about where the US dollar is headed, you have to analyze that delicate dance between it and gold. And number three, to get a sense of the market's appetite for risk,
You watch where the money is flowing. Is it going into assets like oil and other commodities?
And that brings us to our final big thought. You see, for decades, these relationships we've talked about have been a pretty reliable guide to the global economy. But now, as a superpower like China fundamentally changes the game of supply and demand, we have to ask ourselves, will the old rules of the world shop window still apply?
All right, let's get right into it. We're about to pull back the curtain on a hugely powerful but often ignored relationship in the financial world. I'm talking about the deep connection between stocks and currencies. What if I told you the biggest clue for your next Forex trade isn't even on your currency chart? So, I've got to ask you, straight up, when you're looking at a currency pair, are you really, truly sure you're watching the right market? Because the signals you might be missing from somewhere else, well, they could literally be the difference between a winning and a losing trade. And this quote from Anna Coulling just hits the nail on the head. So many traders have tunnel vision, you know? They're completely oblivious to these massive currents of money flowing between markets that are directly related. Well, today, we're taking those blinders off. So our first move is to start looking beyond that single screen. We've got to break the habit of just staring at one chart, one instrument, and start seeing the whole interconnected financial landscape. I mean, think about it, right? If you're trading the Japanese yen, doesn't it make a ton of sense to know what's happening with Japanese stocks? If investors in Japan are selling their yen to pour money into the Nikkei, that is a massive piece of the puzzle you absolutely need to have. That's a fundamental flow of capital that's going to hit the currency you're trading. And that brings us to the next really big idea. Equity markets, or stock markets, are basically the world's #1 barometer for risk. They tell us, right now, in real time, whether big money is feeling brave or feeling scared. It all boils down to this concept called risk sentiment. It's pretty much just the overall mood of investors. When they're feeling confident and optimistic about the economy, their appetite for risk is high. And where do they put their money when they're feeling brave? They pour it into what we call risk assets. And the main one, by far, is equities. So this creates two basic modes for the market: risk on and risk off. When it's risk on, the party's started. Stocks are climbing and money is flowing out of boring, safe things like government bonds and into equities. But when it's risk off, fear kicks in. Stocks start to fall, and that money flees from equities and rushes back into the safety of bonds and so-called safe haven currencies. Honestly, the best way to picture this whole thing is like a seesaw. You've got high-risk stocks on one side and low-risk bonds on the other. As investors pile onto one side, making it go up, the other side naturally goes down. It's all about that flow of money, chasing either big returns or just safety. Okay, but, and this is a big but, it's not quite that simple. Not all the signals you see coming from the stock market are actually telling you the truth. So the real trick is knowing how to read the right signals and how to filter out all the noise. You see it every single day on the news, right? They love to shout about how certain stock indexes are doing. But are those numbers really giving you an accurate pulse of the economy? Or is it just a convenient headline? Let's just take the US market. It's the perfect example. The media obsesses over the Dow Jones, but the Dow only tracks 30 companies. 30! That's a tiny and, frankly, unrepresentative snapshot. The S&P 500, though, now we're talking. It tracks 500 diverse companies, giving you a much, much broader and more accurate picture of how the U.S. economy is really doing. So here you go. Here's your new cheat sheet. For the US, you watch the S&P 500. For the UK, forget the FTSE 100 everyone talks about. The FTSE 250 gives you a better read. For Japan, the Nikkei 225 is your go-to. And for Europe, the Euronext 100. These are the indices that show you what's actually happening under the hood. All right, so now we know what to watch. The next step is learning how to watch it. And this is where we get into the real secret weapon. It's not just about watching the price, it's about understanding the language of volume. So why is volume so critical? Here's why. Price can be nudged around. It can be manipulated in the short term. But volume, the sheer amount of buying and selling happening, that's the one thing the big players, the market makers, cannot hide. It's the truth serum of the market. It shows you their real commitment. And the technique for reading this is called volume price analysis, or VPA for short. All it really is looking at volume together with price. It's how you figure out if a big price move is the real deal or if it's just a fake out designed to trap unsuspecting traders. So principle number 1 is super simple. If you see price making a big move, up or down, and it's backed by a huge surge in volume, that's your confirmation. That means the market is fully behind this move. It's genuine, it's strong, it's a green light. Now, principle 2. This is a massive red flag. Let's say you see enormous volume, tons and tons of activity, but the price just isn't going anywhere. It's stalling out. That's a classic sign of exhaustion. It means that for all that effort, the momentum is dead, and a reversal is probably right around the corner. And the third principle is the trap. This is the one you have to watch out for. You see price suddenly shoot up or crash down, but you look at the volume and it's tiny. Be super careful. This is often a false move, a ghost move, designed to lure people in before the market yanks the rug out from under them. There's no real conviction there.
Okay, this is the moment. Let's put all the pieces together. How do we take this incredibly powerful analysis of the stock market and use it directly to make better currency trades?
Let's walk through a real-world example. Imagine some big U.S. economic news just dropped. You switch over to a chart of the S&P 500. Bam! You see a massive spike in volume, but the price, it's struggling. It barely moves up, and then it starts to drop. Your VPA alarm bells are ringing. You know that means weakness. The market's mood just soured. It's gone risk-off, and that is your cue. Now you can go look for money flowing into safe havens like the US dollar or the Japanese yen, and you can place your currency trade with so much more confidence. So what's the big takeaway here? It's that you now have a new and way more reliable compass for navigating the markets. It's about finally seeing how all these different pieces are connected. By keeping an eye on the right equity indices, and because of futures, you can pretty much watch them 24 hours a day, you have this constant live feed of market sentiment. It is an absolutely incredible advantage that you'd be surprised most Forex traders just completely ignore. At the end of the day, you've basically learned how to listen to the market's real story, not just the noise on the surface. You're not just a chart reader anymore. So the only question left isn't for me, it's for you. Now that you actually know how to listen, what are the markets truly telling you?
Let's be clear about something right up front. The Forex market, foreign exchange, it's not just about getting a good rate for your vacation money. No, it's a hidden battleground. It's where global power struggles play out every single second of every day. And we're not here to give you trading tips. We're here to pull back the curtain and show you who's really pulling the strings. So, ask yourself this. What if the rise and fall of the dollar, the euro, or the yuan wasn't just about simple supply and demand? What if it's actually about countries using their money as weapons in a silent, high-stakes global war? Well, that is exactly what we're going to dig into.
Here's the roadmap for how we're going to unpack this whole thing. First, we'll look at why Forex is so much more than just money. Then, we'll get into the architecture of the system, the dollar and the peg. After that, we'll pinpoint the one game-changing crisis that blew it all up and how that led to a new world order. And finally, we'll look ahead into a very, very unsettled future. So let's get right to it.
Okay, so part 1, more than just money.
You know, if you just glance at the currency markets, the movements can look totally random, almost chaotic. But trust me, underneath that chaos, there's a constant, strategic battle being waged.
That's because this isn't just some abstract economic market. It's the main arena where international politics and high finance collide. It's where the tension between two countries stops being rhetoric and starts becoming hard, cold numbers on a screen.
So why is it so wild and volatile? Well, for one, you've got governments and their central banks constantly jumping in and messing with things. And they are not playing for some global team. No way. It's all about national self-preservation. At the end of the day, every country looks out for number one. If a nation's economy depends on exports, you can bet its central bank will do whatever it takes to keep its currency weak, to make its goods cheaper, even if it hurts their so-called allies. This is the real battleground for trade wars.
Now, to really understand this power game, you have to know the rules. And in the world of currency, the entire system, the whole shebang, is built around two key things: the US dollar and a strategy that countries use called a currency peg.
Ever since the end of World War II, the US dollar has been the world's main reserve currency. It's the foundation, the linchpin that everything else is built on. You see, most major international trade, especially for critical stuff like oil, it's all priced in dollars. And that gives the United States an incredible, almost unfair amount of influence over the entire globe.
So how do other countries try to manage this? Well, a lot of them use a strategy called pegging. Basically, instead of letting their currency's value just float around based on market whims, they decide to lock it or peg it to a more stable currency. And 9 times out of 10, that's the US dollar. It means if the dollar goes up by 1%, their currency goes up by 1%. Simple, right? Well, here's the catch. There's always a catch. Pegging your currency gives you stability, which is fantastic for international trade. But the downside? Oh, it's huge. You lose control over your own economy. You've essentially handed over the keys to the U.S. Federal Reserve. If the Fed raises interest rates to cool down the American economy, your country has to follow suit, even if your economy is struggling and desperately needs a boost. You're no longer in the driver's seat.
And look, this is not a new idea. After World War II, the world tried this with the Bretton Woods Agreement, pegging all major currencies to gold. It failed. It collapsed spectacularly in the early 70s, and one key reason was that the peg exported inflation from the US to other countries. Now remember that detail because it's going to come back in a big way. Despite that massive failure, the world just swapped gold for the dollar and kept on pegging.
Which brings us to the moment the whole system just cracked. The 2007 financial crisis wasn't just a problem for Wall Street banks. It was the spark that lit the fuse on the modern currency wars.
To stop its own economy from completely melting down, the U.S. Federal Reserve started this massive, unprecedented program called quantitative easing, or QE. Put simply, they fired up the money printers and created trillions of new dollars. Now, this might have saved the U.S. economy, but it unleashed a tidal wave of instability that crashed right into the rest of the world.
And here is the trap. Think about it like a seesaw. When the U.S. printed all that money, it weakened the dollar, pushing its side of the seesaw down. Now, for countries like China, to keep that seesaw balanced, to maintain their currency peg, they had no choice but to print their own money to push their side down too. This flooded their economies with cash, basically importing America's inflation problem and trapping them in an absolutely impossible no-win situation.
So what happened next? Well, the fallout from the 2007 crisis and all that QE completely shattered the old way of doing things. It forced countries to pick a side, and clear battle lines started to get drawn across the globe. A new world order was taking shape. And you can really see three major factions emerging from the chaos. First, you've got the BRICS bloc. That's China, Russia, Brazil, and India. Their main goal? To build a whole new system that bypasses the US dollar altogether. Then you have the European bloc, just desperately trying to hold the Euro project together. And finally, you have the independents, countries like Japan and the UK, just trying to protect themselves while these two giants go at it.
Now remember that point about pegs always failing? Well, here is a truly startling fact. In the last 40 years, not a single major currency peg has ever survived. Every single one has collapsed.
So, with that in mind, what is the euro? It's the biggest, most ambitious currency peg in human history. It's an attempt to lock 17 different economies, with 17 completely different cultures and priorities, into one single currency. It's the exact same kind of system that history has shown us, time and time again, is doomed to fail.
The problem is just baked into its DNA. The source material had this brilliant analogy for it. Trying to make the euro work is like asking a natural spender, like Greece, and a natural saver, like Germany, to share a single bank account and just live together in perfect harmony. It's a political project that is trying to defy the laws of economic gravity. The real question isn't if it will face a massive crisis, but when.
And all of this brings us to our final section, the unsettled future. Because with all of these massive forces in motion, the rise of the BRICS, the incredible fragility of the euro, the slow weakening of the dollar, the very rules of money are being rewritten right before our eyes. Which leads us to the multi-trillion-dollar question. After decades and decades of dominance, is the US dollar's reign as the world's undisputed reserve currency finally actually coming to an end? There are a few different scenarios on the table. China, for its part, is pushing hard for a world that uses a basket of currencies, where its own yuan would obviously play a huge role. The IMF has even floated the idea of a synthetic global currency. But the reality check is this. Right now, today, there is no other single currency in the world that has the depth, the trust, or the sheer liquidity to take the dollar's place. Not yet, anyway. So, for the time being, the dollar is still the linchpin. It's been challenged, it's been weakened for sure, but it hasn't been replaced. For better or for worse, the entire global financial system still depends on it. The thing is, that foundation is looking shakier than it has in a very, very long time. You know, there's this famous quote from the legendary investor George Soros that just perfectly sums up the world we've been talking about. Markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected. That's the Forex market in a nutshell.
So, I'll leave you with this final thought. The game of global money is changing. The old rules are breaking down, and the world's most powerful nations are locked in this quiet, relentless struggle to right the nuance. The only question left is, what will those new rules be, and who is going to come out on top?
So where is the economy headed? I mean, that's the billion-dollar question, right? And look, while nobody has a crystal ball, there are clues hidden all around us, right in plain sight. Today, we're going to put on our detective hats and follow the trail left by two of the market's most unlikely but most reliable informants. How can we actually spot the big economic shifts, like a surge in inflation, before they start hitting our wallets? Well, the signs are all there. They're embedded in the daily hum of the global marketplace. We just need to know how to read them. So meet our investigative duo. On one side, you've got bonds. Think of them as the careful planner, always trying to calculate what the future holds. And on the other side, we've got commodities. They're our on-the-ground informant, telling us exactly what's happening right now. Now, they work differently, but when they start telling the same story, well, that's when we really need to pay attention. Okay, so how do we keep track of what our detectives are saying? We're going to use a simple tool, an economic compass. It's a great way to visualize the key forces that are pulling the economy in all these different directions. First up, our compass points north, towards inflation. And all this really means is that prices for, well, pretty much everything are going up, and each dollar you have buys a little bit less. This is the main thing we're trying to get ahead of. Pointing south, we have the US dollar, and this is so important because almost all global commodities, we're talking oil, corn, metals, you name it, are bought and sold in dollars. So when the dollar gets weaker, it just takes more of them to buy the same barrel of oil. That pushes prices up and points our compass needle straight north, towards inflation. Over to the east, we find our first detective, commodities. These are the basic raw materials that literally fuel our world. Their prices give us a live, real-time reading of what's happening with supply and demand in the economy right this second. And finally, pointing west is our second detective, bonds. The easiest way to think about them is just as loans. And the interest rate on those loans, what we call the yield, tells us what the market expects to happen with things like inflation way down the road. They are, in a sense, the market's weather forecast. All right, let's start digging into our first set of clues, the ones coming from commodities. Now, the prices of these raw materials can jump around a lot, so the real trick here is to separate the meaningful signals from all that background noise. You see, commodity prices can go up for a few different reasons. It might be a supply shock, like a bad harvest, or maybe the US dollar is just getting weaker. But the one signal we're really looking for is a genuine increase in demand. That tells us the economy is really humming, and that could mean inflation is just around the corner. And that's the million-dollar question, isn't it? When you see the price of something like crude oil shooting up, how can you possibly tell if it's just a short-term blip or the start of a real demand-driven trend? Well, lucky for us, the market has a kind of built-in lie detector. And we find this lie detector in what's called the futures market. Let's break this down. If the price for a barrel of oil today is higher than the price for delivery 6 months from now, that's a situation called backwardation. It basically suggests a short-term panic. Everyone needs it right now. But if the future price is higher than today's price, that's contango. And that's the market betting that demand is going to be even stronger down the line. That's our signal. So this is the key takeaway here. When a commodity market is in contango, our detective is telling us that the price hike is the real deal. It's driven by actual demand. And that's the first major clue we're looking for on the path to spotting inflation. Okay, so we've got our first clue. Commodity prices are rising because of real demand. Now, let's go check in with our second detective, the bond market, to see what it's forecasting for the future. The key signal to watch here is the bond yield, which is basically the interest rate you get for loaning out your money. And just think about it for a second. If you expect inflation to go up, you're not going to lend someone money for 10 years at a measly 2% return, right? Because your money will be worth less when you finally get it back. So to convince you, borrowers have to offer you a higher yield. So in a nutshell, it really is that simple. When you see bond yields climbing, our future-gazing detective is sending up a flare. It's signaling that the market is bracing itself for two things: higher inflation and the higher interest rates that central banks are going to use to fight it. And now for the main event. What happens when the clues from our two very different detectives, the here and now reactor and the what's next planner, start pointing in the exact same direction? Well, this is where we find the tipping point. And here it is, the big idea. When commodity prices are rising because of real demand, remember, that's contango, and at the same time, bond yields are also rising, it's an incredibly powerful combined signal. It's basically the market screaming that inflation is on its way.
But there's a fascinating little twist to all of this. You see, not all rising yields are seen as a bad thing. There seems to be this historical magic number for the 10-year U.S. Treasury bond yield that changes absolutely everything. And that number is 5%.
This is such a critical distinction. As long as that key bond yield is going up but stays below 5%, the market usually sees it as a good thing. It's a sign of a healthy, growing economy. But the second it crosses that 5% line, the whole mood changes. The market starts to worry that inflation is getting out of control, and that could force a major slowdown.
So why have we gone through all of this detective work? Because this isn't just some abstract economic theory. Understanding how this economic compass works can actually help you make sense of the headlines and what they might mean for interest rates, for your savings, and for your investments.
So let's boil it all down to the essentials. First, remember our two detectives. Commodities and bonds are your go-to indicators for inflation. Second, when they're both rising at the same time, that's a huge warning sign that higher interest rates could be on the horizon. And third, keep an eye on that 5% yield level. It's the tripwire where market optimism can flip to fear, just like that.
So there you have it. You now have the tools. You can look past the noise in the headlines and read the economic compass for yourself, which means the final question isn't for me to answer, it's for you. Based on what you're seeing out there today, where do you think that needle is pointing?
All right, let's get right into it. We're going to talk about something huge in the world of finance, a relationship that's super important, but honestly, most people don't quite get. I'm talking about the secret connection between stocks and bonds. So what if I told you there's a way to get an early warning signal, a heads up before the stock market takes a nosedive? A lot of pros believe that system is real, and it's not some complicated algorithm. Nope, it's hidden in plain sight, right inside the bond market.
Okay, so you've probably heard the basic story, right? It goes like this. When everyone's feeling good about the economy, they pile into stocks, looking for growth. That's what we call risk on. But the second things get scary, they dump those stocks and run for the safety of bonds. And that's risk off. It's like a simple seesaw. One goes up, the other goes down.
Here's a cool way to picture it. Think of a compass. You've got stocks or equities over in the east, that's your direction for growth. Then you have bonds in the west, that's safety. Pointing north is yield, which is just the reward you're getting. And south, well, that's where the danger is, risk. The whole market is kind of like a compass needle, just swinging back and forth between all these points based on what's happening. But, and this is the important part, that simple risk-on, risk-off story, it's not the whole story, not even close. The truth is, the way stocks and bonds relate to each other isn't set in stone. It actually changes, it morphs, depending on the economic season we're in. And that is where the really valuable signals are hiding. You see, to really get this, we have to stop saying the bond market like it's one single thing. It's not. We need to get specific. Are people buying short-term bonds that mature in a few months? Or are they locking their money away in long-term bonds for, say, 10 or 30 years? The answer to that question tells you a ton about what they think is coming down the road. So let's walk through a classic example. Picture this. Some bad economic news drops out of nowhere. The stock market freaks out and sells off. What do investors do? They panic, they sell their stocks, and they need a safe place to hide their money for a little while. So it all rushes into super short-term bonds like T-bills. And why short-term? Because they're betting this is just a quick storm that'll pass, not a full-blown hurricane. All right, now let's flip that script completely. Imagine the economy is doing great. Everything's growing, stocks are in a nice, steady bull market. But look closer. Something interesting is happening. The yields on long-term bonds, they're rising right along with stocks. Now, this isn't fear. This is the exact opposite. It's a sign of real, deep confidence in the future. Yeah, I know. It sounds a little backward at first, doesn't it? Rising bond yields being a good sign. But in a bull market, it absolutely is. It's the market's way of saying, hey, we think the economy is going to keep chugging along. It means investors expect growth, and they're okay with interest rates going up a bit to keep things from overheating. It's all working together, perfectly in sync. But, and you knew there was a but coming, right? This happy little dance between stocks and bond yields, well, it can't go on forever. because as those yields keep ticking up and up and up, the whole system gets closer and closer to a breaking point.
And that's what we call the tipping point. See, you have to remember what a bond yield really represents. It's the cost of borrowing money. So when yields get too high, it suddenly gets really expensive for companies to take out loans to build a new factory or hire more people. That cost starts to chew into their profits. And when profits suffer, well, the whole engine of the stock market starts to stall out.
So is there a magic number? A specific point where the alarm bells go off? Well, not exactly magic, but history gives us a pretty big clue. When the 10-year Treasury yield starts to creep above 5%, that has often been the big red flag. It's the market saying the cost of money is just getting too high for stocks to handle. This is the moment everything flips. All of a sudden, investors look at the market and think, wait a minute, bonds are now offering a really nice return. And at the same time, stocks look super risky because company profits are in danger. So what happens? The risk-off button gets slammed. The herd starts moving. And that right there, that shift of money out of stocks and into those now high-yielding bonds, that is your early warning signal. It's the bond market practically screaming that the good times for stocks are probably over and a bear market might be right around the corner.
Okay, so this all sounds great, but it's a bit theoretical, right? How can you actually see these signals for yourself in real time? Well, the pros have a go-to tool for exactly this. It's called the yield curve. And honestly, you can think of it like the market's crystal ball. It's basically just a graph that shows you the interest rates, or yields, for bonds across all different time frames, from a few months out to 30 years. By looking at the shape of this curve, you get an incredible snapshot of what the entire market thinks is going to happen next with the economy.
The key thing here is its shape. A normal, healthy yield curve slopes upwards. But when that shape starts to flatten out, or even worse, when it flips upside down, what we call an inverted curve, that is one of the most reliable warning signs of a recession out there. It tells us about inflation, about what the Fed might do with interest rates. It's a full economic health checkup in one chart.
Now, it's worth pointing out, once we actually hit that tipping point and the stock market starts falling, things can get a little messy. For a while, the neat relationship kind of breaks down. If there's a real panic, people just sell. Well, they sell everything. Stocks, bonds, you name it. And for a bit, all those predictable patterns go right out the window. So if we zoom out, you can see the whole cycle play out. First, you get that early growth phase, where stocks and long-term yields are rising together in harmony. Then, you hit the tipping point, where those high yields start to hurt company profits and stocks start to tumble. That kicks off the bear market, where things get disconnected for a while. But eventually, those yields fall, money becomes cheap to borrow again, and that sets the stage for the whole thing to start all over. So what's the one big thing to take away from all this? It's that the bond market isn't just along for the ride. For most of this journey, it's actually in the driver's seat. It's the leading indicator. It's showing you the turns in the road before the stock market even gets there. Bottom line, bonds lead the way.
And really, knowing this stuff helps you with what the legendary investor Peter Lynch was talking about. He said the key is not to get scared out of your stocks. Well, by watching the bond market, you get a much clearer picture of the big economic forces at play. It helps you stay rational and make smarter decisions instead of just reacting to scary headlines and short-term noise.
Which, of course, brings us to right now. Today, as we speak, the bond market is sending signals. It's whispering clues about what's coming next for the economy, for interest rates, for the stock market. So the only question left is, now that you know what to look for, are you watching?
You know, when we think about what moves global finance, we usually think about stocks, right? Company profits, big innovations. But there's this other force, a hidden engine that moves trillions of dollars around the world every single day. It's this deep, powerful connection between a country's government bonds and the value of its currency. And today, we're going to pull back the curtain on it.
So, here's the big question. How can you actually predict where a currency is headed? For a long, long time, the financial world had a really simple go-to answer for this. But then, a massive global crisis came along and just shattered that old rulebook. It forced everyone to find a whole new way to play the game.
So, let's start with how things used to work. What was that classic textbook strategy for figuring out a currency's next big move?
For decades, it all boiled down to just one number, the interest rate. Whatever a country's central bank set as its rate, well, that was the North Star.
It was the single most important signal for traders trying to predict whether a currency was going to go up or down. Simple as that.
And you know, the logic was beautifully straightforward. Money goes where it's treated best, right? It chases returns. So a country with high interest rates, that's like a giant magnet for foreign cash, and all that demand strengthens its currency. On the flip side, if your rates are low, that money goes looking for a better deal elsewhere, which weakens your currency. For the longest time, that was pretty much all you needed to know.
But then a catastrophe hit the global financial system, and in the chaos, that one clear, reliable signal that everyone depended on, it just vanished. The old rules were completely broken.
In the fallout of the 2008 financial crisis, central banks everywhere hit the panic button. To try and save their economies, they did something drastic. They slashed interest rates all the way down to basically zero. And just like that, the main difference between countries, that key signal traders used, was gone. It was like trying to navigate without a compass.
This created a huge problem. I mean, if interest rates are pretty much the same everywhere you look, how on earth do you decide where to put your money? What became the new signal? Where were investors supposed to look for clues about the next big currency trend?
Well, the answer was hiding in a different, much more subtle place. The really smart money, they started looking past the central banks and paying incredibly close attention to government bonds.
And the magic number here is the bond yield. Now, think of a bond yield as the market's collective guess about the future. It's not just a number, it's a forecast. It tells you what thousands of big-time investors believe is going to happen with a country's economy and where its interest rates are headed down the road. It's a powerful glimpse into the future.
And not all bond yields are created equal. Short-term yields, they kind of reflect the market's daily mood. Are investors feeling risky today, or are they scared? But the real heavyweight, the one that tells the long-term story, is the 10-year bond yield. That's the benchmark. It's the market's best guess for where the economy is headed over the next decade.
Okay, so these bonds yields are the new clue. But how exactly do they end up moving trillions of dollars across the planet? Well, it happens through this incredibly powerful strategy called the carry trade.
The idea behind the carry trade is almost deceptively simple. You borrow money where it's cheap, in a currency with a low bond yield, and you invest it where it pays more, in a currency with a high bond yield. And listen, this isn't some niche strategy for day traders. This is a core profit engine for the biggest banks in the world, and it creates these massive, trend-defining tidal waves of capital.
Let's just walk through how this global money machine works. So imagine a huge investment fund borrows, say, Japanese yen, where the cost is super low, maybe 0.5%. Then they take all that yen, exchange it for US dollars, and buy a 10-year US Treasury bond that's paying them 5%. Boom. They've just locked in a profit of 4.5% just on the difference. Now imagine doing that with billions of dollars. You can see how this becomes a force that can literally move markets.
Now, this might sound a bit theoretical, but it's not. Let's look at a perfect real-world example that shows just how incredibly powerful this bond-currency connection really is.
Okay, let's rewind to November 2010. Back then, the yield on an Australian 10-year government bond was almost 2.5 percentage points higher than what you could get on a US bond. That massive gap in return, that spread, was like a giant neon sign for global money, screaming, "Invest here." It was a powerful magnet pulling capital into Australia.
But then, fast forward just 5 months, the US economy started looking a lot healthier, which pushed US bond yields up. And that huge gap between the two countries, it shrank dramatically. All of a sudden, that Australian magnet was losing its pull.
And the effect on the currency was, well, you can see it right here. It was instant and it was massive. As that yield difference peaked, the Australian dollar rocketed up against the US dollar. But the moment that spread started to narrow, the whole rally slammed on the brakes and went into reverse. I mean, the connection is right there, crystal clear.
So, after all that, what is the big takeaway? How can you actually use this information to make sense of all the financial news you hear every day?
The absolute key is to stop thinking about a single country's interest rate in isolation. That's the old way. The real signal, the thing that drives the carry trade, is the difference in bond yields between two countries. That's the spread. And that spread is what tells you where the big money is probably going to flow next. If it's widening, look for a trend. If it's narrowing, look for a reversal.
You know, one source put it perfectly. Bonds reveal what the market is thinking and what investors and speculators are doing with their money. It's not just abstract data. It's a transparent signal of where the world's biggest and smartest investors are placing their bets on the future.
So the world's biggest investors are glued to the bond market every single day. But now, you know what they're looking for. By learning to read the language of bond yields and spreads, you've got a powerful new way to understand the global economy. You're not just watching the news anymore, you're actually seeing the hidden forces that drive it.
Let's talk about the one currency that, for better or worse, underpins our entire global economy, the US dollar. How on earth did one single piece of paper come to hold so much power? Well, that's what we're here to find out. It's a massive question, right? But honestly, to understand modern finance, world trade, or even just what's happening in the news, you really have to understand the US dollar. It's kind of the starting point for, well, almost everything. So we're going to pull apart its history to see exactly how we got here. Okay, first up, the dollar's dominance. To really get our heads around the dollar's unique position today, we need to take a quick trip back in time. A little history lesson is in order. So what do these terms you see here actually mean in plain English? Currency of first reserve? That's just the main currency that central banks all over the world choose to hold. And safe haven? That's where all the money runs when global markets start to panic. The dollar essentially is woven into the fabric of world trade. All right, section 2, the gold standard's failure. You see, before the dollar was king, the world tried to anchor its finances to something a little more, well, shiny. This was the era of the gold standard. The idea behind it was actually pretty simple and, kind of elegant. If every currency is backed by a real physical amount of gold, you create stability. It should make inflation easier to manage and, in theory, stop those wild economic swings. It was like trying to build a perfect, self-regulating machine. But here's where it gets interesting. The huge gap between the dream and the reality. The whole system had one fatal flaw. When a country started to struggle economically, the political pressure would just build and build. And what happened every single time? That country would act to protect itself, devalue its currency, break its promise, and the whole house of cards would start to wobble. And wobble it did, again and again. The UK got the ball rolling back in 1844, and by the 1900s, most of the developed world was on board. But then, World War I hit, bringing with it massive inflation. Then came the Great Depression and crippling deflation. By 1933, at a big conference in London, the major powers just threw in the towel. The gold standard was officially dead. So, out of the ashes of the gold standard and a Second World War, a new financial order was about to be born. And this time, its center of gravity wasn't going to be London. And this slide just shows you why, perfectly. Look at that contrast. The UK, the old financial leader, was broke. Its gold reserves were totally wiped out by the war. The United States, on the other hand, it was an absolute economic powerhouse. Its output had literally doubled. It was ready to lead. And here's the one number that says it all. By the end of the war, the US held 80% of the entire world's gold reserves. 80%. Nobody else was even in the same league. So in 1944, leaders from 44 countries met up in Bretton Woods, New Hampshire, to draw up a new set of rules. And the system they created was actually beautifully simple. Step 1, they fixed the price of gold at $35 an ounce. Step 2, every other country agreed to peg their currency's value to the dollar. And just like that, step 3, the dollar became the new anchor for the world economy. This was it. This was the coronation. The US dollar officially became the world's go-to currency, its currency of first reserve. It was a role it had never held before, and, well, one it hasn't given up since. But, history always has a plot twist. The Bretton Woods Agreement, as great as it seemed, wasn't built to last forever. The very system that crowned the dollar, well, it contained the seeds of its own destruction. By the late 1960s, you could really start to see the cracks forming. The U.S. was spending incredible amounts of money on the Vietnam War and its own social programs. Inflation was taking off. The country was running a huge trade deficit. The dollar was now clearly way too strong. But America's trading partners in Europe and Japan were kind of happy to let it stay that way. It made their stuff cheaper to sell. So here's the crucial bit. Other countries started to get really nervous. They were holding all these US dollars, but they began to seriously doubt if America could actually back them up with gold. And you know what? They were right to worry. The US only had enough gold to cover about a third of all the dollars floating around overseas. A run on its gold reserves was a very real threat.
And then, the world changed with a single announcement. In 1971, President Richard Nixon just unilaterally closed the gold window. He cut the link. Foreign countries could no longer just show up and trade their dollars for American gold. The anchor was gone.
After a few failed attempts to kind of patch the system back together, by 1973, it was officially over. For the first time ever, the world's major currencies were left to free float, their values decided by supply and demand, not by a link to gold. And this, right here, was the birth of the modern foreign exchange market, or Forex, that we know today. This brings us into the modern era. The dollar was still the king, sure, but it now ruled over a much more chaotic kingdom. Its reign was about to be tested by a series of crises and the rise of a really powerful new challenger. Let's just take a quick look at how this all played out. During the 1997 Asian financial crisis, the old rules still worked. Investors panicked and fled to the safety of the dollar. But after the dot-com bubble burst in 2001, the dollar began this long, slow slide. Then came 2008. The global financial crisis, which started right in the US, began to seriously damage the dollar's reputation as the ultimate safe haven.
And while all this was going on, a challenger emerged. The euro wasn't just some new currency. It was a political project with two very clear goals. One, protect its member countries from wild currency swings. And two, create a real viable alternative to the US dollar and shift the global balance of power away from America.
The fallout from 2008 just sped this all up. The US Treasury's policy of quantitative easing, which is really just a fancy term for printing money, weakened the dollar even more. And for the first time, investors began to seriously look for other safe havens, turning to currencies like the Swiss franc and the Japanese yen. The dollar's monopoly on safety was officially broken. Which brings us right up to today. After a long, pretty dramatic history, the story of the US dollar is now entering a brand new and, frankly, a deeply uncertain chapter. Now, let's be clear about something. The dollar is still the most important currency in the world. It is the linchpin holding the whole thing together. But its absolute, unquestioned authority as the only safe place to put your money in a crisis, that's being challenged in a way we have never, ever seen before.
And that leaves us with the final, critical question. For over 75 years, the entire world has run on the dollar. The system has bent, it is even broken, but the dollar has always remained on top. The question we're all asking now is, for how much longer?
All right, let's dive right in. Today, we're going to learn how to read the market's secret language. We're talking about those hidden signals that show you what the smart money is really doing.
You know, when you look at the financial markets, it just seems like pure chaos, doesn't it? Just a dizzying storm of numbers and charts. But what if I told you that underneath all that noise, there's a kind of hidden language, a language that if you learn to speak it, can tell you exactly where the money is flowing, often before the rest of the crowd catches on. That's exactly the mystery we're going to solve. So where do we even start? Well, our first clue, and honestly, this might be the most important one of all, is the US dollar. I mean, you could make a pretty strong case that every single market on the planet, from stocks to oil, kind of revolves around it. So getting a real, true reading of the dollar's strength is absolutely step number one. Now, when most people want to measure the dollar, they look at the classic US dollar index, the USDX. It's been around forever, since 1973, and its job is pretty simple. Just track the dollar against a few other big world currencies. It's the tool everyone knows, but, and this is a big but, it's got a huge hidden flaw.
Okay, look at this. This is the flaw I was talking about. See that massive slice of the pie? That's the euro. It makes up nearly 58% of the entire index. Think about that for a second. It means if the euro just sneezes, the whole dollar index catches a cold, completely masking what's happening with all the other currencies.
So you got to ask yourself, right? Does an index designed back in the 70s that's basically just a bet for or against the euro really give us an accurate picture of today's economy? Well, the pros would say absolutely not. They use a much better, much more balanced tool.
And here it is. The one on the right is the index a lot of professionals actually prefer. It's way more modern, from 2011, and the logic is just so much cleaner. Instead of that crazy skewed setup, it just takes 4 of the most important currencies and gives them each an equal 25% weight. So you get the euro, the yen, the pound, and the Aussie dollar on a level playing field. It's just a more balanced, more realistic view.
And you can really see the difference when you look at them side by side. On the left, you've got that old lopsided index. On the right, the more modern balanced version. So by watching the chart on the right, you're getting a much cleaner, much more democratic signal of the dollar's true strength or weakness. It's a better pulse. Okay, so we've got a handle on the flow of money. But now let's track the flow of emotion. Because if you think about it, if money is the engine of the market, then fear and greed, well, that's the fuel. And guess what? There's an index for that too. Let me introduce you to the VIX. I bet you've heard it called the fear gauge, and that's pretty much spot on. What it actually does is measure how much chaos, how many wild price swings investors are expecting to see in the stock market over the next 30 days. It's literally a direct reading of the market's anxiety level. But here's the real secret to using it. You have to think of the VIX as a contrarian indicator. And what that means is you use it to do the opposite of what the crowd is doing. So when the VIX is super low, it means everybody's feeling great, complacent, even greedy. And when it's screaming high, it means they're panicked and full of fear.
This table here just breaks it all down perfectly. So when you see the VIX get really, really low, down into that 10 to 12 range, maybe even lower, that's a warning bell. It's a signal that there's just too much greed out there and a market top could be right around the corner. Now on the flip side, when it spikes like crazy, up above 30 or 40, that's panic in the streets. But for a savvy observer, that signals the selling might be getting exhausted and a market bottom could be forming.
And hey, if you want a really simple way to remember this, just use this little rhyme. When the VIX is low, it's time to go, meaning get cautious. When the VIX is high, it's time to buy, meaning that's when you start looking for opportunities while everyone else is scared. It's a powerful little mental shortcut. So we've got money covered and we've got emotion covered. But that's not the whole story, is it? To get the full picture, we got to look past the financial stuff and check the pulse of the real, physical economy. We need to track the raw materials that actually build our world.
And that brings us to commodity indexes, which, believe it or not, have a pretty quirky history. The first big one, the CRB, came out in 1957, and it had things in it like lard, potatoes, and onions. I'm not kidding. Gold and crude oil weren't even added until 1983. So yeah, it's evolved a lot, but this leads us to a very familiar problem.
Yep, you guessed it. Just like that old dollar index, a lot of the standard commodity indexes today are seriously unbalanced. They're usually way too heavily weighted towards one single sector, and that's usually energy. So if the price of oil goes on a wild ride, it gives you a totally distorted picture of what the entire commodities market is doing.
So, once again, we look for a better alternative. This is the Continuous Commodity Index, or CCI. And as you can see, it's so much more balanced. The 4 major groups, agriculture, softs, metals, and energy, all have a significant piece of the pie, but none of them are dominating the whole thing. This gives you a much truer reading on the health of the global, real economy.
All right, here we go. We now have our 3 key signals: the true pulse of the dollar, the market's emotional state, and the health of the real economy. Now for the most important part, connecting the dots.
There's a name for this technique, by the way. The pros call it relational analysis. It sounds fancy, but the idea is actually really simple. It's not about looking at any one signal by itself. It's about understanding how these different markets are all connected, how they push and pull on each other to tell the real story of where money is going.
So how does this actually work? Well, let's walk through a quick example. Imagine you see the US dollar is falling. Okay, so that means money is moving out of a safe haven. But at the exact same time, you notice that a broad commodity index is also falling. So that means money is moving out of a risk asset too. Then you just ask the simple question, where is all that money going? It's not going to safety and it's not going to commodities. The logical conclusion? It's probably flowing into another risk asset, like the stock market. See how powerful that is? With just 2 charts, you've figured out the market's probable direction.
And there you have it. This is basically your new market dashboard simplified. Just 3 key indicators that give you a really powerful, high-level view. You've got the dollar for the flow of money, the VIX for the flow of emotion, and the CCI for the health of the real economy. That's your toolkit. By tracking these 3 signals together, you've really learned how to decode the market's hidden language. You can cut through all the noise and just focus on what actually matters. So the only question left is,
now that you know how to listen, what are the markets telling you right now? Okay, let's get right into it. You know, the financial markets, they're always talking. They're sending out signals and clues every single second of every day. But let's be honest, sometimes it feels like they're speaking a totally different language. Well, today we're going to change that. We're going to become economic detectives. We're going to crack the code on some of the market's biggest secrets so you can start seeing the financial world like a real pro.
And to really get why this stuff is so important, let's start with a massive question. The huge financial crash of 2008, were there any warning signs? Was the market screaming that something was about to go terribly wrong? The answer is absolutely yes, if you knew where to look. And one of the biggest clues was hiding inside a single, pretty startling number. And that number was 463. In the middle of 2008, right as the crisis was hitting its absolute peak, this was the reading of the market's fear gauge. I mean, it was a spike like no one had ever seen. It was a sign of pure, unfiltered panic in the banking system. But what exactly is this gauge, and what was it trying to tell us?
Well, that brings us to the very first tool in our detective kit. And we're not talking about some super complicated stock chart here. We're talking about something way more fundamental, a tool that measures the actual level of fear and risk in the entire economy.
It's called the TED spread. And yeah, the name itself is kind of a clue. The T is for Treasury bills, and the ED comes from the old ticker for Euro-dollar contracts. But all it really is a simple calculation. It's the gap between two really important interest rates. So let's really unpack what that gap means, right? On one side, you have T-bills. That's basically the interest rate you get for lending money to the US government. For all intents and purposes, it's considered totally risk-free. Then, on the other side, you have the rate that banks charge each other to borrow money, and that always has some risk. The bank you lend to could go under. The TED spread is just the difference between the safe rate and the risky rate.
And boom, just look at this chart. This is what it looks like when fear absolutely takes over the system. That giant spike you see in late 2008, that's the spread getting wider and wider. And it means two things are happening at once. Banks are getting terrified to lend to each other, so the rate they charge goes way up. At the same time, investors are running for the hills, trying to put all their money in super safe government T-bills. A widening spread like this is a massive red flag that the economy is in trouble.
Okay, so the TED spread? That's our right now fear gauge. It tells us what's happening in the moment. But what about what's coming next? Let's move on to our second clue, one that helps us get a peek into the future, specifically what the market thinks is going to happen with inflation. This one is called the TIPS spread, and what's so powerful about this is that it comes directly from the market itself. This isn't some government agency's forecast or an economist's best guess. No, this is the combined wisdom, or maybe the combined worry, of millions of investors all priced into the market in real time.
All right, so how on earth does it work? Well, it's all about comparing two different types of government bonds. A regular, conventional bond gives you a fixed payment. It doesn't matter if inflation goes through the roof, you get what you were promised. But a TIPS bond, and that stands for Treasury Inflation Protection Security, actually adjusts its payments based on inflation. So the spread, the difference in yield between these two, tells us exactly how much investors think future inflation is going to be.
And when you look at a chart like this, you can literally see those expectations play out in real time. When those two lines start to pull apart or diverge, it means investors are worried. They're expecting higher inflation, so they're demanding more protection. And when the lines get closer together or converge, it means those inflation fears are cooling off. And believe me, this is one of the key signals that central banks are watching like a hawk.
All right, so we've got a handle on fear, and we've got a way to peek at future inflation. These are powerful clues on their own. But here's where the real detective work begins. The pros know that the biggest insights come from connecting the dots, from seeing how different markets are all in a constant dance with each other. This technique is called ratio analysis. And it sounds kind of fancy, but the idea is actually pretty simple. It's about getting past just looking at one price chart. It's about comparing two seemingly unrelated things to see how they're actually connected, which gives you a full three-dimensional view of what's really driving the market. Let me show you a few examples.
Okay, first up, gold on the left, the Aussie dollar on the right. Now you might be thinking, what in the world do these have to do with each other? Well, a lot, actually. Australia is one of the biggest gold producers on the planet. So, as you can see from how these charts almost mirror each other, when the price of gold goes up, it usually gives a nice boost to the Australian currency. Let's look at another classic pairing. On the left, you've got the price of oil. On the right, the US versus the Canadian dollar. So Canada is a huge exporter of oil. That means when oil prices climb, the Canadian dollar tends to get stronger. And that's why the chart on the right tends to go down, because it takes fewer Canadian dollars to buy one US dollar. It's a really powerful connection.
And hey, this isn't just about things you dig out of the ground. It works with entire stock markets and currencies too. Take Japan, for example. The Japanese yen has a reputation for being a safe haven currency. So what often happens is, when investors get nervous and the Japanese stock market, the Nikkei, starts to fall, money rushes into the perceived safety of the yen, which makes the currency stronger. The country's stocks and its currency are deeply connected.
So, let's pull back for a second. The point of all this, it's not about finding some magic crystal ball, right? Nobody can predict the future with 100% accuracy. It's about something way more valuable. It's about building a better framework, getting that bird's eye view of the entire financial world so you can spot the important clues for yourself. So let's just quickly recap the 3 key tools we've added to our detective kit today. We've got the TED spread, our real-time fear gauge. We have the TIP spread, which lets us see the market's own inflation forecast. And we have ratio analysis, our secret weapon for uncovering all those hidden connections that really drive the global economy.
And you know, there's a line from the material we're looking at today that just nails it. It's about having the tools which allow you to see the whole picture, and not simply one simple price chart for one simple currency pair. And that's it right there. It's about graduating from a one-dimensional view to seeing the full, fascinating story the market is telling us every single day.
So I'm going to leave you with a final thought. Armed with these tools, you're not just a passive observer of the financial news anymore. You're an analyst. You're a detective. So the next time you see a headline, ask yourself, what are the spreads saying? What relationships are at play here? Now that you know some of the clues, what are you going to see?
So what's really pulling the strings behind the world's biggest economies? Well, today, we're going to dig into the source text, the fundamentals of global economies, to get some answers.
Okay, so you can probably forget everything you thought you knew about who controls things. You know, governments, big markets. According to our source material, the real power, the real story, is all about these super intense internal battles for control that are raging inside the world's biggest economic players right now.
And to really get our heads around this, we're going to take a quick tour of 4 of these giants. We're talking China, the USA, Japan, and Europe.
And what you're going to see is that each one of them is defined by its own unique, constant, internal struggle for economic dominance. So, okay, let's dive in. First up, we've got China. Now, our source points out this huge fundamental paradox, right? You've got a communist state that's trying to run a full-blown capitalist machine. I mean, talk about a high-stakes balancing act. And believe me, the implications for the rest of the world are massive.
The term our source uses for this is state-run capitalism. And the core idea is pretty simple, actually. Economic growth, it's not just about making money. For the Communist Party, it is the absolute #1 tool for keeping their grip on power. It's like, hey, as long as we keep everyone employed and reasonably happy, we stay in charge. Simple as that. And the sheer scale of this whole thing is, well, it's just staggering. Our source projects that in just 5 years, China's piece of the global economic pie is going to hit 18%. That means it will officially overtake the United States as the single biggest economy on Earth.
Wow. And all that economic muscle, well, it translates directly into global leverage. I mean, just think about this. China holds over $1 trillion of U.S. government debt. That gives them some pretty incredible influence on the world stage, doesn't it?
But, and this is a big but, our source is sounding a huge alarm here. All this super fast, debt-fueled growth, it looks dangerously, eerily similar to what happened in Japan back in the 80s. You know, right before that massive bubble burst and basically crippled their economy for decades. And speaking of other economic powerhouses,
let's hop over to the current king of the hill, the USA. And here's where our source makes a really provocative claim. It argues that the real economic power doesn't actually lie with the government. Nope, it's with the Federal Reserve.
So this begs a really fundamental question, one that the source poses directly. Is America's central bank actually part of the government? The answer? Well, it might just surprise you.
The argument from the text is a pretty shocking one. No. It's a private corporation, basically a cartel of incredibly powerful banks that operates completely independent from, and, when it comes right down to it, is totally unaccountable to the American public.
And look, this isn't some brand new conspiracy theory floating around the internet. The source actually points to President Woodrow Wilson himself. Just 3 years after he signed the Fed into existence, he's quoted as saying he felt he put his country under the control of a small group of dominant men. Pretty incredible, right?
Now, this private control gets supercharged by something called the dollar's exorbitant privilege. Think of it this way. Because the entire world needs and uses US dollars, America basically gets what our source calls a free lunch. It can rack up enormous debts and spend money in a way that, frankly, no other country on the planet could even dream of.
All right, from there, let's turn to Japan. This is a nation that, according to our source, is still completely haunted by its own spectacular economic trauma.
It all kicked off in 1985 with this currency deal, the Plaza Accord. It just poured rocket fuel on Japan's economy. By 1989, their stock market was through the roof, an all-time high. But then, just a year later, bam, the whole thing bursts, triggering this incredible crash and starting what everyone now calls the lost decade.
And according to our source material, the ghost of that crash is still hanging over Japan's entire economic policy. It's basically forced their central bank into this constant, almost desperate battle to control the value of their currency, the yen.
So here's the thing. Here's the core issue. Japan's whole economy basically lives or dies on its exports. And if the yen gets too strong, all that stuff they sell becomes too expensive for the rest of us to buy. So this puts the Bank of Japan in this impossible trap, a never-ending fight to keep their own currency weak. And what happens? It often means they have to buckle under political pressure, effectively giving up any real independence.
Okay, our final stop is Europe, and the source describes the Eurozone as this fragile, absolutely historic experiment. But what's interesting here is that it's defined not by who has control, but by a critical, well, lack of control.
See, our source argues that for any currency to actually survive in the long run, it needs 3 essential foundations. Think of it like a stool. It needs a monetary union, right, a shared central bank. It needs an economic union, shared rules on spending, and it needs a political union, a central budget, and leadership. And right here, you can see the euro's fatal flaw. It's got that one leg, the monetary union, with the European Central Bank. But the other two, a unified economic and political structure, they're just not there. And our source points out something pretty chilling. In the entire history of money, no currency built with this kind of fundamental flaw has ever survived.
This structural weakness gets even worse when you factor in a massive cultural divide. It's like a personality clash on a continental scale. On one side, you've got the super disciplined, fiscally minded Germany. And on the other, you have the southern European nations, which, as the source highlights, just have completely different economic realities and, totally different attitudes about spending and debt.
So you have to ask, right? What in the world is holding this fragile thing together? Well, according to the source, it comes down to one thing: sheer, raw political will. And nothing captures that better than this famous quote from the former ECB president Mario Draghi. The bottom line is, European leaders have just poured too much into this project to ever let it fail.
Okay, so let's recap. We've just seen 4 totally different internal battles for control. In China, you've got the state fighting the market. In the US, the source claims it's a private banking cartel against the public. In Japan, it's the central bank wrestling with the ghost of its own currency. And in Europe, it's pure political will going head-to-head with cold, hard economic reality.
So what's the big takeaway here? It's this. Understanding these hidden internal power struggles gives you a completely new, really powerful lens for looking at the world. And it all boils down to one final huge question. As all these different battles continue to evolve, which one of these models of control is going to define the next decade of the world economy?
Ever since China's incredible rise, the big question on every investor's and economist's mind has been the same: who's next? So today, we're going on the hunt for the world's future economic superpowers. And the legendary investor Bill Gross really put it perfectly. See, we're not just hunting for a little bit of growth here or there. We're looking for those generational opportunities, the kind of high-stakes plays that could totally redefine a portfolio. And that means we've got to look at emerging markets.
Okay, so if China is the emperor in waiting, the heir apparent to the global economic throne, then who's next in line? We're going to skip the usual suspects today and take a journey to 2 continents that are just brimming with potential and, of course, a whole lot of risk: Africa and Latin America.
So here's how we're going to break it down. We'll kick things off in Africa, looking at what some are calling the lion markets. Then we'll dive into a really peculiar currency situation over there. After that, we'll jet over to Latin America to get a handle on its hot money problem. We'll even pit Brazil against Mexico.
and then wrap it all up by looking at the high-stakes world of exotic currency trading. All right, our first stop is Africa. You hear it all the time, right? The continent of the future. It's a land of, well, paradoxical potential, where you find this immense opportunity sitting right alongside some unbelievable challenges.
Okay, let's kick things off with a number that honestly should make you sit up and take notice. 5%. That has been the average annual growth rate across the entire African continent for the last decade. Now, to put that into perspective, the only country that has been able to match that kind of pace is China. Africa is definitely earning its nickname, the lion markets.
And this isn't just a flash in the pan. This growth is built on an absolutely incredible foundation. I mean, think about this. By 2035, Africa is on track to have the largest labor force in the entire world. It's sitting on 60% of the planet's uncultivated farmland. And get this, it also holds over half of the world's deposits of rare earth metals. You know, the stuff that's essential for all our modern technology.
But, and this is a huge but, here's the paradox. For all of that mind-boggling resource wealth, the sector that actually pulls it out of the ground, we're talking mining, oil and gas, it employs less than 1% of the African workforce. What this tells you is something really important. Africa has a growth strategy, for sure, but it is desperate for a job strategy to actually lift its people out of poverty.
Right now, the continent's economy is really dominated by a handful of heavy hitters. You've got Nigeria, which is Africa's biggest oil producer. And then you have South Africa, a true mining behemoth that produces an absolutely staggering 75% of the world's platinum, on top of being one of the top 5 gold producers.
Now, to really get a handle on the challenges here, we have to talk about money. And specifically, we're going to look at one of the strangest currency setups on the entire planet, the CFA franc.
So what is it? Well, the CFA franc is the currency used in 14 different African nations, most of them former French colonies. And here's the wild part, the real kicker. It's guaranteed by the French treasury and pegged straight to the euro. This isn't just some financial quirk. It's a direct holdover from the colonial era, and it sparks some really intense debates about economic sovereignty today.
And believe me, this thing has a really turbulent history. It was created way back in 1945. Then, in 1994, it was just, bam, devalued by 50% overnight, sending these massive economic shockwaves across the region. Then, in 99, its anchor was switched from the old French franc to the brand new euro.
And this whole setup really gets to the heart of the issue. The African central banks that use the CFA, they have zero monetary autonomy. They basically have no say in their own policies, and their foreign reserves are held by the French treasury, which operates in total secrecy. It's a system that's African in name, but for all intents and purposes, it's French in control.
Okay, let's pack our bags and head across the Atlantic to Latin America. Over here, the story isn't so much about colonial legacies, it's about a much more modern problem. This flood of speculative investment that's known as hot money.
So, you might be asking, why is all this money pouring in? Well, the answer is actually pretty simple. Interest rates. While the US, Europe, and Japan were offering rates way down below 1%, countries like Brazil and Mexico were offering over 7%. For global investors who are starving for yield, that's like an irresistible magnet. Now here's the catch. All this hot money is flooding into economies that are still super dependent on commodities. Over half of the entire region's exports are raw materials. You know, stuff like oil, soybeans, copper. This makes their currencies incredibly volatile because they swing wildly with every little change in commodity prices and investor mood.
And to really see this in action, let's put the two titans of the region head to head, Brazil and Mexico. I mean, they're both economic powerhouses, but they've taken two completely different approaches to dealing with all this.
On one side, you've got Brazil. Its economy is pretty much fueled by that hot money we were talking about, chasing after their commodity exports and those high interest rates. Their central bank is constantly jumping in to manage the currency, which creates something called a dirty float. Then you have Mexico, which has gone a different route. It's attracting more long-term foreign investment into its huge manufacturing sector, and its central bank is totally hands-off, letting the peso float freely.
But here's the thing about Mexico. Even with this big push into manufacturing, it just can't seem to shake its commodity DNA. Just look at how the Mexican peso still moves almost in perfect lockstep with the price of crude oil. It's a powerful reminder of what's really driving things under the surface.
Okay, now let's look at Brazil's currency, the real. See those crazy sharp peaks and deep valleys? That right there,
That's the signature of hot money. Massive amounts of cash flood in, the currency spikes, and then, as soon as sentiment changes, that money rushes out just as fast, causing it to crash. You can imagine what a nightmare that is for their central bank.
And if you want a cautionary tale, a real glimpse of what happens when things go completely off the rails, you just have to look at Argentina. A long, painful history of bad currency pegs, government defaults, and just total economic mismanagement has sent their peso into what looks like a permanent freefall. It's a huge warning sign for the entire region.
All right, so after this whirlwind tour of 2 continents, what's the big takeaway? Well, it really boils down to a classic investment dilemma, right? High risk, high reward. The dream, of course, is that with some stability, with stronger institutions, and more diverse economies, these so-called exotic currencies could one day become stable, mainstream investments. But getting from here to there, that's the gamble. But there's one more piece to this puzzle, and it's absolutely critical. The ultimate variable in all of this is the US dollar. See, when a global shock hits, like the financial crisis in 2008, investors stop caring about high yields. They just want one thing, safety. So they dump their high-risk emerging market currencies and pile into the US dollar. This causes commodity prices to collapse at the exact same time that the emerging currencies are falling. It is a devastating double whammy.
And that leaves us right back where we started, with that huge central question. Are these emerging markets really the roaring lions of the next generation, poised for incredible growth? Or is this all just a high-stakes gamble, where the odds are long and the house, powered by the US dollar, always seems to win in the end? The answer to that is going to define the next chapter of global finance.
Let's talk about the Asia-Pacific, where managing your country's currency is, well, it's a high-stakes game. You get it right, your economy takes off, but if you get it wrong, you're looking at some serious instability. So how exactly are these economic powerhouses playing the game? Let's dive in.
It really all boils down to one simple but massive question. Do you peg your currency, basically anchoring it to something else? Do you just let it float freely in the wild seas of the market? Or do you get in there and fight every single day to control its every move? And trust me, this isn't just some dusty old economics textbook stuff. For these countries, the answer is a multi-trillion-dollar decision. It affects everything from the price of your groceries to the stability of the entire nation. The whole region is like this incredible economic laboratory, and we're going to go inside and see how these experiments are playing out right now.
Okay, let's start with the most disciplined, most rigid strategy of them all, the hard peg. This is where you literally anchor your currency's value to another, usually a more stable one.
And our poster child for this is without a doubt Hong Kong. Since way back in 1983, the Hong Kong Monetary Authority has kept its dollar locked to the US dollar. And when I say locked, I mean it's kept in an extremely narrow trading band.
Now you look at this chart, and you might think, wow, that's boring. It's just a flat line. And you know what? That is the entire point. For a currency speculator, this is a total nightmare. But for Hong Kong's central bank, this flat line, this stability, that's the holy grail. For a global financial hub, that predictability is everything. But, and this is a big but, that stability comes at a huge cost. See, by pegging to the US dollar, Hong Kong basically has to copy-paste America's monetary policy. So when the US Federal Reserve keeps interest rates super low to get its own economy going, Hong Kong has to do the same, even if its own economy is on fire. And this leads to some nasty side effects, like inflation and massive asset bubbles. I mean, get this. In 2012 alone, property prices in Hong Kong shot up by 23%. Ouch. So if the hard peg is just too rigid, what's the alternative? Well, let's look at a more mysterious approach. This is the world of the managed float, and this is where things get a little secretive. Think of it like a currency on a leash. It's not locked down, but it's not totally free either. It's supervised. And nobody, and I mean nobody, does this quite like our next case study, Singapore.
Okay, so what's so amazing about this chart? It's the direction. See, most countries are desperately trying to weaken their currency to make their exports cheaper. Singapore? They do the exact opposite. Their central bank deliberately lets its dollar get stronger. Why on earth would they do that? Well, as a small island that imports pretty much everything, a strong dollar means all those imported goods are cheaper, and that is their #1 weapon for keeping inflation under control.
But how do they actually manage this?
the Singapore dollar is managed against a basket of other currencies, which is a pretty common strategy. But the big question is, what's actually in that basket?
And that's the secret sauce. The exact mix of currencies in that basket, how much each one is weighted, even the band that the dollar is allowed to float in. It's all a state secret. Nobody outside the central bank knows. This secrecy gives them incredible flexibility, and it's what makes their system one of the most unusual and frankly successful in the entire world.
Now, Singapore isn't completely alone here. Its neighbor, Malaysia, does something pretty similar, a managed float against its own secret basket. But their main goal is a little different. They're less focused on inflation and more on just maintaining overall economic stability, which has really helped them dodge some of the volatile money flows that have hit other countries in the region.
All right, on to our final category. If the first strategy was an anchor and the second was a secret formula, this one is a constant all-out brawl. Welcome to the world of the interventionists.
And there is no better example of this fight than Indonesia. Their central bank is walking the tightrope of all tightropes. Think about it. If they raise interest rates to fight inflation, a flood of foreign hot money comes pouring in looking for a quick profit. But that inflow makes their currency, the rupiah, stronger, which then crushes their exports. It's this vicious cycle where every time you solve one problem, you create another one.
And this chart, wow, this is what that constant battle looks like on paper. Just look at the insane volatility. If there's one word to describe the rupiah, it's volatile. It has crashed, it has recovered, it has been devalued. You are literally looking at the front lines of a currency war.
Taiwan is another really fascinating one. Officially, on paper, they'll tell you the new Taiwan dollar is a free float. But in reality, yeah, not so much. The central bank is famous for stepping in all the time, especially when the currency gets too strong. They have to protect their massive export-driven economy.
So let's actually put two of these interventionists side by side. On the left, you've got Singapore's slow, steady, deliberate climb to fight inflation. Then on the right, you have Taiwan. Their currency also gets stronger over time, but look at the difference. You can almost see the managed movements, the interventions, to make sure it doesn't happen too fast and hurt their exporters. Two very different styles of fighting for two very different goals.
So, we've seen the pegs, the secret floats, and the constant battles. But what happens when you zoom out, when you stop looking at the individual strategies and look at the whole region? A bigger and frankly more surprising picture starts to take shape.
This quote really gets to the heart of it. There's this growing belief that these nations, many of them still scarred by that devastating 1997 Asian financial crisis, are now quietly coordinating with each other. It's like an unwritten rule, an informal pact of exporters.
And here's the key takeaway. They're all trying to make sure no single country gets an unfair advantage by devaluing its currency against its neighbors. The memory of that 97 crisis is still so fresh that the new motto is safety in numbers. They're closing ranks, creating a powerful, unified bloc to protect themselves from all that global volatility.
And that leaves us with one last really big question. In a global economy that's dominated by giants like the US and China, are all these individual playbooks, the peg, the float, the fight, are they becoming obsolete? Maybe the real strategy, the only one that truly matters anymore, is the one they're writing together. A unified economic front built not on individual tactics, but on a shared, hard-won lesson of survival.
You've probably heard it a million times, right? The economy is this wild roller coaster, booms, busts. But what if that's completely the wrong way to look at it? In this explainer, we're going to argue it's less of a theme park ride and a whole lot more like something, well, something massive. I mean, you feel it, I feel it, we all do. One year, it seems like jobs are everywhere, everyone's feeling good. The next, all you see are headlines about recession and doom and gloom. It really does feel like this crazy up and down roller coaster. But is that what's actually going on under the hood? All right, so here's the big idea. Forget the roller coaster. The economy isn't quick, it's not nimble, it can't just flip on a dime. A much better way to think about it is like a giant oil tanker. Seriously. Once that thing is moving, it has this incredible momentum. It can take miles just to slow down, and even longer to actually change direction. And that single idea, that massive, sluggish inertia, that's the key to the whole boom and bust thing. Okay, so if the economy is this giant tanker, it kind of begs the question, right? Who's at the helm? Who's trying to steer this thing? Well, that's where the world's central banks come in. You've heard of them, the Federal Reserve in the US, the European Central Bank, and so on. These are the captains of our ship. Now, you'd think the captain's job is to take us on an exciting ride, but it's actually the complete opposite. Their whole mission is to be more like a gardener, tending to a greenhouse. They want to create these perfect, stable, totally predictable conditions. Not too hot, not too cold, just right for the economy to grow at a nice, steady pace. But here's the catch, and it's a big one. A gardener can look at a thermometer, see it's too hot, and open a window right away. Our captains, they don't have that luxury. Their instruments are kind of clumsy, they're blunt, and even worse, when they do something, when they turn a dial, it can take months, sometimes even years, for it to have any effect. That tanker's momentum is just huge. So, okay, we get it. The captains have a really, really tough job. But what can they actually do? What's in their toolkit? Let's take a look at the actual levers they have to pull, and you'll see why it's a lot like trying to steer that tanker through a super thick fog. This right here, this is the core of the problem. The data they use, it's all old news. It's like driving a car while only looking in the rearview mirror. They have to make huge decisions based on where the economy was a few months ago, not where it is right now. So what happens? If they act too early and hit the brakes to cool things down, they might accidentally kill off a perfectly good recovery. But if they wait too long, that tanker's momentum just keeps it going until it overheats, which then forces them to slam on the brakes so hard that it sends the whole thing into a recession. It's this impossible balancing act, all because of that massive time lag. So what are these clumsy controls they're using? Well, they've basically got three main levers. First up is interest rates. That's the main throttle on the ship. Higher rates means slowing down, lower rates means speeding up. Simple enough. Then there's bank reserves. This is all about telling banks how much cash they have to keep on hand, which controls how much they can lend out. It's like controlling the fuel supply. And third, you have something called open market operations. Don't let the fancy name fool you. It just means they're buying and selling government bonds to either inject cash into the system or suck it out. And the key thing to remember, all three of these are powerful, but they all have that same frustrating time delay. And to make things even more interesting, the captains on the bridge don't even agree with each other all the time. They basically fall into two groups. First, you've got the hawks. These guys are absolutely terrified of inflation. For them, it's public enemy number one, and they're always itching to hit the brakes, even if it hurts the economy a bit. Then, on the other side, you have the doves. They're all about jobs and growth. They say full speed ahead and are willing to risk a little inflation to keep things humming along. And these two sides, they're constantly fighting over the controls.
So, when you put it all together, this tendency to act too late or too early, plus the constant battle between the hawks and the doves, you get this, well, the surprisingly predictable pattern. The tanker's journey isn't just random zigzagging. It actually goes through 4 distinct seasons, again and again. So let's map out that typical voyage.
And here's the journey laid out. It always starts at the bottom, what we call the trough. From there, we move into early expansion. Things are starting to look up. People are getting hired again. That momentum builds into a late expansion. The economy's roaring now, but this is when the captains start getting nervous about overheating, and you hear that word, inflation, all the time. So they try to cool things down, which eventually leads to a recession. The economy shrinks, unemployment goes up, and then the whole cycle starts over from the trough again. And this isn't just abstract theory, right? This is what it actually feels like for all of us on the ground. When we're in an expansion, jobs are easier to find, prices are going up, and people are generally feeling optimistic. But when we hit a recession, jobs get scarce, prices might level off or even drop, and yeah, the whole mood just gets pessimistic. I'm sure you've lived through at least one of these cycles. You know exactly what I'm talking about. Okay, so if this whole journey is pretty predictable, that's actually great news for us. It means we don't have to be just clueless passengers getting thrown around. We can actually learn to read the signs, to check the economic weather, if you will. So let's talk about how you, a savvy passenger, can spot which season we're in. To do that, you need to understand one key idea: risk appetite. It sounds complicated, but it's not. It's just about how brave or scared investors are feeling. When the economic weather is sunny and warm, people feel adventurous. They're willing to take more risks, like buying stocks, for a bigger payoff. But when the storm clouds gather, they run for cover and look for something safe. So let's put it into practice. During that expansion phase, when everything's looking great and feeling optimistic, risk appetite is through the roof. Investors are pouring money into stocks and commodities, hoping to ride the wave of growth. That's why you see the stock market just soaring, hitting record highs. But then, the cycle turns. We head into a recession. Fear completely takes over.
what happens to risk appetite? It collapses. Investors yank their money out of those risky stocks as fast as they can, and they pile into the safest things they can find. Usually that means government bonds. They're thinking, hey, I'd rather get a tiny but guaranteed profit than risk losing my shirt. And that's why you'll often hear that bonds are suddenly king when the stock market is tanking. All right, so why does any of this matter? What's the big takeaway here? Why is thinking about the economy as an oil tanker so much more helpful than thinking of it as a roller coaster? Let's tie this all together, because it really does change how you see the world. It matters because it shows you that this whole system isn't just random chaos. There's a logic to it, a rhythm. The next time you see a headline about the Fed raising interest rates to fight inflation, you won't just shrug. You'll go, okay, the captains are trying to slow down the tanker. You'll know there's going to be a delay before it works, and you'll know that this action is already setting up the next season in the cycle. It gives you a framework, a way to actually decode what's going on. But let me leave you with one final big question. Over the last decade or so, the captains have started messing with some brand new, pretty experimental tools. The big one is called quantitative easing, which is basically like strapping a giant, untested rocket engine to the back of the tanker, just printing unprecedented amounts of money to force it forward. And the truth is, nobody really knows what the long-term consequences are. So the question we're all facing now is this: are these new tools finally going to give the captains the precise control they've been dreaming of, or are they accidentally steering our giant oil tanker straight into completely uncharted and maybe very dangerous waters?
Hey there, and welcome. Today, we are diving deep and going way beyond the headlines to really decode economic news. We're going to find out what all those big, flashy numbers actually mean for the markets and, for you.
So, have you ever seen this happen? You see a headline that's just screaming about amazing job growth or a booming economy. And then you look at the stock market and it's tanking. It makes absolutely no sense, right? It feels totally backward. Well, that's the big puzzle we're going to solve together in this explainer. And believe me, the answer is way more interesting than you'd think.
Okay, first things first. Before we get to the twists and turns, we need to get a handle on the basic tools of the trade. Let's quickly run through the major numbers that everyone uses to get a snapshot of an economy's health.
Let's start with the big one, GDP, or Gross Domestic Product. The easiest way to think about it is like the economy's final report card for the quarter. It literally adds up the value of every single thing a country produces. We're talking everything from coffee to cars to computers. It's the highest level view we have, telling us if the whole economic engine is speeding up or starting to slow down.
Next up, we've got the CPI, the Consumer Price Index. Now this one hits a little closer to home for all of us. It's how we measure inflation. It basically tracks the price of a virtual shopping cart filled with everyday stuff like milk, gas, and rent. So when the CPI number goes up, it means your money just doesn't stretch as far as it used to. It's a huge deal.
And finally, there's the NFP, or non-farm payroll. This report comes out on the first Friday of every month in the US, and honestly, it's the one that traders and analysts are glued to their screens for. Why? Because it can move the markets more than almost any other single piece of news. It's a direct look at the health of the job market, which is pretty much the backbone of the entire economy.
Okay, so now we know what GDP, CPI, and NFP are all about. But just knowing the definitions, that's only the first piece of our puzzle. This is where we get our first really big twist.
You see, here's the secret. The actual number that gets reported is only half the story. The other, and maybe more important half, is the forecast, the number that all the big-shot economists and analysts expected to see. The market doesn't really react to the news itself, it reacts to the surprise. It's all about the gap between what was expected and what actually happened.
And this slide just nails it. This right here is how we start to solve that paradox from the beginning. Look at the left side. We got good news. The economy grew by 2%. Awesome, right? Well, no, because everyone was expecting 3%. It's a miss, a disappointment, and the market sells off. Now look at the right. This is bad news. 100,000 people lost their jobs. That's terrible. But the forecast was for a loss of 200,000. So bad suddenly becomes better than we feared, and the market actually rallies. It's all about managing expectations.
But what if it goes even deeper than that? What if the numbers themselves aren't as clean or as straightforward as they look? Well, this brings us to the big reveal, and a really provocative argument from our source material about what it calls the statistics game. The analysis we're digging into kicks off with this very famous and very cynical quote. Now, the point isn't to say that all data is garbage. Not at all. It's more of a warning that we need to be a little bit skeptical and really understand how these numbers are put together in the first place.
And here we get to the core argument from the text we're examining. The claim is pretty bold, that official stats aren't just an imperfect picture of reality, they can sometimes be, and I'm quoting here, massaged. And just so we're super clear, this is the argument from our source material. The author uses the official U.S. unemployment data as a prime example of how this can happen.
So how is this supposedly done? Well, according to the author, it all comes down to who you count and who you don't. The official unemployment rate, for instance, typically only counts people who are actively getting unemployment checks. It often leaves out people whose benefits have run out or folks who've gotten so discouraged they've just stopped looking for work altogether. And here's the kicker. Based on that methodology, if a bunch of people just give up on their job search, the official unemployment rate can actually fall, even if not a single new job was created.
And this slide really drives home the potential difference. The author points to March of 2011. The official unemployment rate that was reported was 8.8%, but by their own calculation, adding back in all the people they say were excluded, they argue the true rate was closer to a whopping 20%. That is a massive, massive difference.
And this critique doesn't just stop with the unemployment rate. The source argues it also applies to that big jobs created number from the NFP report. The argument centers on this statistical tool they use called the birth/death model. It's basically a fancy estimate of jobs created by brand new companies minus the jobs lost from companies that went out of business. The source claims this model is often way too optimistic and can end up artificially boosting the final number.
And there's one last piece to this puzzle, according to the source. It's the revision. You see, that huge headline-grabbing number that moves markets on a Friday morning, it's often just a first guess. Weeks, sometimes months later, that number gets quietly updated or revised. Sometimes the change is huge, but by then the news cycle has completely moved on and almost nobody even notices.
Okay, I know, that is a lot to take in, and it can all sound a little bit dark and cynical. But listen, the goal here isn't to make you distrust everything. Not at all. The point is to turn you into a more critical, more savvy consumer of information. So what do we do about it? Let's build a quick and easy toolkit.
It's really just 3 simple steps. First, always look at the trend. 1 month can be a fluke. What's the pattern been over the last year? Is it going up, down, or sideways? Second, use a simple reality check. Does this official number actually match what you're seeing and hearing in your own life? And third, always ask, who benefits from this story being told this way?
And let's be really clear about this. This whole toolkit isn't about just throwing out official data and yelling, "It's all fake." It's about adding layers of context and critical thought. It's about empowering yourself to look past the easy headline and build your own more complete picture of what's really going on with the economy.
So I'll just leave you with this question to think about. The next time a big economic headline flashes across your screen, what are you going to look for? Will you immediately check the forecast? Will you think about the longer-term trend? Or will you maybe ask yourself, who's not being counted in this number? That right there, that's how you go beyond the headline. Thanks for watching.
All right, today we are going to completely rethink technical analysis. We're going to cut through all the noise, all the complicated indicators, and get right to the core principles that truly successful traders actually use. Principles that, honestly, most people just completely miss.
You know, the legendary investor Sir John Templeton, he just nailed the paradox of trading with this one. The ideas seem so simple, right? But actually putting them into practice consistently, that's where almost everyone struggles. And our goal today is to help you bridge that exact gap.
So let's just start with the biggest problem out there. The way most people are taught technical analysis is, frankly, fundamentally flawed. It actually sets people up for failure before they've even placed a single trade.
This is the big promise, isn't it? This idea that a simple price chart holds all the secrets of the market, that it somehow captures the hopes and fears of every single person trading. It's this really seductive belief that if you just study the past, you can perfectly predict the future.
Okay, but if it's really that simple, then why do the stats show that the vast majority of traders lose money? Well, they end up with charts that are a total mess, just covered in lines and indicators, and they get hit with what's called analysis paralysis. So many conflicting signals, they just freeze up. The answer isn't to add more stuff, it's to start using the right stuff.
And the real reason for all this failure? Well, it pretty much boils down to one huge mistake.
It's like trying to drive a car down the highway while only looking in your rear-view mirror.
See, here's the thing you have to understand. Most of these common tools, moving averages, MACD, Bollinger Bands, they all have one thing in common. They are lagging indicators. They're built using old price data, which means they can only ever tell you what's already happened.
And this visual says it all, right? Relying on those lagging indicators is exactly like driving while staring into that mirror. Sure, it might work for a second, but you're going to crash. It's not a question of if, it's a question of when. You're always just reacting to what's behind you, never seeing the road ahead.
Okay, so if looking at the past is so dangerous, what are we supposed to do? Well, the solution requires a totally different way of thinking. It's not about predicting. It's all about validation.
You have to remember, a market like Forex, it's notoriously manipulated. Big players are always trying to fake out smaller traders. This makes the single most important question you can ask. Is this price move I'm seeing on my screen, is it for real?
And this brings us to what is maybe the most important takeaway of this whole thing. We have to completely redefine our goal. Your job isn't to be a fortune teller, it's not about prediction, it's about validation. You have to learn to validate what's happening on the chart right now because without that, any trade is just a wild guess. All right, so how do we actually do that? How do we get this validation? Well, it all comes down to three things, but one of them is the absolute key that unlocks everything else. And here it is, the one thing so many people ignore, the secret weapon that the legends of trading have been using for over 100 years. It's volume. Price tells you what happened, but volume is what confirms why it happened. It's the ultimate truth serum for the market. I mean, when you really boil it all down, there are only two indicators that actually lead the market, that tell you what's happening right now. The first is price itself. The second is the volume driving that price. When you put those two together, it's like mixing two chemicals. You get this powerful reaction that can show you where the market truly wants to go. Now, right away, I know what some of you are thinking. But wait, Forex doesn't have a central exchange. There's no official volume. And you're right. So here's the solution. We use something called tick data as a stand-in. Instead of counting shares, it just measures market activity, how often the price is changing. And get this, studies have shown it's over 90% accurate at reflecting the real buying and selling pressure. Okay, so we have our two key ingredients, price and volume. But how do we see them in action? Well, you could use a simple bar chart. It gives you the basic data. But a candlestick chart tells a whole story. It's a visual drama of the battle between buyers and sellers, and that's absolutely critical for what we're doing. Okay, let's make this super practical. You do not need to memorize hundreds of confusing patterns. We're going to focus on just three individual candles that act as incredibly powerful early warnings. Now, these are not automatic buy or sell signals. Think of them as the market tapping you on the shoulder and saying, hey, pay attention right now.
First one up is the hammer, and you'll see this one pop up at the bottom of a downtrend after prices have been falling.
So what's the story here? Well, the sellers were trying to keep pushing the price down. But then, bam, the buyers stepped in with some serious force and drove it all the way back up. The name is perfect. It's like the market is literally hammering out a bottom.
So how do you spot one? It's easy. Look for that super long lower wick. It should be at least 3 times the size of the small body on top. And you'll see very little or even no wick at all on the top. It's a clear picture of that buyer comeback.
All right, next up we have the complete opposite of the hammer. This is the shooting star, and it shows up at the top of an uptrend. After prices have been rising, this time it's the buyers who are all excited, pushing the price way, way up. But then the sellers just came in and completely overwhelmed them, slamming the door shut and pushing the price right back down. It's a huge sign that a rally is losing its energy. And the rules to spot it? You guessed it, it's just the exact opposite of a hammer. A long upper wick, a tiny little body at the bottom, and pretty much no wick underneath. It's literally the picture of a failed attempt to go higher.
And for our last one, we have the Long-Legged Doji. This one is all about pure, chaotic indecision in the market.
I want you to think of this candle as an epic tug-of-war. Buyers and sellers are fighting like crazy, pushing the price all over the place to extreme highs and extreme lows. But in the end, nobody wins. They close right back where they started. It means the trend, whatever it was, has just run out of gas. You'll spot this one by its ridiculously small body. The open and close are practically the same price, and these really long wicks on both the top and the bottom, which are usually about equal in length. It's just a picture of extreme volatility where neither side could take control. So look, if you take away just one thing from all of this, let it be this. Stop looking for some magic indicator or a secret pattern. Success in this game comes from a fundamental shift in your mindset. You have to move away from trying to predict the future and start focusing on validating the present.
Because when you start combining these things, the price, the volume, the story inside the candlesticks, you're not just looking at lines on a chart anymore. You're actually reading the market's narrative. So the next time you pull up a chart, ignore all the clutter and ask yourself this one simple question. What story is the market really trying to tell me right now?
Hey everyone, and welcome. All right, let's just get right into it. If you've ever tried your hand at trading, you know the feeling. Staring at a chart that's just covered in squiggly, colorful lines, feeling totally overwhelmed, but also kind of hopeful. You are definitely not alone. So today, we're going to tackle this whole world of technical indicators. You know, those fancy math tools that are supposed to give us an edge, but more often than not, just create a whole lot of confusion. Our mission? To cut right through all that noise and find the real signal. Man, this quote from the legendary investor John Neff just hits the nail on the head, doesn't it? It perfectly captures what we're up against. For decades, traders and mathematicians have been trying to somehow tame this wild, irrational market, trying to find some kind of formula to predict its next move. And that quest, that's what gave birth to this whole universe of technical indicators. And this is where it all begins. A clean, simple price chart. This is the market's raw, unfiltered story. Every single tick, every high, every low, it's all right there. But for a lot of traders, especially when you're just starting out, this just feels, well, incomplete. There's this nagging feeling that you must be missing something. And that hunt for something more, that search for confidence, well, it usually leads traders right into a super common and, yeah, a very costly trap. So, does this look familiar? I bet it does for a lot of you. In the hope that more indicators will magically lead to more certainty, we end up with this, a state of total analysis paralysis. The moving average is screaming buy, but the RSI is like, no way, sell. And the MACD, it's just shrugging its shoulders somewhere in the middle. The end result is just confusion, indecision, and a ton of missed opportunities. Now, what's really interesting here is the analogy our source uses. Indicators are like water wings. Yeah, they can be super helpful when you're just starting out, you know, giving you that sense of security in the deep end. But here's the kicker. The real problem is when you never take the water wings off. They become a crutch, and they actually stop you from ever truly learning to read the market for yourself. So how do we get out of this mess? How do we break free? It all starts with one huge shift in how you look at the charts, a core principle that can bring clarity to all that chaos. This, right here, might be the most important thing you hear all day. Let it sink in. Price is primary. Indicators are secondary. They are just tools, okay? They're in a supporting role, designed to maybe add a little perspective or simplify some info. But they should never, ever be the reason you click the buy or sell button. Your analysis of the price action itself, your brain, has to come first. Okay, so to use these tools right, you gotta know what you're working with. You've got leading indicators, which try to predict the future, and lagging ones, which really just confirm what's already happened. And this is where our source makes a really bold claim. The only things that truly lead the market are price and volume. Period. Everything else, every moving average, every oscillator, the whole shebang, it's all just a fancy way of looking in the rearview mirror. All right, so with that in mind, let's pop the hood and take a critical look at some of the most popular lagging indicators. The goal here isn't to bash them, but to understand what they're really for, and more importantly, where they fall short. First up, we've got the old faithful, the workhorse of technical analysis, the simple moving average, or SMA. It's probably the most basic trend indicator out there. All it's really doing is taking a bunch of past prices, adding them up, averaging them out, and drawing a nice smooth line for you to follow. And you typically see them used in a couple of main ways. On the left, you've got a really short-term average, just kind of hugging the price, giving you a basic feel for the immediate trend. But on the right, you've got something that's super popular, the crossover strategy. When the little line crosses over the big one, you buy. I mean, look at that. It looks so simple, so clean, almost too good to be true, right? But this brings up a huge kind of philosophical question, especially with the big ones, like the 200-day moving average. I mean, the financial news reports on it. So when the price bounces perfectly off that line, is it because of some magical property of the market? Or is it just a giant self-fulfilling prophecy? Is it only working because millions of us and all the big trading bots are all staring at that exact same line and hitting buy at the same time? Something to think about. All right, next up in the toolbox, Bollinger Bands. Now we're shifting from trend to volatility. You can think of these bands like the guardrails on a highway. They expand and contract to show you how wild or how calm the price action is at any given moment. So the promise, the thing they tell you in all the beginner courses, is super simple. Price hits the top band, you sell. Price hits the bottom band, you buy. Easy, right? But then you get the reality check. And get this, it's from the guy who invented them, John Bollinger himself. He flat out warns that price can, and often does, just walk the band in a strong trend, leading to what he calls an excruciating series of losses. Even the creator is telling you it's not that simple.
And last but not least, let's talk momentum. We're looking at the MACD here, a real fan favorite. Indicators like this are designed to be the speedometer for the market, measuring the speed and strength of a trend to tell you if it's running out of gas or just getting started.
But here's the fatal flaw with so many of these momentum indicators. The MACD looks like an absolute genius when the market is already in a huge, obvious trend. The problem is, it's totally useless in a choppy, sideways market, which, let's be honest, is exactly when you need an indicator the most. It'll just whip you back and forth with a constant stream of false signals. Okay, so we've poked some holes in the most popular tools out there. So what does work? Let's switch gears and talk about the one thing, other than price itself, that our source says is a true, real-time, leading indicator. We're talking about volume. And you have to think of volume as the fuel. It's the gas in the market's engine. It's not some complicated formula looking at what happened yesterday. It is a direct, real-time measure of activity and participation. It tells you how many people are showing up to the party, right here, right now. I love this analogy because it makes it so clear. Imagine a big sale at your favorite store. If the prices drop and huge crowds rush in to buy, that's high volume. It confirms there's genuine interest. But what if the store puts up all the 50% off signs and nobody shows up? That's low volume. It tells you that even at these bargain prices, nobody's interested. And the price will probably have to drop even more. Volume gives price its meaning.
Okay, that's the theory, but how do we actually use this? How do we put price and volume together to read the market's real story and see what the big money, the insiders, are really up to? Well, that's the magic of what's called volume price analysis, or VPA. Okay, let's break this chart down together. Look at the volume bars at the bottom there. See how they're climbing? 1, 2, 3, 4, each one getting bigger? Now, look up at that fourth price candle. We've got this massive spike in volume, right? So you'd expect a huge green candle rocketing up. But look, the candle is tiny. It's a dud. What does that tell you? It's a huge red flag. It means sellers have shown up in force at that price and are soaking up every single buy order.
And look what happens right after. Bam! The rally dies on the spot and the price starts to fall, just like we suspected. But here's the next chapter of the story. Look at the volume as the price goes down. See how it's just fizzling out? A real, scary sell-off needs big, scary volume to sustain it. This tells you that the sellers are weak. They had enough juice to stop the rally, but they don't have enough to start a whole new downtrend. That's a level of detail no lagging indicator is going to give you. Now let's flip it around and look at a buying setup. Here, the price is trying to fall, but check out what's happening. We get what's called a hammer candle. See that long tail at the bottom? And we don't just get one, we get 4 of them. Now, the crucial part, look at the volume underneath. It's huge. So what's the story here? It's simple. Every time the sellers try to push the price down, the big players, the insiders, are stepping in and saying, thank you very much, I'll buy that, and pushing the price right back up. This is them quietly filling their bags while everyone else is panicking. So, when you put it all together, our source lays out a really clear 3-step path forward. It's like a roadmap. First, just forget the indicators for a minute and master the language of price itself. Learn what the candles and patterns are telling you. Then, once you've got that, start building your analytical skills, recognizing how price behaves. And only then, way at the end, do you even think about adding an indicator or two, and only as backup singers, never the lead vocalist. And so that really leaves us with one final question. And I want you to really think about this for your own trading. Take an honest look at your charts right now. Are all those lines and colors actually making things clearer? Or are they just noise? Are they just a distraction, keeping you from hearing the simple, powerful story that price and volume have been trying to tell you all along?
Have you ever looked at a financial chart and just seen chaos? A jumble of lines that makes absolutely no sense? Well, hidden in all that noise is actually a story of human emotion, a battle between buyers and sellers. And in the next few minutes, we're going to learn how to read that story, not to predict the future, but to understand what's happening right now.
So when you look at a chart like this, what do you see? For most of us, it's just a mess, right? A frantic scribble of ups and downs that feels totally random, almost, intimidating. But what if there's a language here? What if it's not random at all? And that is the real question, isn't it? Are we just looking at meaningless noise, or is there a story unfolding right in front of us? Turns out, the secret is learning to read the language of the market.
Okay, so let's start decoding that noise. The very first step to making sense of all this chaos, it starts with one kind of counterintuitive insight about how markets actually move.
Here it is, the first big secret. Most people think markets are always racing up or crashing down, but the reality is something else entirely. About 70% of the time, markets are just moving sideways. We call this a congestion phase. They're only in a clear, strong trend about 30% of the time. And here's the kicker. Those quiet, sideways periods are exactly where the market is dropping hints about what it might do next.
So how do we analyze these sideways markets? We need a basic toolkit. And honestly, it starts with just two simple ideas that act like the floor and ceiling of a house.
Take a look at this chart. This is a classic congestion phase. You can almost feel the tension, right? On one side, you have the buyers, the bulls, trying to push the price up. And on the other, you have the sellers, the bears, trying to force it down. They're just locked in this battle for control, and the price is trapped, bouncing back and forth between them.
The first concept we need is called support. The easiest way to think about it is like an invisible floor or a safety net. Every time the price drops to this level, buyers jump in, thinking, hey, this is a good deal, and they push the price back up. It's literally supporting the price.
And the opposite of that? You guessed it, resistance. This is the invisible ceiling. Whenever the price rises to this level, sellers take over. They decide it's a good time to sell and take profits. And all that selling pressure resists any more upward movement, pushing the price back down.
Okay, now let's go back to that messy chart from before. Look what happens when we simply draw those two horizontal lines. Boom. All of a sudden, the chaos has structure. You can clearly see the floor, where the buyers are making their stand, and the ceiling, where the sellers are pushing back. We've just turned random noise into a defined battlefield.
It's really easy to get bored during these sideways phases, but this is where the magic happens. A great way to think about it is that the market is coiling a spring. It's gathering energy for its next big move. The longer and tighter this sideways congestion is, the more explosive the trend is going to be when it finally breaks out.
Eventually, one side has to win the battle. In this case, the buyers have completely overwhelmed the sellers and just smashed right through that resistance ceiling. This is what we call a breakout. And here's the really cool trick. That old ceiling, which was once a major barrier, often transforms into a new floor of support for the next leg up.
And of course, the exact same thing works in reverse. If the sellers win the fight and the price breaks down through that support floor, well, that old floor can become the new ceiling. It'll now act as a level of resistance, making it that much harder for the price to rally back up.
All right, now let's zoom in a little closer. Because within these congestion zones, the price action often forms specific, recognizable shapes or patterns. And each of these patterns tells a different story about that ongoing battle between buyers and sellers.
Yeah, this coiled spring idea is the perfect way to visualize these patterns. As the price bounces between these narrowing boundaries, you can just feel the tension and energy being stored up. And you know how it is. The tighter that coil gets, the more explosive the release is going to be when it finally lets go.
Here are two fantastic examples. On the left, we've got a rising triangle. Notice how the ceiling is totally flat, but the floor keeps creeping higher and higher? That tells you the buyers are getting more and more aggressive. They're building up that upward pressure. Now on the right, it's the complete opposite. A falling triangle has a flat floor, but the ceiling keeps getting lower. That means the sellers are getting more aggressive, and it's a big sign of weakness.
There's also something really powerful about the number 3.
On the left, a triple top shows the market tried to break through that ceiling 3 separate times and failed every time. This is a classic sign of exhaustion, and it often leads to a sharp reversal down. And on the right, you've got its mirror image, the triple bottom. 3 failed attempts to break the floor. That's a huge signal that the buyers are finally taking control.
But what happens when the market isn't just moving sideways? How do support and resistance work when there's already a clear trend going on?
Well, the principle is exactly the same, but instead of being flat, the floor and ceiling get tilted at an angle, creating what we call a channel. In an uptrend, you get a rising floor and a rising ceiling. In a downtrend, they're both falling. The price is still contained, but now the entire house is moving up or down along with the trend.
So, this is where it all comes together. These aren't just a bunch of random separate patterns and lines. They are all just stages in a single, continuous, and repeating cycle.
And here is that cycle in action. It all starts with a trend. Then the price takes a breather. It pauses and moves sideways into a congestion zone. That floor and ceiling get tested and confirmed, and then finally you get the breakout, which kicks off the next trend. In this process, from trend to congestion to breakout, it repeats itself endlessly on every single financial chart, in every single market.
So in the end, a financial chart isn't random noise at all. It's a story about human psychology. It's a map of the collective battle between fear and greed. The patterns are there, the cycle repeats. The only real question left is, are you patient enough to quiet the noise and just listen to the story the market is trying to tell you?
Welcome back. So today, we're not just going to talk about the Forex market. No, we're going to go deeper. We are venturing into what it's really become, a complex, kinda unpredictable, and honestly, a thrilling ecosystem. We're heading straight into the currency jungle. You know, the great Albert Einstein really hit the nail on the head with this one. To win at any complex game, you've got to master the rules, and then you have to play better than everybody else. And trust me, in the world of Forex, that has never been more true.
But, and this is the big but, isn't it? What happens when the rules you learned, the maps you were given, are suddenly useless? What do you do when the playbook you spent all that time studying just doesn't apply anymore? Well, that is exactly what's happened in Forex.
And that gets us to our first absolutely crucial point. The Forex market you see today is a completely different animal than it was even a decade ago. Those good old days of these nice, simple, trending markets, they're pretty much a memory. Now just look at the difference here. It's pretty stark. The old advice, the stuff you read in books from a few years ago, will tell you to just stick to the major pairs and ride those long trends. But if you try that in this new jungle, you're just setting yourself up to fail. The real action, the big opportunities, are hiding in the crosspairs. And those long, easy trends, they've been replaced by a ton of volatility. So we have to adapt. We've got to become, as the source material puts it, fast, agile guerrilla fighters just to survive out here.
So what happened? What ripped up the old rulebook? Well, it's basically 3 massive forces. First, you've got currency wars, which is just a fancy way of saying central banks are messing with their currencies on purpose. Then there's the constant political meddling, especially with a currency like the euro. And finally, the big one, high-frequency trading. We're talking about supercomputers making millions of trades in the blink of an eye. For you and me, the average trader, this means our old strategies can get just completely shredded in an instant. The game has changed, and it's not changing back.
Okay, so if you're going to navigate this new jungle, you have to understand the animals that live in it, right? Every single currency has its own personality, its own behaviors, all driven by its unique economic and political DNA. So let's meet the key players. First up, we've got the heavyweights. The US dollar, of course, is still the world's safe haven. When things get scary, people run to the dollar, and its fate is tied directly to the Federal Reserve. The euro, that's the political upstart. Its moves often make no logical sense. They're driven purely by the political headlines coming out of Europe. The Japanese yen is the classic darling of the carry trade. That's the strategy of borrowing a low-interest currency to buy a higher-interest one. And the pound, well, after all the Brexit drama, it's kind of settled into being the staid, steady one, mostly driven by the health of the UK economy.
All right, next up is the commodity crew. The Australian dollar, you can basically think of it as a proxy for China's economy. Seriously, when China gets a little sick, the Aussie gets a full-blown flu. The Canadian dollar is joined at the hip with its neighbor, the US, and, of course, the price of oil. And the New Zealand dollar?
It's a total magnet for hot money. That's all the short-term cash flying around looking for high interest rates. It's mostly driven by soft commodities like all that dairy they export.
And rounding out our group, we have the specialists. The Swiss franc is easy. Just think safety and security. It is a secure fortress backed up by all that gold. And the Norwegian krone is what I like to call the wealthy underdog. I mean, the country is unbelievably rich because of its oil fund, but the currency is also driven by these really unique things like what's happening in its own domestic housing market.
Okay, so now you know the players. But here's where we really have to break from those old rules. The common advice is to just stick to the big pairs, like the euro versus the US dollar. But if you do that, you are going to miss some of the absolute best opportunities in the entire jungle.
And here's why that is so important. When you only trade the major pairs, almost every single trade you make is just a bet on what the US dollar is going to do. You're basically stuck in one little corner of the jungle, and you're always just reacting to what its biggest, most powerful animal is doing. If you want to find clearer, better trends, you've got to start exploring the paths that fewer people travel. And this is where you can start to see those incredible opportunities. Take the euro versus the pound. It's often called an old-school pair because it can be so predictable, without all the political noise you get with EUR-USD. Oh, and AUD-JPY? That is the ultimate gauge of how risky the market is feeling. When investors are feeling brave, this pair tends to soar. CAD-JPY is a super direct way to trade the price of oil. And AUD-NZD, that's just a fascinating fight between Australia's hard commodities, like iron ore, and New Zealand's soft commodities. You see, these pairs tell their own unique and often much clearer stories.
Now you're ready to explore these other paths, but how do you see the jungle clearly? How do you know if a currency is actually strong or weak across the entire market and not just in one pair? Well, there's an incredibly powerful tool for this, a kind of secret weapon that gives you a 3D view of everything.
It's called the currency matrix. And here's the best way to think about it. Instead of trying to judge a singer by listening to just one song, you listen to their whole album, right? It's the same idea here. Instead of looking at just one chart like Euro USD, you look at the euro against a whole basket of other currencies all at the same time. This little shift in perspective, it's a total game changer. It lets you see if a currency's move is just a small local thing, or if it's a huge market-wide trend.
So how does this actually help you? Well, it answers 3 of the most important questions you can ask. First, it helps you identify the true driver of a move. Is euro/GBP going up because the euro is strong, or is it because the pound is weak? The matrix will tell you. Second, it validates a trend. If you see that euro is rising against all of its peers, well, you can be way more confident that you're looking at a real trend. And third, it helps you find the absolute best pair to trade. It just lights up, showing you which currency pair is showing that strength or weakness the most clearly.
Let's make this super practical. Let's say you think the euro looks strong. Okay, instead of just looking at one chart, you pull up the euro matrix. You check the euro against the dollar, the yen, the pound, the Swissy, and on and on. Now, if the euro is going up on all or even most of those charts at the same time, boom, you've just confirmed that there is genuine, universal buying pressure in the euro. You've proven your idea. So let's just pull this all together. When you understand that the old rules are gone, when you know the personalities of each currency, and when you start using this currency matrix, you are fundamentally changing how you look at the market. You're no longer lost. You're trading with a brand new and much more accurate compass. And look, if there is only one thing that you take away from all of this, please let it be this. Stop getting trapped by the story of a single chart. It's like looking at a 2-dimensional picture of a 3-dimensional world. Your new goal is to start seeing the whole market, the entire jungle, and all of the crazy interconnected relationships happening within it. This whole new way of looking at things just opens up a world of possibilities. It's not about guessing on one pair anymore. It's about finding a theme, like real yen weakness or true Aussie strength, and then figuring out the absolute best way to act on it. So the only question left to ask is, with this new map in your hand, which currency story are you going to follow first?
You know, there's a market out there that turns over more than $6 trillion a day. It doesn't have a central location, it never, ever sleeps, and you're actually a part of it whether you know it or not. So today, we're going to dive into the world's biggest and maybe most misunderstood financial arena, the Forex market.
And we're starting with this quote from the legendary trader Jesse Livermore, because it perfectly sets the stage. See, the Forex market isn't some simple game of chance. No way. It's a really complex system with its own rules and some seriously powerful players. Getting that in your head from the get-go, well, that's your first and best line of defense.
All right, let's kick this off with a simple but kind of profound idea. This market, it's all around us. It's not some abstract thing happening in a far-off corner of the world. Nope, it touches your life directly every single day.
I mean, think about it, right? When you swap some cash at the airport for a vacation, that's Forex. When you buy a smartphone that was made in another country, or even when you just fill up your car with gas that's priced in US dollars, the value of all of that stuff is determined by foreign exchange rates. You're in the game without even placing a trade.
At its very core, that's all it really is. This massive, decentralized marketplace where one country's money is traded for another's. It's the thing that allows international business to happen smoothly, but it's also become the world's largest speculative playground.
So here's where it gets really interesting. Not all the players in this market are created equal. This is not a level playing field. It's more like an arena with a very, very clear hierarchy, from the absolute giants who move trillions all the way down to the newcomers just starting out.
At the very top, you've got the market makers. These are the huge international banks. Then come the multinationals, the companies using the market for actual business. After them, you have the big speculators, like hedge funds. Central banks, they kind of act like referees, stepping in to manage their own currency. And way, way down at the bottom of it all, well, that's the retail trader. That's you. So what does that really mean? It means you're playing on their turf, and you're playing by their rules.
And just to give you a sense of the scale here, just look at how dominant these market makers are. According to our source, just 3 banks, Deutsche Bank, UBS, and Citigroup, control almost half of the entire market's daily turnover. That is an incredible amount of concentrated power.
The source material has this brilliant phrase for them, the 200-pound gorillas. And it's perfect, because they aren't just participating in the market. For all intents and purposes, they are the market. They're the ones creating the prices that pretty much everyone else trades on.
So, this is a crucial point. We have to understand where the price you see on your screen actually comes from. It isn't just pulled out of thin air. It flows down from the very, very top of that food chain we just looked at.
The easiest way to wrap your head around it is to think of it like a wholesaler versus a retailer. The big banks, they're the wholesalers. They trade directly with each other in what's called the interbank pool, and they get the absolute best rock-bottom prices. Your broker? They're the retailer. They go and buy access to those wholesale prices, and then they sell it to you, the end consumer, with a little markup.
And this whole structure leads to a pretty stark reality. Because the market at the top, where those gorillas operate, is completely unregulated, it is incredibly easy to manipulate. You've got maybe 10 banks that effectively control a multi-trillion-dollar-a-day market with no central exchange. I mean, that's a recipe for them to push prices around to suit whatever they need.
Okay, another thing that makes Forex so unique is that it never really closes. It's a continuous 24-hour market that just rolls around the globe. But what's really fascinating is how the entire personality of the market changes depending on what time of day it is.
It literally follows the sun. The trading day kicks off in New Zealand and Sydney, then it moves over to Tokyo, then to London, and finally to New York. And then the whole cycle just starts all over again. It's always open somewhere in the world.
But, and this is a big but, it's not the same market throughout the day. Not at all. The main currencies being traded and just the overall level of activity, it shifts dramatically as the big financial centers of the world wake up and go to sleep. The market's entire personality changes from one session to the next.
And the data. Oh, the data tells the whole story. During the Tokyo session, a staggering 78% of the volume is in the US dollar versus the Japanese yen. Then, just a few hours later, when London takes over, yen trading totally falls off a cliff, and the euro versus the US dollar becomes the star of the show. The market is very local. It focuses on the local currency.
Okay, so we have giant players creating the prices, a structure that's just begging to be manipulated, and a market that never sleeps and is constantly changing its focus. It sounds a little overwhelming, right? And that brings us to the most important question of all. Where do you, the retail trader, fit into this whole thing?
Let's not sugarcoat this. The source is brutally honest about it, and we're going to be too. You are at the very, very bottom of this food chain. You get the last look at prices, you have the least amount of capital, and to the bigger players, you're basically considered fair game.
Now, I know that sounds grim, but don't get discouraged. This is where the story pivots. Because being the underdog, it doesn't mean you're destined to lose. It just means you have to play the game a whole lot smarter.
Because here's the secret weapon. Those 200-pound gorillas, they can manipulate price, but there's one thing they cannot hide, their footprints, and those footprints are volume. Every massive order they place leaves a signature. So by learning to spot these unusual spikes in trading activity, those moments where the volume is just way above average, you can actually see the giants making their move in real time. And that is how you stop fighting against them and start trading alongside them.
So that's the lay of the land. It's a massive, complex, and manipulated market where you are the smallest player. The game is absolutely 100% stacked against you. So the real question is, now that you know that, are you ready to learn the rules to even the odds?
All right, welcome to the Explainer. Today we're going to cut right through all the noise of the global currency market. We're going to focus on the 8 major players that pretty much everyone, traders, investors, or even if you're just curious, really needs to understand.
Look, the world of Forex trading, it can feel totally overwhelming, right? I mean, with hundreds of currencies, the number of trading pairs is just insane, and it is so easy to get lost. But what if I told you that you don't actually need to track all of them? To really get what's going on in the market, you just need to know the main characters. Because the key to today's market isn't about knowing every single currency out there. It's about understanding one pivotal event that just, well, it changed all the rules of the game.
So where do we start? Well, to understand the currencies that matter today, we have to go back to the moment everything was turned upside down.
The 2008 financial crisis was so much more than a stock market crash. It was like a global economic earthquake. And for the Forex market, this meant the old rules, the old predictability were just gone. They were replaced by this new era of massive, and I mean massive, government intervention.
In response, central banks pulled out this really powerful and, frankly, controversial tool, quantitative easing, or QE. This slide here does a great job simplifying a complex idea, but think of it this way. It's essentially a fancy way for central banks to inject huge amounts of new money into their economies that were really struggling.
And this kicked off what many people started calling the race to the bottom. I mean, think about it. Every major economy was struggling. So central banks deliberately tried to weaken their own currencies. A cheaper currency makes your country's exports cheaper for other people to buy, which gives you a competitive edge. But when everybody is doing it at the same time, you just get chaos. And in all that chaos, where does the world turn for some stability?
They turned to one currency that rose above all the rest, not just as another player, but as the benchmark that every other currency was measured against, the US dollar.
Because the US has the world's biggest economy, the dollar is seen as the ultimate safe haven. When fear takes over the market, investors flock to the dollar. When confidence comes back, they sell it for riskier stuff. It's literally the world's risk barometer.
So, the most important point for anyone watching the markets is this. You have to track the dollar's strength. And the easiest way to do that is with the US dollar index, which measures the dollar against a basket of other major currencies.
But here's the catch. And trust me, it's a big one. As you can see on the left, the traditional index, the USDX, has gotten pretty outdated. It's heavily skewed towards European currencies, and it completely ignores major players like the Australian dollar. A more modern version, which you can see on the right, gives a much more balanced and realistic picture by weighting the euro, British pound, Japanese yen, and Australian dollar equally.
And this slide just perfectly illustrates why that matters so much. On the left, you've got the traditional index. But now look at the chart on the right, the newer, more balanced one. See how it gives you a far more accurate picture of the dollar's true strength against its key global rivals? Getting this right is absolutely crucial because a distorted view can lead to some really bad decisions. Take a second to really see how different those patterns can be. Okay, let's move on to the other major players and see how they fit into this new landscape. These are the currencies that challenge, complement, and pretty much react to every single move the US dollar makes. First up is the euro. Now, the euro isn't just a currency. It's a political dream of a unified Europe. This unique origin story makes it incredibly sensitive to political news and rhetoric. Its fate is completely tied to the political will of its members.
The euro has lurched from one crisis to another, and its survival is often dependent on these really dramatic interventions. Nothing captures this better than this famous statement from Mario Draghi, the former head of the European Central Bank. With these words, he sent a crystal-clear message: the political project of the euro would not be allowed to fail.
Next up, we have the Japanese yen, a currency with a real split personality. For decades, its near-zero interest rates made it the go-to for something called the carry trade. That's where investors borrow yen for cheap to invest in currencies with higher interest rates. This makes it act like a safe haven, but remember that whole post-crisis intervention thing? The Bank of Japan is known for stepping in aggressively to weaken the yen to help its exporters.
Then there's the British pound, or sterling. It was traditionally seen as the steady, dependable character in the room, controlled, measured, and relatively predictable. But the Brexit decision threw it into a whole new era of extreme volatility, where its value can just swing wildly on political headlines.
And finally, in this group, we have the Swiss franc. Its entire identity can be summed up in a single word: safety. Backed by massive gold reserves and a famously stable country, the Swiss franc is where money goes to hide during times of extreme global turmoil.
Okay, now let's look at a totally different group of currencies. These are the players whose fortunes are not just tied to central bank policy, but are directly tied to the value of natural resources being pulled right out of the earth. This slide just lays it out perfectly. You can see how each of these three currencies is directly tied to a specific commodity. The Australian Aussie dollar, it moves with the price of gold and iron ore. The Canadian loonie is basically a proxy for the oil market. And the New Zealand Kiwi dollar, that's driven by soft commodities, like dairy.
So, after that whirlwind tour, how do we put it all together? This isn't just some list of currencies, it's a framework for understanding the entire market.
The key takeaway is this: stop thinking of currencies as just codes on a screen. Think of them as characters in a global economic drama. The dollar is the king, setting the tone for everyone else. The euro is the ongoing political saga. The yen is the interventionist safe haven. And the commodity currencies are the pulse of global growth. Each has its own distinct personality.
By understanding these 8 key players and their personalities, you now have a powerful framework for making sense of the Forex market. It helps you cut through the noise and gives you a foundation to build on. And as you watch the global story unfold, it leaves you with one final question to ponder.
Ever look at a currency quote and your eyes just glaze over? All those numbers can look pretty intimidating. Well, today, we're going to change all that. We are breaking down exactly what those numbers mean so you can read them like a pro. Let's get right into it.
So, let's kick things off with a super simple question that actually gets to the very heart of how Forex works. Just imagine walking into a bank and trying to buy $100 using a $100 bill. It sounds ridiculous, right? I mean, you can't trade something for itself. And that one simple idea is the foundation for everything else we're about to talk about.
You see, the foreign exchange market solves this problem by pairing currencies together. The best way to think about it is like a seesaw. As one currency's value goes up, the other one has to go down. And that exchange rate, well, that's the fulcrum in the middle, keeping the whole thing perfectly balanced. Okay, so here's the game plan for this explainer. We've just talked about the currency seesaw. Next up, we'll get into the different kinds of pairs, then how to actually read them, then we'll tackle the super important pip, and finally, we'll break down those two prices you always see, the bid and the ask. You know, you might think that trading only a handful of major currencies would be a bit limiting. But once you start pairing them up, you unlock this huge menu of trading opportunities. Let's break them down into 2 main groups.
So first you've got the majors. Now all 7 of these pairs have one thing in common, and that's the US dollar. These are the most heavily traded pairs on the planet, which means they have the most liquidity, and that makes them a perfect place to start if you're new to trading.
So what about everything else? Well, any pair that doesn't include the US dollar is called a cross-currency pair, or, just a cross. This is where you find pairs like the euro against the Japanese yen, and it's what takes our 7 major currencies and expands them into a much, much wider world of trading options.
Okay, now that we know what the different pairs are, let's learn how to actually read them. I promise it's way simpler than you think. All right, so every single pair has 2 parts. The first currency you see, in this case the British pound, or GBP, that's called the base currency. That's the one you're actually focused on buying or selling. The second currency, here it's the US dollar, is the counter currency. Its only job is to tell you how many US dollars it takes to buy one single unit of the base. Simple as that.
Now, let's tackle the part that honestly trips a lot of people up at first, the numbers themselves. To really understand the price, we first have to understand the pip. It's the most basic, fundamental unit of measurement in all of Forex.
So take a look at this. This is a totally standard quote for the euro versus the US dollar. You see these two prices, 1.30110 and 1.30136. Right now, that might just look like a jumble of digits, but by the time we're done here, you're going to know exactly what this means.
So, what even is a pip? Well, it stands for percentage in point, and it's simply the smallest standard change in the price of a currency quote. Just think of it like the points in the stock market. It's the basic unit we use to track our profits and our losses.
Okay, here's where it can get a little bit confusing, but stick with me. It used to be that brokers would quote prices to 4 decimal places, and that 4th digit was the pip. Now, they often use 5 decimal places, but, and this is the important part, the pip is still the 4th decimal place. That extra 5th digit, that's just a fractional pip. For the most part, you can just ignore it.
Of course, there's always an exception to the rule, right? And in the world of Forex, that exception is almost always the Japanese yen. As you can see from this quote here, the whole format just looks different.
So here's the rule, plain and simple. For almost every pair, like the euro-US dollar we just saw, you look to the 4th decimal place to find the pip. But for any pair that involves the Japanese yen, you only have to look to the 2nd decimal place. That's it. So if the price moves from, say, 99.52 to 99.54, that's a 2-pip move.
So why is the yen so different? Well, this analogy just explains it perfectly. Think about it. A single US dollar is a banknote, a piece of paper. But a single Japanese yen is much closer in value to a coin. Quoting it to 4 decimal places would be like trying to track fractions of a penny. The numbers would just be too small and jumpy to be useful.
All right, we have totally mastered the pip. So now, let's circle back to our original quote and figure out why on earth there are always 2 prices listed, not just one. And this brings us to 3 key concepts: the bid, the ask, and the spread. It's really a simple 3-step idea. The lower of the 2 prices is always the bid price. That's the price your broker is willing to buy the base currency from you. The higher price is the ask. That's the price your broker will sell the base currency to you. And the tiny little difference between those 2 numbers, that's the spread. And that, my friends, is how the broker makes their money.
So if we go back to our euro/US dollar example, the ask price was 1.30136 and the bid was 1.30110. You subtract one from the other and you get a difference of 0.00026. In the language of Forex, that translates to a spread of 2.6 pips.
And here's the key thing you got to remember. The spread is the built-in cost of every single trade you make. It's not that different from the commission you'd pay when you trade stocks. The second you enter a trade, you are immediately down by the amount of the spread.
And I love this way of thinking about it. Starting a trade is like starting a race, but you're giving your opponent a head start. In our example, it's a 2.6 pip head start. The market has to move in your favor by at least that much just for you to get back to the starting line, just to break even.
All right, let's do a quick recap. Currencies trade in pairs, like a seesaw. The first one is the base. The second is the counter. A pip is our unit of measurement, 4th decimal for most, 2nd for the yen. The bid is the price they'll buy it from you. The ask is the price they'll sell it to you. And the spread between them is your cost of doing business. And there you have it. You can now officially look at any Forex quote and understand exactly what it's telling you. But, knowing what the numbers mean is really only half the battle. The next big question is, what makes those numbers move in the first place? We'll save that for another time. Thanks for watching.
Have you ever wondered what really makes the Forex market tick? It's the biggest financial market on the entire planet. And while it's a world of huge opportunity, it's also run by some seriously powerful and often hidden forces. Well, today, we're going to pull back that curtain and show you what's actually going on behind the scenes.
They say if you boil any market down to its core, you're left with just 2 things: fear and greed. Right? It's that constant push and pull between wanting to make a profit and being scared of losing everything. That's the classic explanation. But is it the whole story? When we're talking about the Forex market, is it really that simple? The answer is kinda yes and kinda no. See, there's a whole other layer to this market, a hidden structure that most people just never ever see. So, here's the plan. We're going to start with the Forex market's biggest secret. Then, you're going to meet the 2 groups doing the manipulating, the little guys and the big guys.
After that, we'll get into how to actually read the daily news, and finally, I'll show you the one secret weapon every trader has to see what's really happening.
All right, let's just dive right in. The number one secret of the Forex market isn't some super complex trading formula. Nope, it's the fact that this market is, by its very design, one of the most manipulated markets in the world. And if you want to succeed, you have to understand why.
So what makes Forex so different from, say, the stock market? Well, for one, it's at the absolute center of every other financial market. Two, it's not a market for a product, it is the market for money itself. And because of that, governments use it to steer their entire economies, which, you guessed it, makes it the perfect playground for powerful groups to push their own agendas.
Okay, let's meet the first of these powerful groups. These are the folks working on the ground floor, day to day, minute by minute. These are the micro-manipulators, but you probably know them as the market makers. So who are these guys? Think of them like a cartel, a small club of incredibly powerful banks. And since there's no central place like the New York Stock Exchange for Forex, they basically are the market. They're the ones setting the prices, which then gets sent out to the rest of us through what the source material calls a spider's web of brokers.
And here is their playbook. It's so simple, it's brilliant. Whenever a big news announcement is coming, they have 3 goals. 1, scare you into closing your trades. 2, push the price just far enough to trigger all those stop-loss orders you set up for protection. And 3, trap a whole bunch of new traders who are jumping in on the wrong side of the move. It's a brutally efficient way to make a profit.
Now let's zoom out to the big picture. If the market makers are the micro manipulators, then the central banks are the macro ones. They aren't just making waves, they're moving the entire ocean. They create these huge economic shifts that the market makers then use to their advantage.
You have to understand, the whole game has changed. Before the 2008 financial crisis, the rules were pretty straightforward. Money would flow to the country with the highest interest rate. It was predictable. But after 2008, interest rates around the world just tanked. The old playbook got thrown out the window, and now we're in a totally new era. Some people even call it currency wars.
And here's the most important part. The new job for every single central bank isn't about global harmony anymore. It's about one thing and one thing only: protecting its own economy and its own markets no matter what it takes. It's all about self-interest now, and that drives every decision they make.
Okay, so we know who the players are. Now the big question, how do we actually see what they're doing in real time? Well, the answer starts with the tool they use for cover, the daily economic news.
This right here is an economic calendar. I know, it might look like a boring spreadsheet, but trust me, this is the battlefield. This is where the market makers get all the ammunition they need to scare people, trap them, and take them out of the market.
So when you look at one of these calendars, the first thing you should look for are the red flags. These signal the high-impact news events. This is the stuff that everybody's watching, and it's where you're going to see the biggest, most explosive market moves.
But here's the real secret to reading this like a pro. The market doesn't care if the news is good or bad. It only cares about one thing: surprises. The real fireworks happen when the actual number that comes out is way different from what everyone was forecasting.
And this is a perfect example of something that catches so many new traders off guard. A currency can totally shoot up on what looks like terrible news. Why would that happen? Because the market was braced for a complete disaster, but the news was just kind of bad. And in the world of trading, less bad than expected is often treated as good news.
So, you've got market makers trying to fake you out, you've got central banks playing their own games. How on earth is a regular trader supposed to compete? Well, there is a way. There's a tool that lets you see right through all the smoke and mirrors. To get this, think about a popular item on eBay. You see tons of bids pouring in, right? And the price just shoots up. That high volume of bids proves that the price increase is legitimate. It's a real move, backed by real demand.
Now picture the opposite, a traditional auction where nobody's bidding. To get things going, the auctioneer might fake a bid, from the back of the room. The price goes up, but there's no real activity behind it. Is that price move real? No way. It's a fake move, designed purely to manipulate.
And that's the secret right there. The market makers, they can push prices around all they want. They can use the news as cover. But there is one thing they absolutely cannot fake: the volume. The amount of activity behind a move. Volume always tells the truth.
So it all boils down to this one simple, powerful idea. By watching the relationship between price and volume, you can see when the big money is actually moving.
Your job is just to follow their footprints. It's that simple. Buy when they buy and sell when they sell. So, I'll leave you with this question to think about. Now that you know who's really pulling the strings, now that you know about the market makers, the central banks, how they use the news, and how volume exposes them, how does that change the way you look at the market?
You know, trying to trade Forex can sometimes feel like you're lost in a storm without a compass, right? Well, today, we're going to give you that compass. We're going to build a simple but really powerful framework to help you see the market not as just a bunch of random noise, but with some real clarity. The legendary Warren Buffett once said, if past history was all there was to the game, the richest people would be librarians. And man, he's making such a powerful point here. The market is not a history exam. You can't just memorize what happened before, because the future, it's never a carbon copy of the past.
So, that really begs the question, doesn't it? If just looking backward isn't enough, how are we supposed to understand what's happening right now? And maybe more importantly, how do we even begin to make an educated guess about what could happen next?
For as long as I can remember, traders have been kind of locked in this huge debate, usually falling into one of two camps. You've got your fundamental analysts over here who are all about economic news, and then you have the technical analysts who believe that everything, and I mean everything you need, is right there on the price chart.
It's this really fierce debate, right? But what if it's the wrong debate entirely? What if the real secret, the real edge, isn't about picking a side, but about finding a way to combine them?
Okay, so this is exactly where our three approach comes into play. It's a framework that brings together three critical viewpoints. First, we've got the fundamentals, which tell us why a market might move. Second, the technicals, which show us what the market is actually doing. And third, the relational view, which gives us the full context. And this is the piece that so many traders just miss completely. All right, let's jump right in. Dimension 1, fundamental analysis. This is all about getting to the bottom of the underlying economic story that's pushing a currency's value either up or down.
Now, I know economic story might sound super intimidating, but here's the thing. You really don't need a PhD in economics for this. It honestly just boils down to applying a bit of good old common sense to a few core ideas.
So at its very heart, a country's economy really just rests on three pillars that are all connected. It all starts with employment. When people have jobs, they feel secure, they have money. That feeling fuels the second pillar, consumer spending. And of course, when people are out there buying things, businesses see that demand, and that encourages them to invest and grow, which, you guessed it, creates more jobs. It's a full circle.
But here's the key thing to remember. Economies have momentum. They're like these massive oil tankers. Even after the captain cuts the engines, that thing is going to keep drifting for miles. Economic changes take a long time to actually show up in the numbers. It's a slow, powerful drift, not some speedboat that can just whip around on a dime. All right, on to our second dimension, technical analysis. If fundamentals are the economic story, you can think of technicals as the story of market psychology, the collective hopes and fears of every single trader out there.
So the main idea here, the belief, is that the price chart is basically a map of human emotion. Every piece of news, every ounce of fear, every wave of greed, it's all baked right into the price. For a true technical analyst, the chart is the story. And the language we use to read this story, it's the Japanese candlestick. Each one of these is like a little snapshot. It tells us four key things for any period: where the price opened, where it closed, the highest point it hit, and the lowest point it hit. Just by its shape and color, you can instantly see who won the battle, the buyers or the sellers.
Okay, so here's where it gets really cool. When these candles form specific patterns, they can give us some seriously powerful clues. Take the hammer, for example. You'll usually see this one pop up after the price has been falling for a while. The name is just perfect, isn't it? It literally looks like the market is trying to hammer out a bottom.
So let's break down what's happening inside that one candle. Think of it like a tug of war. For most of the session, the sellers are in complete control, dragging the price way down. But then, bam! The buyers storm back in, they refuse to accept those low prices, and they manage to push the price all the way back up. It's a story of a major comeback.
Now, on the flip side, you have the shooting star. It's the mirror image of the hammer. You'll typically see this form at the very peak of an uptrend, and it's a big warning sign that the rally might be running out of gas. And here we see the exact opposite tug of war. The buyers start out strong, pushing the price to new highs, but they just can't hold on. The sellers jump in with so much force that they erase all those gains and slam the price right back down. It's a huge red flag that the sellers are taking over.
Okay, let's get to our third and final dimension. And honestly, this is the one that so many traders just completely miss. It's called relational analysis, and it's all about context.
So relational analysis is all built on this one simple but incredibly powerful idea. No market is an island. Money is always flowing between different asset classes, stocks, bonds, commodities, currencies, and they're all connected in this giant global web.
A classic example of this? Just look at the relationship between the US dollar and commodities. Think about it. Most major commodities, like oil, are priced in dollars. So if the dollar gets stronger, it actually makes those commodities more expensive for other countries, which can hurt demand and push their prices down. It's why they often move in opposite directions.
And we see this inverse relationship even more clearly when you put the US dollar up against gold. When investors are feeling good about the economy, they might prefer the dollar. But when fear kicks in, they often flock to the safety of gold. So by watching one, you can get some really valuable clues about the other. It's all about context.
So, okay, we've gone through these 3 different dimensions. What's the payoff? Why does this all matter when we bring it all together?
Here's the most important takeaway. Think of each of these analytical styles as a single strand of a rope. Yeah, one strand is pretty strong on its own, but when you braid them together, the why from fundamentals, the what from technicals, and the context from relational analysis, you create something that is far, far more powerful. It's practically unbreakable.
And there you have it. That's your complete 3-dimensional framework. You get the underlying economic story, you get the real-time read on market psychology, and you get the bigger picture of how everything is connected. Instead of just seeing one little piece of the puzzle, you're now seeing the entire board.
So I'll leave you with this one question. Have you been looking at the market in flat 2-dimensional terms? Are you ready to add that crucial 3rd dimension and start seeing the whole picture? So let's approach financial charts a little differently today. I want you to stop seeing them as just a confusing mess of lines and instead see them as a crime scene. And you're the detective. You're looking for clues that tell you what's really going on.
Because this, right here, this is the one question that every single trader on the planet asks themselves every single day. It's the multi-million-dollar question, isn't it? And finding a reliable way to answer it, well, that's the holy grail.
The problem is that most of the tools traders use are, well, they're lagging. They're built on what's already happened. So they're great at telling you where the market has been, but not so great at telling you where it's going. It's kind of like trying to drive a car forward by only looking in the rearview mirror. It's not a great strategy.
But what if there was a way to see the market's intention? Not yesterday, not an hour ago, but right now. Well, there is. And it's not some newfangled thing. It's a century-old secret used by the absolute giants of trading. We're talking Jesse Livermore, Richard Wyckoff. Back then, they called it tape reading. Today, we call it volume price analysis, or VPA for short.
So, how do we start our detective work? Where do we even begin? It all starts with one fundamental clue, the absolute bedrock of this entire method. You have to understand the relationship between effort and result.
The core law here is actually pretty simple. Just think of volume, all the buying and selling, as the effort being put into the market. And the price movement you see on the chart, that's the result. Now, for a move to be legit, the result has to match the effort. It just makes sense, right?
Richard Wyckoff, one of the godfathers of this technique, put it perfectly. He said, if you have a lot of volume, you should see a lot of move. If you don't, why? And that why, that's everything. That's the moment you put on your detective hat. That mismatch, that's your first big clue.
And this concept isn't just for markets. It happens in the real world all the time. Think about a huge department store sale. Prices get slashed, and massive crowds, that's our volume, rush in. High volume confirms that big price drop. Or flip it around. Think of an exclusive car launch. The price is high, maybe even rising, because the demand, again the volume, is through the roof. In both cases, the amount of activity totally validates what's happening with the price.
So on any chart, this whole idea, it really just boils down to spotting one of 2 key signals. That's it. It's either agreement or it's disagreement.
And it really is this simple. You've got agreement, where you see a big price move on high volume. That tells you, okay, this move is healthy, it's valid. And then you have disagreement. That's when volume and price are telling you 2 completely different stories. And that, my friends, is a massive warning signal. It's the market whispering in your ear that something's not quite right.
And here's the crucial part. While agreement is nice, it just confirms what you can already see. It's the disagreement that's the golden nugget. That's the real opportunity. An anomaly like that, it's like a footprint left behind by the big players, the smart money. It's your clue that the current story is about to change. And that's exactly where a sharp detective wants to be.
All right, enough theory. Let's get our hands dirty. Let's put on our detective hats and see how this actually works on a live chart. This is where all those clues really come to life. Okay, so we're looking at a 15-minute chart of the Australian dollar versus the Japanese yen. Now, I want you to focus your attention on just two specific candles, the ones I've marked as Candle 1 and Candle 2.
First up, let's look at Candle 1. See that big, long red candle? That's a huge, decisive drop in price. Now, look straight down at the volume bar below it. It is massive, way above average. The huge effort perfectly matches the huge result. This is a textbook, crystal-clear case of agreement. That downward move is for real.
But now, what about the very next candle? This is where our investigation gets really, really interesting. What happens when the story the volume is telling doesn't line up with the story the price is telling?
Okay, now shift your eyes to Candle 2. Look at the volume bar. It is just as high as the one before it. The effort is identical, but look at the result. The candle itself is tiny, with this long tail or wick at the bottom. And that wick tells us everything. It shows us that prices tried to go lower, but buyers stepped in so aggressively that they pushed the price all the way back up. All that selling effort was absorbed and overwhelmed. This is a huge disagreement, a massive clue that the sellers are running out of gas and a reversal could be right around the corner.
So now that we know what clues to look for, we need to know the most likely place to find them. See, these clues don't just appear randomly. They tend to show up at very specific locations on the chart.
And this might surprise you, but markets spend about 70% of their time, yes, 70%, not rocketing up or plummeting down, but just moving sideways. We call these congestion zones. You know, a lot of traders get so frustrated by these sideways markets. They see it as boring, a total dead zone. But with our new detective's lens, we see it completely differently. These zones are the spawning grounds for the next big trend. This is where the market is coiling up like a spring, just building up energy for its next major move. So as the market moves sideways, it starts to establish these clear boundaries. It creates a price ceiling that it just has trouble breaking above. We call that resistance. And it creates a price floor that it has trouble falling below. We call that support. The price just kind of bounces between these two levels, waiting. Now, this house analogy is probably the best way I've ever heard to understand how these levels work. Imagine you're on the ground floor of a house. The ceiling above your head, that's resistance. Okay, now imagine you break right through that ceiling and you're standing on the next floor up. What happens? That very same structure that was once your ceiling is now the floor beneath your feet. It has become support. And that simple idea that resistance becomes support is absolutely fundamental to understanding how markets move.
Okay, let's bring all our clues together. We've gone over a lot, but what's the ultimate takeaway here? How does all this really change the way you look at a chart from now on?
So here's the bottom line. Volume price analysis, it's not a crystal ball. It's a leading indicator that helps you shift the odds into your favor. It gives you a peek into what the big players, the insiders, are doing right now, because volume is the one footprint they just cannot hide. It helps you validate trends, tell the real moves from the fake ones, and maybe most importantly, it gives you the confidence to actually hold on to your winning trades.
So the next time you pull up a chart, you've got a choice. You can see it as just a bunch of random wiggles and take a wild guess at what might happen next. Or you can look at it like a detective, using volume and price to read the clues and finally understand the real story the market is trying to tell you.
All right, today we are pulling back the curtain on Forex trading. We're going to get right into the nitty-gritty of what actually happens when you place a trade, and we'll look at how traders take these teeny tiny price changes and, well, try to turn them into real money using some seriously powerful and seriously risky tools. So let's just start with the biggest question right off the bat. When you look at a currency pair, the price moves by fractions. I mean, fractions of a penny. So how in the world is anyone supposed to make any actual significant money from that? It seems kind of impossible, right?
Well, for the average person, it pretty much is impossible. I mean, think about it. If you took $1,000 and exchanged it, and the rate moved just a little bit in your favor, you might make enough profit to, what, buy a coffee? Maybe.
To make these microscopic movements mean something, traders need a very special kind of tool. Let's put some real numbers on this. Imagine you make a $1,000 trade on the US dollar versus the Japanese yen. The market moves in your favor, hooray! And your profit is, drumroll please, $4.90. Yep, not exactly the high-flying, fast-paced world you see in the movies, is it? So how do we get from $4.90 to something, well, a bit more exciting? The answer is a hugely important concept called leverage. But as you're about to see, this thing is a classic double-edged sword. So what is leverage really? At its core, it's pretty simple. It's a loan from your broker. It's a tool that lets you control a much, much bigger pile of money in the market than you actually have in your account. It magnifies your trading power, and, as we'll see, it magnifies everything else too. Probably the best way to wrap your head around leverage is to think about a mortgage on a house. You put down, say, 20%, but you get to control 100% of the property. That's 5-to-1 leverage. Now, in the world of Forex, oh boy, we're talking 50-to-1, 100-to-1, sometimes even more. It's like a mortgage on steroids. Okay, so let's go back to our sad little $4.90 trade. Now, let's apply 100-to-1 leverage. Suddenly, your $1,000 deposit is controlling a $100,000 position. That same tiny market move doesn't get you pocket change anymore. It gets you $490. Now we're talking. That is the incredible power of leverage. But, and this is a huge but, here's the sharp side of that sword. That awesome $490 profit, it could have just as easily been a $490 loss if the market had moved against you by that same tiny amount. Leverage doesn't care if you're winning or losing. It just makes everything bigger. So if leverage is this incredible financial superpower, what's the price of admission? What's the catch? Well, that brings us to the next critical piece of the puzzle, margin. Margin is basically the security deposit you have to put down to get that leverage loan. It's your own cash set aside by your broker to prove you have some skin in the game. It's not a fee you pay. It's your money, held as collateral to protect the broker in case your trade goes south. So let's see what happens when it all goes wrong. You start with $1,000 in your account. You open a leveraged trade and your broker sets aside $100 of that as used margin. But then the market turns against you. You're down $500. Your account's real-time value, your equity, is now only $500. The loss gets worse. Now you're down $900. Your equity has tanked to just $100, the exact same amount as your used margin. Alarms go off. Your broker's system steps in and automatically closes your trade. That, my friends, is a margin call. It's game over for that position. And you really need to understand what this means. Our source author, Anna Coulling, just nails it with this quote. A margin call isn't just a losing trade. It's a catastrophic failure of your risk management. It's a blaring red light telling you to stop everything you're doing and figure out what went so terribly wrong. Okay, we've covered the power and the peril. Let's shift gears now and get into the practical side. How do we actually measure all these little price movements and, translate them into actual cash? Well, it all comes down to two funny-sounding words, pips and lots. A pip is basically the tiniest possible price change for a currency, that little fraction of a cent we've been talking about. And a lot is just the standardized size of your trade. The lot size you choose decides how much real money each one of those pips is worth. And here's the simple breakdown. If you trade a standard lot, every time the price moves by one single pip, you make or lose about $10. Trade a smaller mini lot, and each pip is worth about $1. Go even smaller with a micro lot, and a pip is just 10 cents. This is so important because it lets you calculate your potential risk and reward down to the penny before you even click the trade button. So we've gone through all the mechanics, right? The how-to part. But I gotta be honest with you. The most important part of trading has nothing to do with any of that. It's about what's going on between your ears. It's all about having the right mindset. This right here, this is the absolute core difference between an amateur and a pro. New traders are totally fixated on the upside, on how much they could make. But professionals, they are obsessed with the downside, with how much they are willing to lose. They know that if they protect their capital first, the profits will eventually follow. And this is a really tough pill for a lot of people to swallow. You've got to stop thinking about hitting a home run and making thousands of dollars. Look at it this way. If you start with a $1,000 account and at the end of the year you've made $520 profit, that's a 52% return on your capital. Do you have any idea how good that is? That would put you in the same league as the best professional fund managers on the planet. Success is all about percentages, not big dollar signs.
And that brings us to this simple little equation, which is maybe the most important takeaway from this whole explainer. If you can prove that you can be consistent and generate steady percentage returns, even small ones, on a small account, then making more money is just about scaling up your capital. Consistency plus percentage returns. That is the real path to building wealth over time.
So I'll leave you with this one question, and it's something you really have to ask yourself. When you think about trading, are you focused on the dollars or are you focused on the percentages? Are you chasing that quick, flashy win, or are you building a disciplined, repeatable process for the long haul? Because your answer to that question, well, it will define everything.
Let me ask you something. What if I told you the #1 rule in trading has almost nothing to do with making money, and that it has everything to do with not losing it? It sounds completely backwards, I know, but it's the fundamental secret that separates the traders who last from those who just burn out.
So think about it. What is the single most important goal when you're trading? I mean, the obvious answer, the one everyone jumps to, is to make a ton of money, right? To hit that one trade that changes everything. But what if focusing on that prize is actually the fastest way to lose the entire game?
You know, the legendary trader Jesse Livermore absolutely nailed it with this quote. He said the real damage, the kind that hurts your bank account and your spirit, doesn't come from just being wrong on a trade. It comes from refusing to accept it. It's that stubborn refusal to take a small loss that turns into your biggest enemy.
And this brings us to a really core idea in trading. It's one that feels completely wrong at first, but trust me, it's the bedrock of success. We're going to call it the trading paradox.
Okay, so here's the paradox in a nutshell. Your main job as a trader is not to chase massive profits. It's to play world-class defense. It's about being absolutely obsessive about protecting your money, about minimizing your losses on every single trade. And the profits? Well, they're just what happens when you're good at not getting knocked out of the game.
I love this saying. It puts it so perfectly. You've probably heard the old phrase, look after the pennies and the pounds will look after themselves. Well, the trader's version is this: look after the losses and the profits will take care of themselves. Your capital, your money, is the most important tool you have. Protect it first, and the growth, it'll follow.
Now look, this isn't just some feel-good philosophy. It's all based on cold, hard math. Let's actually break down the numbers, because when you see them, you'll understand why playing defense is completely non-negotiable.
So, let's imagine you start out with a trading account of $1,000. A nice, clean, round number. All right, so your first trade, it doesn't go your way. It happens. You stick to your plan, you take a small, manageable 10% loss. That's $100, no big deal, right? You're still in the game.
So, your account balance is now sitting at $900.
But here is the million-dollar question. To get back to where you started, back to that original $1,000, what percentage gain do you need now? I mean, you lost 10%, so you just need to make 10% back, right?
Nope. To get that $100 back, you now need to make an 11.1% gain on your new, smaller account. Just think about that for a second. That small loss has already put you in a deeper hole than you thought, and now the math is actively working against you.
And believe me, this problem gets worse, like exponentially worse. If you lose 20%, you need a 25% gain just to get back to even. But look at this one. If you lose 50% of your account, you now need a 100% gain. You have to literally double your remaining money just to get back to where you started. That's not a trading strategy, that's a lottery ticket.
And that right there, that is the reason why. It's why keeping losses small isn't just a good idea, it is the absolute prime directive of trading. Because the math of trying to recover from big losses is a brutal, unforgiving opponent that you just cannot afford to go up against.
Okay, so the why is pretty clear. The math doesn't lie. So the next logical question is, how do we actually put this into practice? Let's talk about a few simple, powerful rules for financial survival.
All right, here are 3 rules to live by. First up, the 1% rule. Super simple. Never risk more than 1% of your entire account on any single trade. This makes sure that no single loss can ever take you out of the game.
Now, the 5% rule is kind of like a modification for smaller accounts that are really focused on growth. And finally, the 10% rule is your ultimate safety brake. You should never have more than 10% of your total capital at risk across all of your open trades at any given time.
So why the different rules? Why would you risk a bit more on a small account? Well, think of it this way. A small account is like a startup. Its main goal is aggressive growth. So it can take on a little more calculated risks to get there. A large account, on the other hand, is more like a big, established company. The focus isn't on explosive growth anymore. It's on protecting what you've built and generating steady income. The whole strategy just evolves. Of course, knowing these rules is the easy part, right? Actually following them when things get stressful, that's a different story. And this brings us to what is easily the biggest challenge for every single trader, the psychology of losing. This is one of the deepest truths in all of trading. You have to learn how to lose correctly before you can ever learn how to win consistently. And what does that mean? It means you have to get to a place where you can accept a small, planned loss as nothing more than the cost of doing business. It's an expense. You have to master losing calmly before you can ever win big.
And this right here is the fundamental difference between a professional trader and a gambler. For the pro, a loss is just data. It's a business expense. They look at it, they learn what they can from it, and they move on to the next trade. But for the gambler, a loss feels like a personal attack. It makes them angry, and it triggers that really dangerous desire to get it back from the market. And you know, this is where you have to be brutally honest with yourself. Trading is really a game you play against your own emotions. If you can't handle being wrong, if you can't take a small hit and just move on without it ruining your day, then this might not be the right arena for you. And you know what? That is perfectly okay. So let's bring this all home. Let's focus on the one thing that matters more than anything else, your single most precious asset in this entire game. So this is what it all comes down to. Your trading capital, your money, is the lifeblood of your business. It's your oxygen. If you run out of it, you're out of the game. It's that simple. So that makes survival your #1 job. The longer you can just stay in the game, the better your chances of eventually succeeding. And that means you have to completely shift your focus. You have to stop asking, how much can I win on this trade, and start asking, how much am I willing to lose?
So I'll leave you with this one question. The next time you're about to make a decision, in the market or anywhere in life, which voice will you listen to? Will you be mesmerized by the potential win, or will you be grounded by the acceptable loss? I promise you, your answer to that question will make all the difference.
So you want to build a trading plan. A lot of people hear that and think it means writing up some super strict, mechanical set of rules. But honestly, a really effective trading plan, it isn't a rigid document at all. Think of it more like a personal framework, a guide that's built for you, your goals, and your life. Let's really break down what that means.
You know, there's this common myth that a trading plan is some kind of secret code, right? A magic formula that just prints money. This idea that you can just blindly follow a few steps and get rich is, well, it's super appealing, but it's just not how successful trading actually works in the real world. And this, right here, shows the difference perfectly. On one side, you've got the black box system. It's totally mechanical. And yeah, it might work for a little while if the market conditions are just right for its algorithm, but eventually, it always breaks down. On the other side is your trading plan. It's flexible, it allows you to make decisions, and it adapts, because let's face it, the market is always changing.
So here's our game plan for building that flexible framework. We're going to start by totally busting that black box myth and introduce a really simple analogy, thinking about trading like you're driving a car. Then we'll hit 2 non-negotiable survival rules and the simple math behind them. After that, we'll get into choosing a personal approach that fits you, and we'll finish up with an actionable 10-step blueprint to put it all together. Okay, let's kick things off with a really powerful way to think about all this. The analogy is simple. Trading is a whole lot like driving a car on a long road trip. Just think about it. When you're driving, you don't just set one speed and stick to it, right? Of course not. You react to the road and the weather. Those are your market conditions. You adjust your speed. That's you using your discretion. But some rules, they're totally non-negotiable. Like, driving on the correct side of the road. And trying to use a rigid black box system, well, that's like leaving the cruise control on in the middle of a rainstorm during rush hour traffic. Sooner or later, you're going to crash.
So, just like driving has a few hard and fast rules, your trading plan needs a solid foundation. And it's built on 2 simple, unbreakable rules that are designed to protect you first and foremost.
Rule number 1. This is your seatbelt, and it is absolutely non-negotiable. Every single trade you enter, and I mean without exception, has to have a stop loss. This is your #1 safety mechanism.
It's what prevents one bad decision from turning into a total catastrophe.
And rule number 2 builds right on top of that. You have to decide on a small, fixed percentage of your total capital that you're willing to risk on any one trade. Usually this is somewhere between 1 and 5%. This ensures that no single trade can ever wipe you out. This is what keeps you in the game.
And this is exactly why those 2 rules are so important. You have to think about it this way. Your trading capital isn't just a number on a screen. It's your ticket to opportunity. It's the lifeblood of your entire trading business, and you have to protect it like it's the crown jewels.
Okay, so we've got our 2 core rules down. Now let's connect them to the real world of charts and prices. We're going to see exactly how these rules tell us how large our trade should be. It's all about the math.
To really see how this works, just look at these 2 charts. They're for the exact same currency pair. On the left, you've got a 5-minute chart, and the price might only move in a 10-pip range. But on the right, on the daily chart, you're seeing a range of almost 150 pips. The crucial point here is that your risk, and therefore your stop loss, has to be relative to the time frame you're playing on. A short-term trade needs a tight stop, but a long-term trade needs a lot more room to breathe.
And this brings us to this key concept of position sizing. And it's actually a really simple kind of backwards process. You don't just guess your trade size. No way. You calculate it based on your capital, your risk percentages, and where your stop loss needs to go. Your rules tell you your position size, not the other way around.
Let's make this crystal clear with a quick example. Okay, imagine you've got a $1,000 account. You've decided on rule number 2, so you're risking a maximum of 2% per trade, which comes out to 20 bucks. And based on your chart, you figure out that your stop loss needs to be 50 pips away from where you get in.
So how do we figure out our position size from there? Well, the math is incredibly simple, as you can see. You just take your maximum dollar risk, that's our $20, and you divide it by your stop loss distance in pips, which is 50. And boom, the result tells you the maximum value per pip you can have on this trade.
In our example, that comes out to 40 cents per pip. Now in Forex, one of the smallest trade sizes is a micro lot, and that's worth 10 cents per pip. So if your risk limit is 40 cents a pip, your maximum position size for this specific trade is exactly 4 micro lots. See? No guesswork. The rules just gave you the exact answer.
All right, now that you get the unbreakable rules and the simple math behind them, the next step is building the rest of the plan around you. This is all about finding a trading style that actually fits your personality, your schedule, and your life.
You know, for most people just starting out, taking a longer-term approach is often the smartest move. And why is that? Well, for one, it's way less stressful than being glued to your screen watching every little price tick. It also lets you learn and get experience while keeping the security of your full-time job. Plus, it naturally helps you avoid the temptation to overtrade, and it keeps your transaction costs way down.
And this piece of advice right here is worth its weight in gold. Seriously, don't quit your day job to become a trader. The pressure of having to make money from trading just to pay your bills is one of the fastest ways to force bad emotional decisions. Let your job support you while you learn how to do this right.
All right, we've covered the philosophy, the rules, and the math. Now, let's put it all together. Let's make it super practical with a clear 10-step blueprint you can use to build your very own trading plan.
Okay, first up, steps 1 through 5. Number 1, decide on your starting capital. And this has to be money you can truly afford to lose. 2, be honest with yourself about your time and life commitments. 3, choose your general approach. Are you going to focus on charts, on news, or a mix of both? 4, match your trading style to your personality. And 5, set non-financial goals. Don't aim for a dollar amount. Aim for being consistent with your process.
Now for the back half, steps 6 through 10. 6, define your risk percentage per trade. That's your unbreakable rule number 2. 7, figure out what a good trade setup looks like to you. What are your signals to get in? 8, plan how you're going to manage and get out of your trades. 9, do your homework and pick a good, reputable broker. And finally, step 10, just get started. Place your first trade using the smallest size you possibly can, just to get some real-world experience without any major risk.
And one last crucial piece of advice, keep a trading diary. Write down what you did, why you did it, and what the result was. Taking screenshots of your trades is a game changer too. Trust me, this diary will become the single most valuable teacher you'll ever have. It'll show you exactly what you're doing right and what you're doing wrong.
So just remember, this plan you're about to build isn't set in stone.
It's a living, breathing document. As you learn more, as your skills get better, and as your life changes, your plan should change right along with you. It's your personal roadmap, and it's meant to guide you for your entire journey.
We've laid out the entire framework for you, from the core philosophy all the way to the actionable steps, so the only question left is this. Now that you have the blueprint, what's going to be the very first step you take to build your plan?
You know, when it comes to trading, we spend so much time studying charts, right? We're analyzing fundamentals, trying to perfect our strategies. But what if the single biggest key to success isn't something you can find on a screen, but it's actually inside your own head? Today, we're diving into the psychology that really decides whether you win or lose in the markets.
The legendary trader, Bruce Kovner, just nails it with this quote. This one idea gets right to the heart of the problem. See, trading isn't just about math. It's a battle against our deepest, most basic instincts, especially that instinct to take every single loss personally. It's the difference between seeing a loss as a piece of data versus an emotional gut punch that can wreck your whole game plan.
So let's start with this big question. We're always taught to see the market as the enemy. You know, it's unpredictable, it's volatile. But the experts we're looking at today make a really bold claim. The real fight, the one that actually matters, is the one happening right between your ears.
I know it sounds a little dramatic, but in the high-stakes game of trading, your own mind, with its ancient survival programming, can absolutely be your own worst enemy. Let's break down exactly why that is.
According to our source material, traders are basically haunted by what's called the unholy trinity of fears. First, there's the obvious one, the fear of taking a loss, which just feels like a personal failure, right? Then there's the fear of missing out, FOMO, seeing a big move happen without you, which makes you jump into bad trades. And then there's the third one, and oh man, this is the one that destroys most traders, the fear that a winning trade will turn into a loser. It's what makes us sell way too early and leave a ton of money on the table.
So, where do these powerful, decision-destroying fears even come from? Well, the answer isn't in some trading book, it's deep in our evolutionary biology. We're literally walking around with brains that were built for a completely different world.
A really simple way to understand this is something called the triune brain theory. It basically models our brain as 3 different layers, each one evolving at a different time, and all of them are just kind of crammed together in our skulls. And here's the catch. They do not always get along. First, you've got the ancient reptilian brain. It's just handling the basics, breathing, heart rate, it's the autopilot. Then, layered on top of that, is the limbic system. This is our emotional core, and its main job is to constantly scan for danger and get ready to hit the fight or flight panic button. And finally, you have the star of the show, the neocortex. This is our modern, rational, logical brain. It's the part we think is in charge when we're placing a trade.
But here is the massive problem. In moments of stress, like say when you're in a trade that's going against you, these parts of your brain go to war. It's a full-on internal battle between your ancient survival instincts and your modern logical mind. And when the wrong side wins, you lose money.
See, deep inside that emotional limbic system is a little thing called the amygdala. Think of it as your emotional bodyguard. It's incredibly fast, totally instinctive, and it only cares about one thing, survival. It's always asking, am I safe? Meanwhile, your neocortex is the cool-headed analyst. It's slow, it's logical, and it's asking, what does the data tell me? So when the market gets crazy, who do you think reacts first?
And this right here just perfectly sums up the problem. A red candle on a chart is not a life or death threat. But to your ancient amygdala, that sudden drop in your account balance might as well be a saber-toothed tiger leaping out of the bushes. It literally cannot tell the difference, so it triggers the exact same panic response.
As Dr. Bruce Hong points out, we humans have this unique and kind of terrible superpower. We don't even need a real tiger. Just the thought of a trade going wrong is enough to flood our bodies with adrenaline and cortisol, which basically shuts down our rational brain and hands the controls over to the part of us that just wants to run away.
Okay, so it sounds like we're just wired for failure, right? Is that it? Well, no, not at all. Recognizing the enemy is the first step to winning the war. So now let's get into a practical toolkit for taking back control.
This brings us to our first rule for taming that emotional brain. It's so simple, but I promise you, it is a complete game changer.
You have to take money out of the equation. The second you say, I'm up $100, your brain's emotional centers light up. You start thinking about what you could buy with it, which leads to greed, and then comes the fear of losing it.
But what if you say, my position is 10 pips up? That's just data. It's a boring, neutral statement of fact that keeps your analytical brain in the driver's seat. All right, on to rule number 2. This one is all about the incredible power of the words you choose, both in your own head and when you talk about your trading.
Stop using the words winning and losing. Just think about sports for a second. Those words are tied to the highest highs of euphoria and the lowest lows of devastation. You do not want that emotional roller coaster in your trading day. Instead, use neutral words. Up and down are just directions. They describe a process, not your personal worth. It seems like a small change, but it keeps your emotions on a much more even keel.
And that brings us to our final rule. This is a powerful little mental trick you can use the instant you feel that panic starting to bubble up.
The moment a trade starts to go against you, your gut instinct is to freak out. Instead, you have to force your first thought to be, how interesting. See what that does? It's not an emotional reaction, it's an analytical question. By framing a potential threat as a point of curiosity, you're tricking your brain. You're forcing your logical neocortex to engage and analyze the situation, which overrides the amygdala's urge to just hit the eject button.
But does any of this stuff actually work in the real world, when the pressure is truly on? Let's put it all together with a perfect example of someone who won the game, not by getting rid of fear, but by managing it.
This is Captain Sully Sullenberger, describing the moments right after his plane lost both of its engines. He felt absolute terror. He didn't magically turn into a robot, he was a human being, and his amygdala was screaming that this was a life or death emergency.
But what happened next? That's the key. You see, Sully had spent thousands of hours in flight simulators, rehearsing emergency procedures over and over and over again. His analytical training was so deeply burned into his brain that it just kicked in automatically, and it completely overrode his emotional reaction. His neocortex had a plan, and it took charge.
And that really is the ultimate lesson here. The goal is not to become some emotionless trading robot. That's impossible. The goal is to accept that fear is going to show up to the party and to have a rehearsed analytical plan ready to go when it does. Your trading rules, your risk management, those are your flight simulators.
Look, that ancient, survival-focused part of your brain is never going to sleep. It is always on guard, always looking for tigers in the charts. So the real question you have to ask yourself is, have you trained your analytical mind to be ready? Because when the pressure is on, who's really going to be in control?
If you're getting into Forex, you're probably, laser focused on charts, strategies, all that stuff. But listen, the single most important decision you're going to make happens way before you ever place a trade. It's picking your broker. This is the one trade that can literally make or break your entire career. So let's make sure we get this right.
We all know the market is a wild beast, right? The famous economist John Maynard Keynes put it perfectly. The market can stay crazy way longer than you can stay in the game financially. And we accept that risk. It's part of the challenge. It's you against the chaos of global finance.
But what if the market itself isn't actually your biggest enemy? What if the real danger, the biggest threat to your trading account, is hiding in plain sight, somewhere you would never think to look? That's right, your broker, the very company you've partnered with, the one you trust with your hard-earned money, might secretly be betting against you. It sounds crazy, I know, but for some of them, it's just how they do business. So let's pull back the curtain on this. Let's really dig into this secret conflict of interest, because understanding how this works is absolutely crucial if you want to protect your capital. See, when you click that buy or sell button, your order goes down one of two paths. It can go to what's called a dealing desk, which is basically run inside the broker's own office. Or it can go through a non-dealing desk, connecting you straight to the real, wider market. And that one little detail, well, it changes absolutely everything. Okay, so brokers who run a dealing desk, they often split their clients into two groups. You've got the A book for the handful of traders who are consistently profitable. Their trades get passed along to the real market. But then there's the B book, and that's where most retail traders end up. For these clients, the broker doesn't pass the trade on. They just take the other side of it. So when you lose a trade, they win your money directly. So you might be asking, why would they do this? Well, the numbers tell the whole story. Regulators actually force brokers to publish this data now, and it's pretty shocking. Somewhere between 75 and 80% of all retail traders lose money. That's a brutal, honest-to-goodness fact of trading you have to know. And because of that incredibly high failure rate, The B-book is basically a gold mine for the broker. They're playing the odds. They're betting on the fact that you, like most people, are going to lose. And for them, statistically, it's an incredibly safe bet to make. The house almost always wins. But what happens if someone on the B-book actually starts winning consistently? Well, that's when things can get, let's just say, a little shady. We're talking about things like stop hunting, where the price mysteriously spikes just enough to take out your stop loss, or sudden requotes that mess up your entry, or, my personal favorite, the platform conveniently freezing right during a huge news announcement. All of it is designed to tip the scales back in their favor. Okay, that was a lot of doom and gloom. But here's the really good news. You can avoid all of this pretty easily. You just have to know what you're looking for. So let's meet the 4 main types of brokers so you can find a real partner, one who's actually on your team.
First up, we have the ECN broker. Honestly, this is the gold standard. ECN stands for Electronic Communications Network, and it means you get direct access to the interbank market. You're trading against other traders, banks, and institutions. Your broker isn't on the other side of your trade. Instead, they just charge a small, fixed commission per trade. This is a huge deal because it means they only make money if you're actively trading. They want you to succeed and stick around. It's a true win-win.
Next, very similar, is the non-dealing desk, or NDD broker. Just like an ECN, your orders go straight to liquidity providers, big banks that handle massive volume. The key takeaway here is in the name: no dealing desk. That means no requotes, no funny business from a dealer, and no built-in conflict of interest. Then things get a little murkier with the STP, or straight-through processing broker. This is kind of a hybrid model. They might send some of their clients, the profitable A-book traders, to the real market, but they might also decide to keep the less successful traders in-house on their own B-book. And here's the catch: you'll almost never know which book you're on. And that brings us to our final type, the market maker. This is the classic dealing desk we've been talking about. They literally make the market for their clients by taking the opposite side of every single trade. That fundamental conflict of interest we mentioned, for them, it's not a bug. It's the entire feature. It's how their business works. So let's just quickly put it all together. On one side, you've got your ECN and NDD brokers. They offer total transparency, and their success is aligned with yours. On the other side, you have the market makers. They might offer free trades, but it comes with that massive conflict of interest. And the STP brokers, well, they're living somewhere in that gray area in the middle. All right, before we move on, let's quickly bust 2 massive myths that I see new traders fall for all the time. Myths that can cost you a ton of money. You've heard the saying, there's no such thing as a free lunch. Well, that's especially true in financial markets. So when you see a broker advertising commission-free trading, be skeptical. They have to make money somehow, right? The costs are just hidden. They're baked into wider spreads, or worse execution, or slippage. That free trade can end up being very, very expensive. And what about the demo account? Look, think of a demo account as the broker's perfect shiny shop window. Your orders get filled instantly at the exact price you want. It's flawless. But the real world, with real money on the line, it's messy. So here's the bottom line. A demo account is great for one thing and one thing only: learning how to use the software. It is not a reliable way to test if your strategy will work with real money. So with all that in mind, how do you actually protect yourself? It's simple, really. You have to do your homework. So here's a quick checklist you can use to investigate any broker before you even think about sending them your money. First things first, and this is non-negotiable: regulation. A legitimate broker will be regulated by a major respected authority. We're talking about the FCI in the UK, the CFTC and NFA in the US, ASEC in Australia, or CWSEC in Cyprus. If a broker is based on some tiny island you've never heard of with zero oversight, run. That is a gigantic red flag. Finally, you need to be ready to ask some direct questions. Here are the top 5. 1. Are you regulated, and by which specific agency? 2. What type of broker are you? ECN, STP, market maker. 3. What are all of the costs involved in trading? 4. Are there any restrictions on trading styles, like scalping? And 5. What is your platform's actual uptime percentage? How they answer these questions? Well, it'll tell you everything you need to know. Look, picking a broker isn't just some boring setup step. It is the absolute foundation of your trading career. You wouldn't try to climb Mount Everest with a guide who gets paid if you fall off, right? So don't trade with a broker who profits when you lose. Now that you know how to find the right partner, Are you ready to make the most important trade you'll ever make?
Hey everyone, welcome. So if you're into Forex trading, you've probably hit this wall. Which currency pairs should I actually focus on? I mean, there are so many options. How do you pick the right one for your strategy? Well, in this explainer, we're going to break down how to choose your pairs, and I'll even show you a really powerful technique to see what's really moving the market behind the scenes.
You know, this quote from the legendary trader Jesse Livermore, it just hits the nail on the head. Because success in trading isn't just about making those big winning moves, it's about avoiding the dumb ones. And that all starts with making smart, informed decisions about the pairs you choose to trade in the first place.
All right, so this is it, right? The fundamental question every single trader asks themselves. Should I just stick with the most popular kid on the block, the EUR/USD, or are there maybe better, less obvious opportunities hiding somewhere else? Getting this right is honestly the first major step to building a solid trading plan.
Okay, so to even start to answer that, we've got to get the lay of the land. See, all currency pairs fall into one of three main buckets, and knowing the difference between them is absolutely critical. First up, you've got the majors. These are the big seven, the most heavily traded pairs, and they're all quoted against the US dollar. Then you have the crosses, which are any pairs that don't involve the US dollar at all. And finally, you have the exotics, and these pair up a major currency with one from a smaller or emerging economy.
And look, right off the bat, here is a huge piece of advice. If you're new to this, just stay away from the exotics. I know the potential returns can look super tempting, but these pairs are often really thinly traded. That means the spreads can be massive and the volatility, it can literally wipe out an account in minutes. It is just not worth the risk when you're still learning the ropes. All right, so let's focus on the place where most of us start, the 7 major pairs. And you know, it's really helpful to think of them not just as ticker symbols, but as actual characters, because each one has its own personality, its own quirks, and its own way of behaving.
Yeah, this table really breaks down those personalities perfectly. You see how the Euro-USD is the most liquid, but it's also super sensitive to politics? The GBP/USD, the cable, is all about that post-Brexit news flow. But then you've got what we call the commodity currencies, the Aussie, the Canadian, and the New Zealand dollars. These are often great for beginners because their movements are, well, they're more straightforward, often tied directly to things we can track, like commodity prices.
And this just lays it all out, plain and simple. On one side, you have the AUD/USD, which is a fantastic starter pair. Its value is tied to tangible things like iron ore prices and economic news out of China. But then on the other side, you have the USD/JPY, and that's a whole different beast. You've got two safe haven currencies fighting each other, massive influence from Japanese retail traders, and always the threat of the Bank of Japan stepping in. It's just a much trickier game to play.
And this is a super important heads up, especially for a pair like the euro-dollar. Sure, it offers the tightest spreads, but it is a political animal. A single off-the-cuff remark from a central banker in Frankfurt or Washington can send it flying in a totally unpredictable direction, which can be a really tough environment for new traders.
So, if the majors can be, well, a bit of a handful, where else can we look? This brings us to the cross pairs, and they offer a really compelling alternative, especially in the market we're in today.
You know, to really get why crosses are such a big deal now, you kind of have to look back at how the market's changed. Before the big financial crisis in 2007, currencies were mostly free-floating, driven by classic economic forces. But after the crisis, central banks, especially the US Fed, started intervening on a massive scale, printing money, messing with interest rates, and some argue that this created a kind of false market, especially for the US dollar.
And that is exactly why cross pairs have become so interesting. They let you step outside of that heavily managed world of the US dollar. You can trade the direct economic battle between two regions, like Europe versus the UK with the EUR/GB. And some pairs, like the AUD/JPY, are almost a pure barometer for how risky the market is feeling overall. It's kind of like a return to more classic, old-school price action.
But that leads us to the next big puzzle, right? Whether you're trading a major or a cross, how do you know what's really pushing the price around? Is a pair moving because of strength in one currency or weakness in the other?
I mean, this is the million-dollar question, isn't it? If you see the Euro-USD chart climbing, you have to know, is the market buying the euro like crazy, or is everyone just dumping the dollar? If you guess wrong, your risk goes through the roof because you might be accidentally fighting the market's real momentum.
Well, the answer is this simple but honestly game-changing tool called the currency matrix. This is a method the pros use to see the entire picture of a currency's performance across the whole market, not just in one little isolated pair.
And the best part? It's ridiculously easy to set up. Seriously. You just pick a currency you want to analyze, let's say the euro. You open up charts for all of its major pairs on your platform. You make sure they are all set to the exact same time frame, like the 1-hour chart. Then you just look. Is the euro going up or down across the board?
So your screen would look pretty much like this, a whole grid of charts, all focused on the euro, but against different currencies. Instantly, with just one glance, you can see if the euro is universally strong, universally weak, or just mixed.
So what does this actually give you? Well, everything. You're not guessing anymore. You can see the true driving currency. You can identify the universal market sentiment and confirm the real momentum behind a move. It even helps you pick the best pair to trade. If you see broad euro strength, the matrix will show you which pair, maybe it's EUR-JPY, maybe it's EUR-AUD, is moving the cleanest and gives you the highest probability trade.
So let's bring it all home. What's the big takeaway here? It all comes back to this one core idea: making smarter, risk-managed decisions by understanding the true flow of money in the market. I love this quote because it just sums up the whole philosophy perfectly. Using the currency matrix is like finally being able to see which way the river is flowing. It ensures that when you place a trade, you are moving with that powerful current of market sentiment, not trying to paddle against it.
So, look, choosing the right pair and actually knowing which currency is in the driver's seat, that is a huge step forward. It allows you to dramatically lower your risk from the get-go, but it also brings up the next big question, doesn't it? Once you're in that trade, how do you manage that risk all the way to the finish line? Well, that's the next level of your trading journey.
All right, today we're cracking open the trader's playbook. We're going to break down one of the most important skills you can have in the market: how to analyze risk. You know, it can feel like this super complex art form, but we're going to turn it into a clear step-by-step science. So let's just dive right in. You know, the legend Warren Buffett really hit the nail on the head with this one. He said risk comes from not knowing what you are doing. Think about that. It's not about gambling. It's not about rolling the dice. It's just a knowledge gap. And here's the best part. That's a gap we can totally fill. This whole explainer is about giving you the tools to know exactly what you're doing before you even think about placing a trade.
So, what's the whole point of all this analysis? Every chart you look at, every indicator, every single news report, they're all just trying to help you answer one single fundamental question. I mean it. If you can get this one thing right, you've pretty much unlocked the core of successful trading. Any idea what it is?
Okay, so here's our game plan. First, we're going to reveal that one big question. Then we'll get practical and set up your analytical dashboard, step by step. After that, we'll zoom in on a single currency pair, confirm what we're seeing with a really cool tool called the matrix, and then wrap it all up with a concept that connects everything: the ripple effect.
All right, Section 1, trading's only real question. Let's not wait any longer. Let's get right to the answer we've been building up to.
And here it is. The one question you have to answer before every single trade is simply this: how much risk am I taking on? That's it. Is it high? Is it medium? Or is it low? Every single tool, every chart pattern, all of it, it's just there to help you answer that one simple question. Because once you can actually quantify the risk, then you can make a smart decision about whether to take the trade or just walk away.
So let's get into Section 2 and see how this actually works in the real world. Think of this next part as setting up your command center, your dashboard for getting a clear view of the entire market. It's really just a simple 3-step routine you do before any trade. First, we get the big picture with currency indices. Second, we do a quick scan for any big news events that could shake things up. And third, we use a special tool to find a signal that's actually worth looking into. Okay, step 1 is all about context. A currency index like the US dollar index you see here basically tells you how one currency is doing against a whole bunch of others. It gives you that bird's eye view, you know? Is the dollar generally having a strong day or a weak day? You always have to know what the big players are up to before you do anything else.
Next up, step 2, fundamentals. Trust me, you never ever want to get blindsided by a major economic announcement. A quick look at the economic calendar tells you what's coming up today, tomorrow, this week. High-impact news can just inject a crazy amount of volatility into the market, so knowing it's on the horizon is absolutely non-negotiable.
And now, step 3,
finding a signal. For this, we use something called a currency strength indicator. Just think of it like a market radar. It instantly shows you which currencies are hot, being bought up like crazy, and which are not. See this? Look at the line for the Japanese yen, the JPY. It's way up in the overbought zone. And down here, the Australian dollar, the AUD, is deep in oversold territory. That difference, right there, gives us a potential trade to look at, buying the weak Aussie dollar against the super strong Japanese yen. And that leads us right into section 3. We've got our signal, right? Now we have to check if it's legit and turn it into an actual trade setup. And to do that, we're going to use a technique called volume price analysis. Now, that sounds fancy, but it's really just a way of looking at how much is being traded to confirm what the price is actually doing. So we start small on the 5-minute chart. Notice how the price broke below that old low? Now, look down at the volume bars at the bottom. See how they got bigger? That tells us the selling was for real. But then, look inside this magnified box. See that one gigantic volume spike? Even with all that selling, the price didn't really drop much further. That right there is a massive clue that buyers are starting to step in and soak up all that pressure. Okay, now let's zoom out a bit to the 15-minute chart to get some more context. Look at these 2 candles here, the ones with the long wicks sticking out the bottom. They're called hammers. What they show us is that sellers tried to push the price way down, but buyers came roaring back and pushed it right back up. When you see 2 of those after a big drop, well, that's a powerful sign that the sellers are running out of gas. This story is starting to come together. But we're not done yet. Let's zoom out one more time to the 60-minute chart. This is the moment of truth. This is where we finally answer our big question: how much risk are we really taking? When you look at the price over the last few days, the main or dominant trend is clearly down. So that means our idea to buy this pair would be what we call a counter-trend trade. We'd literally be swimming against the current. And this is the bottom line, right here. Trading against the dominant trend is, by its very nature, higher risk. It means you're probably just playing a temporary bounce, not some huge reversal, so you're likely in and out pretty quick. On the other hand, trading with the dominant trend, that's lower risk, and those are the trades you can potentially hold on to for a lot longer. Knowing which game you're playing is everything when it comes to quantifying risk. And you have to remember this: markets almost never turn on a dime. All that selling pressure we saw, it has to be absorbed by buyers. It's like a sponge mopping up a huge spill. It takes time. This is exactly why we look for confirmation on multiple timeframes, instead of just jumping in on the first little signal we see. Patience is a huge part of the playbook. All right, let's get to our final layer of analysis here in section 4, confirming with the matrix. I love this part because this step gives us the ultimate confirmation. It gives us this incredible market-wide perspective. So here's the key question the matrix is going to help us answer. We see AUD/JPY trying to move up, but is that because the Aussie dollar is suddenly getting strong against everything? Or is it because the Japanese yen is getting weak against everything? The answer to that question completely changes how confident we are in the trade. Now check this out. This is the yen currency matrix. It's showing us all the major yen pairs all lined up side by side, and what do you see? They're all showing similar patterns. The New Zealand dollar/yen, the US dollar/yen, the British pound/yen, they're all hinting at a potential reversal. And that tells us something huge. This isn't about the Aussie dollar. This is a broad yen-driven move. And that's the magic of the matrix. It confirms why the market is moving. It reveals the true sentiment across the entire board, and that gives us the confidence we need. By confirming it's a broad move affecting the whole yen complex, it helps us nail down our risk one last time. It is an absolutely essential final check. And that brings us to our final section, section 5. This last idea, the ripple effect, just beautifully ties together everything we've been talking about with using different time frames. So just take a look at these 2 charts showing the strength of the British pound. On the left, you've got the 15-minute chart. See how the pound has peaked and is already starting to roll over and get weaker? But now look at the 30-minute chart on the right. It shows the pound is still right at its peak. It's heavily overbought, but it hasn't started turning down yet. See what's happening there? This is the ripple effect. It's just like dropping a pebble in a pond. A change in trend starts on the fastest, smallest chart, and then the ripples spread outward to the slower, bigger ones. That 15-minute chart is basically giving us an early warning for what's probably about to happen on the 30-minute and then the 60-minute charts.
This lets us anticipate moves and get in sync with the bigger flow of the market, which can dramatically lower our risk. So there you have it. We've laid out a complete, methodical process for analyzing the market. It's a playbook for actually quantifying risk. It starts with that big picture view and then drills down layer by layer until you have a complete picture. So the only question I have left for you is this. Now that you have a map, are you ready to navigate the markets?
So you're ready to dip your toes into the world of trading, huh? Well, you've probably heard the name MT4 or MetaTrader 4 thrown around a lot. And for good reason. It's pretty much where everyone gets their start. Today, we're going to cut through all the noise and give you a super simple guide, all the way from downloading it to placing your very first practice trade.
You know, over 100 years ago, a trading legend named Jesse Livermore said this. And what was he getting at? Simple. Trading isn't something you can just learn from a book. At some point, you have to move from just studying to actually doing. And that's the journey we're kicking off right now.
But that's a huge leap, right? I mean, going from theory to actually clicking the button can feel, well, pretty intimidating. You've got the interest, but taking that first real step can feel like a massive hurdle.
Well, here's the secret. You bridge that gap safely. You don't have to just dive into the deep end with your own money. What you need is a tool that lets you practice, get the feel of it, and build up your confidence, all without risking a single penny. And for millions of traders, that tool is MT4.
So, with all the different platforms out there, why does everyone keep recommending MT4 for beginners? Let's break down exactly why it's such a big deal.
First off, its history and reach are just massive. This thing's been around since 2005. That's an eternity in the software world. It means it's incredibly stable. Plus, pretty much every Forex broker offers it, so it's become the unofficial standard for the entire industry. And that means there's this huge community and a massive library of extra tools built for it.
But here's its real superpower. It's simple and it's fast. Yeah, other platforms might have more bells and whistles, but they're also way more complicated. When you're just starting out, the last thing you want is to fight with your software. MT4 is intuitive. It lets you focus on learning how to trade, not on learning a complex program.
Okay, this brings us to what I think is a non-negotiable rule for anybody new to trading. You have to practice before you risk real money. And the great thing is, every broker who offers MT4 also gives you a free demo account. Think of it like your personal trading sandbox or a flight simulator for the markets.
And getting one is unbelievably easy. You just sign up on a broker's website. They usually just need an email. They'll zip a download link over to you, you click through the installer, and boom, you're ready to start playing with virtual money right away.
Now, once it's installed, you might wonder where the heck it actually lives on your computer. It's usually tucked away in your Program Files folder. But honestly, you don't even need to worry about that. The installer automatically puts a nice, convenient shortcut right on your desktop for you. All right, now that we've got it installed, let's fire it up. We're going to double-click that new icon on the desktop and take a quick tour of your new workspace. Okay, when you first launch MT4, you're going to see something that looks like this. And I know, with 4 charts and all these windows, it can look a little overwhelming. But don't worry, we're going to simplify this whole thing right now by focusing on just 3 key areas. Up at the top, see that View menu? Think of that as your command center. It's where you can turn on or turn off any of the main windows. So if you ever accidentally close something and can't find it, just head straight to the View menu. Problem solved. The first key window you need to know is the navigator. Honestly, just think of this as your toolbox. It's got your account info, but more importantly, it has the entire library of built-in technical indicators. And adding one to your chart, it's as simple as just dragging and dropping it over. This second crucial window is the terminal, and you'll find it sitting at the bottom of your screen. This is your financial dashboard. The Trade tab shows you your current balance and any trades you have open. And that Account History tab, that's your report card. It's a full list of all your closed trades, which is perfect for reviewing how you're doing. Now, before we move on, let me give you a quick pro tip to keep your platform running nice and fast. See, over time, MT4 collects a ton of old price data, and that can really slow your computer down. So to fix that, just go to the Tools menu, click Options, and then find the Charts tab. We're just going to tweak 2 little settings in here. You're going to look for the fields that say Max Bars in History and Max Bars in Chart. Just change both of those numbers to something manageable, like 500. The default setting can be crazy high, which is total overkill for most people, and it will eventually bog your system down. This tiny adjustment makes a huge difference in performance. Okay, enough with the setup and the settings. Let's get to the fun part. We are going to walk through step by step how to place your very first practice trade. You're about to see just how easy this is. First things first, you're going to click that new order button right up there in the top toolbar. That's going to pop open the main order window, which is where we'll set up everything for our trade. The very first field to look at is volume. That's just a fancy way of saying your trade size. And trust me on this, you want to start small. Select 0.01 from the dropdown. That's what we call a micro lot, and it's the smallest size you can trade. It keeps your risk super low while you're just getting the hang of it. And now, for what is, without a doubt, the most important step of all, setting your stop loss. This is the price where your trade will automatically close out if the market goes against you. It's your safety net. It's the most important habit you can build for managing your risk. So, with your volume set and your stop loss in place, you're ready. You just click buy or sell, and boom, just like that, you are in the market. You'll see these cool dotted lines pop up on your chart, one for where you got in and one for your stop loss. Seriously, congratulations. You've just placed your first trade. But see, placing the trade is just the beginning. Now you have to manage it. So let's look at one of the absolute best features of MT4, how easy it is to adjust your stop loss to protect yourself while the trade is live. This right here is the power of active management. If the price starts to move in your favor, you can literally just click on that stop loss line and drag it up. The second you move it past your original entry point, you have just created a risk-free trade. The worst thing that can happen now is that you close out with a small locked-in profit. How cool is that? All right, one last thing. Let's cover a feature that is going to save you a massive amount of time once you figure out how you like your charts to look. So when you finally get a chart looking exactly the way you want, with your favorite colors, your go-to indicators, all of it, you can save that entire layout as a template. That way, the next time you open a brand new chart, you can apply that template with a single click instead of setting everything up all over again. It is a huge time saver. So there you have it. That's the complete blueprint. You know why MT4 is the perfect place to start, you know how to get it set up, and you know how to place and manage your first trade completely risk-free. You've officially bridged that gap from student to speculator in training. The platform is all yours. The only question left is, what's your first move going to be? Today, we're going to pull back the curtain and look at what's really driving the market. We're talking about volume price analysis, a way to read the hidden story that the charts are trying to tell us. So let's get right into it. Does this sound familiar? You see the perfect trade setup, you make your move, and then, bam, the market just whips around and goes the other way. It is so frustrating. It feels like you're playing a game, but someone else wrote the rules. Well, what if I told you you're not crazy? You're absolutely right. See, most traders are looking at only half the picture. They're obsessed with price, right? They analyze every peak, every valley, every pattern. But the insiders, the people really moving the markets, they're looking at something else. They see the price, sure, but they also see the volume. And that little piece of information changes the entire game. It's like you're seeing a shadow on the wall, but they're seeing the person casting it. So to really get why volume is the key, you first have to understand who we're tracking. So let's talk about these insiders. Let's meet the market makers. The easiest way to think about market makers is to see them as giant wholesalers. Seriously, their business model is incredibly simple. Fill up their massive warehouse with stock when prices are dirt cheap, and then turn around and sell all that stock when prices are sky high. Their entire job is to buy from you at a discount and sell it back to you at a premium. So how do they get you, a smart trader, to sell low and buy high? Well, they have a playbook, and it only has 2 steps. First, they use the news to crank up your emotions. We're talking intense fear or unbelievable greed. And then, step 2, they exploit those emotions. They'll engineer a scary price drop that makes you panic and sell your shares for cheap right into their open arms. And on the flip side, they'll create a euphoric rally that gives you intense FOMO, so you buy at the very top, which of course is exactly when they want to be selling. It sounds like the game is completely rigged, doesn't it? Well, not quite. Because even though these guys operate in the shadows, they can't help but leave behind a trail of evidence, a very clear trail. And that trail is the hidden clue we've been searching for. Market makers are absolute masters of disguise. They are brilliant at hiding what they're really doing behind confusing price moves and distracting headlines.
But there is one thing, one single activity that they simply cannot hide, because their operations are so massive. Every single move they make leaves a clear, undeniable footprint right there on your chart. And that footprint? It's volume. Think about it. A wholesaler can't fill a gigantic warehouse using a pickup truck. They need a fleet of cargo ships. It's all about scale. Their activity is so huge, it creates these massive spikes in trading volume. It is the one thing they can't fake.
And here's the secret to decoding it. When price and volume agree with each other, the move is real. A big price jump on huge volume, that means the insiders are in on it. They're buying. But what if you see that same price jump on really low volume? That's a trap. That means the big players are sitting on the sidelines, just trying to lure you in before they pull the rug out. That's your warning sign right there.
And hey, this isn't some new flashy theory I just made up. This whole way of thinking was laid out over 100 years ago by a trading legend, Richard Wyckoff, and he boiled it all down to 3 simple, timeless laws. These are the 3 core principles you need to read the market's real story. The law of supply and demand, the law of cause and effect, and my personal favorite, the law of effort versus result. All right, law number 1 is the easy one. This is Econ 101, right? When there are more buyers than sellers, demand is high and the price goes up. When there are more sellers than buyers, supply is high and the price goes down. It's the foundation for everything. Law number 2 is all about preparation. Imagine you're winding up a toy spring. The longer the market makers spend quietly buying up stock in a sideways range, that's the cause, the more tension they're building in that spring. And that means the eventual breakout trend, the effect, is going to be that much more explosive. Okay, and law number 3 is where it all clicks. The effort, which is the volume, has to match the result, which is the price. So think about this. What if you see a colossal amount of volume, a huge effort, but the price barely moves an inch? That's a massive red flag. It means an invisible battle is happening, and one side is quietly absorbing all the pressure from the other. Something big is about to happen. So when you put these 3 laws together, everything changes. You stop seeing random zigzags on a chart, and instead, you start to see a carefully planned out campaign, almost like a military operation, being run by the market makers. And this campaign almost always follows a predictable 4-phase cycle. It kicks off at the bottom with a buying climax. This is when the public is panicking and selling with high volume, which lets the insiders fill up their warehouse. Then comes phase 2, the slow, steady climb up the ladder. That's your bull trend. At the top, we get a selling climax, where public greed is at a maximum and the insiders empty their warehouse. And that leads to phase 4, the fast, scary slide down the snake, the bear trend. This, by the way, is exactly why markets always seem to go down way faster than they go up. The turning points in this home campaign are powered by emotion, your emotion. At the bottom, they create fear. The price crashes, the news is terrible, and you panic sell your stock right to them. At the top, they create FOMO, that intense fear of missing out. The price is going parabolic, the news is amazing, and you can't help but greedily buy their shares from them at the absolute worst possible time. You know, Richard Wyckoff wrote this nearly a century ago, and it's more true today than ever. His point was simple. You have to learn to ignore all the noise. All you really need to focus on are the core facts, the price, the volume, and how they relate to each other. Everything else is designed to distract you. And when you do that, when you focus on just those few key facts, it all boils down to answering the one question that every trader on earth wants to know. The only question that truly matters. Where is the market going next? The answer isn't hidden in some complicated indicator or a secret trading guru's newsletter. It's been right there on your screen the whole time. If you want to know where the insiders are planning to take the market, you have to stop listening to the stories and start looking for their footprints. Because the volume reveals the truth. All right, today we're going to decode the secret language of the financial markets. We're going to look past all those squiggly lines on the chart and dive into something called volume price analysis. It's, a really powerful way to see what the big players, the insiders, are actually up to. So let's get right into it.
I mean, have you ever felt like the market is just one step ahead? You know the feeling, right? You spot what looks like the perfect setup, you jump in, and bam, the market just rips in the other direction, leaving you high and dry. It's so frustrating, and you can't help but feel like someone out there is playing a totally different game. Well, here's the thing, they are. Okay, so let's start with a core idea here. The market is not random. Not at all. There are some really powerful forces at play, and the best part is they leave footprints all over the charts for us to find. You see, behind all those charts are what we call market makers, or insiders. And look, their primary goal is pretty simple. They want to engineer moves that trap regular traders, people like us. They create these illusions of strength or weakness just to get you to buy at the absolute top or panic sell at the very bottom. But, and this is the good news, their actions leave behind these little clues, these subtle hints in how price and volume relate to each other. And that right there brings us to the absolute core of this whole analysis. The real secret is learning how to spot when the price action and the trading volume are telling two completely different stories. That disagreement, that's our signal. Yeah, this all boils down to a really fundamental concept from a guy named Wyckoff. It's his third law, effort versus result. And it's actually super simple when you think about it. Just picture this. Volume is the effort. It's the gas you're putting in the tank. The price movement is the result, how far the car actually goes. Now, in a healthy, normal market, a lot of effort should create a big result, right? But when they don't match up, well, that's an anomaly. And that's exactly what we're on the hunt for. And this quote just nails it. It's the perfect way to picture one of these key anomalies. It's like driving a car up a steep hill on an icy road. You're flooring the accelerator, right? The wheels are just spinning and spinning. That's massive effort, huge volume, but the car is barely inching forward. It's failing to grip. That is exactly what can happen in the market. All this turning, all this volume, but the price just stalls. It's a huge sign of exhaustion. So really, there are two key anomalies we need to keep our eyes peeled for. First, you've got a big, dramatic price move happening on really low volume. That's a huge warning sign. It suggests the insiders are not participating. It's probably a trap. Then you've got the second one, that car on the ice situation, a tiny little price move on ridiculously high volume. That tells you a massive battle is going on between buyers and sellers, and a reversal could be right around the corner. All right, let's really zoom in on that first anomaly, the big move on low volume. Because honestly, it's one of the most common and effective traps that market makers love to set. Okay, just look at this chart. How tempting is that? You see this monster green candle just exploding upwards. It looks like a powerful breakout, right? Instantly, that fear of missing out, that FOMO, kicks in hard. And every single instinct in your body is screaming, buy! Get in now before it goes to the moon. But hang on, let's put on our new VPA glasses here and look a little closer. See the volume bar that goes with that huge move? It's tiny. It's average at best. The effort just does not match the result at all. The move is huge, but the fuel in the tank is next to nothing. This is a massive, flashing red flag. And there it is. That's the trap. The insiders push the price up dramatically, but they aren't actually participating themselves. They're not putting their own money on the line. They just want to lure in all the unsuspecting traders, and then when everyone's piled in, they pull the rug out and the market reverses, leaving everyone who followed them completely stranded. That tiny volume bar, that was the giveaway the whole time. So it's not just about spotting these traps. This kind of analysis is also amazing for seeing when a really strong trend is starting to run out of gas. It gives us these little early warnings that a reversal might be coming. Take a look at these two charts. On the left, you've got a hanging man candle, and on the right, a shooting star. Both are classic signs of weakness, especially when they show up at the top of a big rally. See those long wicks sticking out the top? That's telling you a story. It means that during that period, buyers tried to push the price higher, but sellers came in strong and slapped it right back down. These are often the very first whispers that a bullish trend is in trouble. So here's a quick little checklist of what market weakness can look like. First, watch out for those candles with the long wicks on top, like the shooting stars we just saw. Second, be really suspicious of rallies that happen on falling volume. That's a huge sign of a lack of conviction. And third, keep an eye out for that car on ice situation, narrow price moves on super high volume. Any of these are clues that the tide might be getting ready to turn. Okay, so why does all this matter? What's the real payoff here? Well, it's not just about finding the perfect time to get into a trade. It's about having the confidence and the conviction to manage your trades once you're in them, especially through all that inevitable market noise. Let's walk through a super common situation. Look at this NZD/JPY chart. It's in a clear downtrend. You're in a short position, things are going great. But then, it's full of these little pullbacks. The market starts rallying against you. And that question starts screaming in your head. Is this a real reversal, or is it just a pullback? The panic starts to set in. Do you get out? Do you hold on?
This is where volume price analysis becomes your best friend. So, step 1, we know the primary trend is down. Step 2, the market rallies against us, and we ask, is this a reversal? So, step 3, we check the volume. And what do we see? The volume on that little rally is low, or maybe it's even declining. The effort is weak, and that leads us to our conclusion. This is just a weak pullback. It's noise. And now we have the confidence to hold our position.
And that's the whole point. VPA gives you the confidence to hold a position through those scary-looking temporary reversals because it helps you see whether the insiders are truly behind the move. You can see that the rally has no conviction, no real power. And that allows you to ride out the noise and stay with the main trend without getting shaken out by fear. So when it all comes down to it, you're just learning to ask your chart a few simple questions. Does the volume actually confirm the price move? Are the market makers in on this, or is this just a trap? Is this rally starting to show signs of weakness? Does this little pullback have any real conviction, or is it just hot air? When you start asking these questions every time you look at a chart, you'll begin to see the real story the market is telling you. The point is, you don't have to guess anymore. Once you really grasp this relationship between effort and result, you can start to decode what the market makers are actually trying to do. Suddenly, the charts aren't just a bunch of random squiggly lines. They become a story, a narrative. So the only question left is, what will your next chart tell you? Have you ever stared at a price chart and just had that feeling that you're missing something important? Like there's a secret conversation happening right in front of you, but you can't quite hear it? Well, guess what? There is. And today, we're going to learn how to listen in. Let's get into it. So let me just ask you straight up. Are your price charts lying to you? And the short answer is, well, yeah, sometimes they are. A price zipping up or down seems pretty straightforward, right? But on its own, price can be super deceptive. It's really only showing you half the story. So you see a simple trend line, but what's really going on under the surface is this incredible story of effort versus result. And the key to unlocking that story is trading volume. This is the difference between seeing the market flat in 2 dimensions and seeing it in 3D. To really get this, we've got to talk about price, volume, and the insiders. You know, the big institutional players, the so-called market makers. Think of them as the whales in the ocean. Volume is their footprint in the sand. It shows us exactly where the big money is playing, and maybe even more importantly, where it's sitting on the sidelines. But hang on, before we start looking for those footprints, there is one golden rule you absolutely have to know, especially if you're looking at hourly charts. If you get this one thing wrong, pretty much all your analysis goes right out the window. And it all comes down to the trading session. You see, the market isn't just one long, continuous day. It's a 24-hour cycle broken up into different periods of activity. So naturally, the volume during the super busy London or New York sessions is going to be way, way higher than the volume during the much quieter Asian session. So here's the deal, and this is crucial. You have to compare apples to apples. You can compare the volume in today's London session with the volume in yesterday's London session. That's useful. But comparing London volume to Asian volume, it tells you absolutely nothing. It's like comparing rush hour traffic in a major city to the traffic at 3 in the morning. Of course they're different. All right, so now that we've got that golden rule locked in, we can start the real fun part. Let's go hunting for clues. We're going to look at the specific signs of market weakness that these insiders leave behind for us to find. Signal number 1 is maybe the most powerful of them all. We call it high effort, no result. This is what happens when you see a gigantic spike in volume. That's the effort, but the price just fizzles. It barely moves. That should set off alarm bells in your head. Okay, now take a look at this chart. See that candle in the second session? Now look down at the volume bar directly underneath it. It is huge. It's the highest on the entire chart. That is a massive amount of effort. But now look back up at the price candle itself. It's tiny with a long wick. The result just doesn't match the effort at all. And this quote here just nails it. With that kind of insane volume, the price should have shot to the moon. The fact that it didn't, well, that's sending a very loud signal that the big players are quietly selling into all that buying excitement, absorbing the demand and getting ready to turn this market around. Okay, on to our next signal. This is another classic, a rally on falling volume. The price is climbing, everything looks great on the surface, but the participation, the fuel for the move, is actually drying up. It's like a car trying to accelerate while it's running out of gas.
Just look at this chart. In that fourth session, the price takes off like a rocket. It looks incredibly bullish, right? But if you just glance down at the volume bars, you'll see they're actually getting smaller and smaller. This is a massive red flag. That whole move is hollow. There's no professional muscle behind it. It's not built to last.
And finally, for our third signal, we're talking about specific candle patterns that become 100 times more powerful when they show up with high volume. A perfect example is the shooting star candle. You know the one, small body, long wick sticking out the top. Think of it as the market trying to go higher but getting slammed back down.
And here it is, plain as day. You see that shooting star at the very end of session 1? It's right at the peak of a nice rally. And then you look below, and bam, it's confirmed by the biggest volume spike of the session. This is a clear as day signal that the insiders are dumping their positions at the top, selling to all the latecomers.
Okay, now for the really juicy stuff. How market makers use these very principles to actively set traps for everybody else. See, they don't just react to the market, they create illusions to fool people.
And it all comes down to basic human psychology. They know that a fast, sharp price move triggers that powerful emotion we all know, FOMO, the fear of missing out. Traders see the price taking off without them, they panic, they jump in without thinking, and that is exactly what the insiders are waiting for. So here's the playbook. Step 1, they create a sudden, eye-catching move. Step 2, and this is the secret sauce, they make sure their own money isn't really behind it, so the volume is suspiciously low. Step 3, this triggers that FOMO panic in retail traders who all pile in. And step 4, the market makers reverse the price, trapping everyone who just bought at the top. It's a classic setup. This picture just says it all. On the left, you've got a legitimate move up, and you can see it's supported by real, significant volume. On the right, you have a trap. The price candle is even bigger, looks even more exciting, but look at the volume. It's shockingly low. It's an illusion. The insiders are not on board. They're waiting to spring the trap. So what do we do with all this? How do we use these signals and avoid the traps? Well, the final and most important clue isn't actually on the chart at all. It's all about your mindset. You have to remember this. Markets spend way more time going sideways in choppy congestion than they do in a nice, clean trend. The temptation is to always feel like you have to be doing something. But the real skill here is patience. You have to learn to sit on your hands and just wait. Wait for the volume to confirm what the price is telling you. And that really brings us full circle, right back to the core principle of this entire analysis. It all boils down to spotting an anomaly, a disagreement between the effort, which is the volume, and the result, which is the price move. And this isn't some newfangled idea. It's a foundational concept in trading, codified as Wyckoff's third law. When those two things get out of sync, the market is screaming a message at you. So, the next time you pull up a chart, I want you to do something different. Don't just look at the price candles. Look beneath the surface. Look at the volume. And ask yourself one simple question. Is the volume telling the same story as the price? Because the answer might just change everything for you. Ah, the 15-minute chart. You know, it's one of those things, right? It promises so much action, so many opportunities. But man, can it feel like pure chaos. It's just so fast, so furious, and it's super easy to get completely lost in all that noise. I bet this sounds familiar, right? You see this awesome strong move, you think, this is it. You jump in, and bam, the market just rips right back against you, and you're left there just scratching your head thinking, what on earth just happened? Well, here's the thing. Those crazy, unpredictable moves, they're not random at all. They're often very, very deliberate. So the real key here is to stop staring just at the price. I mean, what if? What if you could actually see the hidden story playing out behind those candles? What if you could spot the footprints of the big players, the market makers, and figure out what they're really up to? Well, guess what? You absolutely can. So here's what we're going to do in this explainer. We're going to break this whole thing down. First, we'll tackle how to actually decode the 15-minute chart. Then, we're unlocking the secret language of volume. After that, we get super practical. I'm talking how to spot hidden selling and hidden buying. We'll also talk about your secret weapon, which is patience. And we'll finish up with a handy little VPA pocket guide you can start using like today.
Okay, so the biggest headache with these faster charts, it's all about context. Think about it. Volume can go absolutely wild when different trading sessions overlap, like when the Asian session hands off the baton to London. So a high volume bar during a quiet period might be totally average during the handover. It makes comparing apples to apples really tricky. But there is a way to read the story as it unfolds.
And that method is called volume price analysis, or VPA for short. Now, this isn't about cluttering up your charts with a bunch of confusing indicators. Nope. This is about getting back to basics and learning to read the tape. It's about understanding that raw, fundamental relationship between price and the volume that's pushing it. This, right here, is the key to seeing what the insiders are really doing.
Yeah, so you can think of VPA as our special decoder ring. It lets us look at that dance between price and volume to figure out what the pros are up to. Are they, secretly buying up everything they can, or are they dumping their positions on unsuspecting retail traders? The volume, that's what tells the real story.
And here's the beautiful thing. The core idea is incredibly simple. Just think effort versus result, okay? So if you see a ton of effort, I'm talking massive volume, you'd expect a massive result, right? A huge price move. That's just common sense. But what happens when you see all that effort, all that volume, and the price barely moves an inch? That's the anomaly. That's the big flashing sign that something else is going on under the surface. All right, enough theory. Let's put this into practice. First up, we're going to hunt for hidden selling. This is that sneaky situation where it looks like the market is on a tear, rallying like crazy, but behind the scenes, the market makers are quietly selling everything to all those excited buyers. Okay, check out this chart of the AUD/USD. Some news just dropped, and boom, we get this monster spike up on insane volume. Now, to most people, this looks like a one-way ticket to the moon, right? Super bullish, you'd be so tempted to jump on that train, go long, and just ride it up. But take a closer look at that volume bar. And this is that aha moment. When you start using VPA, you look at a chart like this, and your gut just screams at you, wait a minute, something is not right here. The story the candles are telling just doesn't line up with the story the volume is yelling. So let's really break this down. Look at that first huge candle. That's our yardstick, okay? This much volume got us this much of a price move. Got it? Now look at the very next candle. The volume is almost identical. It's huge. But look at the price. It barely went anywhere. The effort was massive, but the result was, well, pathetic. What does that tell you? It tells you all that buying is running into a giant brick wall of selling. The big boys are dumping their positions into all that excitement. Okay, so now let's flip the script, because this exact same principle works in reverse. We can use VPA to sniff out hidden buying when it looks like the world is ending and the market is in free fall. This is when the market makers are happily scooping up bargains from everyone who's selling in a panic. All right, take a look at this Euro GBP chart. Yikes. The price is just taking an absolute nosedive. It looks awful, totally terrifying. Panic is in the air, right? Everyone's hitting the sell button. But then, look what happens. Right at the bottom of that scary move, the biggest volume bar of the entire day pops up out of nowhere. What's really going on here? So the setup is pure fear. They drag the price down to shake everyone out and trigger that panic selling. The big signal is that monster volume spike on a candle that has a long tail, or a wick at the bottom. And that wick is everything. It's proof that the price tried to fall further, but a tidal wave of buying came in and pushed it right back up. That's the market makers stepping in with their giant shopping bags, just soaking up all that selling. And the result? The sellers run out of steam and whoosh, the market turns around. So let's put them side by side. It makes it so clear. On the left, you've got hidden selling. All this effort, all this volume, and the price just hits a ceiling. It can't go higher. On the right, hidden buying. All that volume comes in and acts like a giant safety net, stopping the price from falling. See? It's the exact same principle, effort versus result, but it's telling you a completely different story depending on whether you're at a top or a bottom. Okay, so we've seen some pretty clear signals for buying and for selling. But what happens when the signal is, well, fuzzy, when it's not clear at all? This is where your true superpower as a trader comes in. And that superpower is patience. Seriously, sometimes the smartest, most profitable thing you can do is absolutely nothing. Let's look at this GBP/USD chart. We had a nice move up, and then we get this thing, a doji candle. You see it? It's got that tiny little body and these long wicks sticking out the top and bottom. And crucially, it happened on really high volume. So, is this buying? Is it selling? The honest answer is, we have no idea. You can't tell. This candle is a sign of a massive battle between buyers and sellers, but right now, there's no clear winner. And this is the difference between a professional and an amateur. Don't guess. Don't flip a coin. If the picture isn't crystal clear, you sit on your hands, you protect your cash, and you just wait for the big players to finally show you which way they're going. So here's your 3-step game plan. Step 1, spot that signal of indecision, that high-volume doji. Step 2, acknowledge the truth. You do not know what happens next. It's a 50-50 shot, and that's just gambling. So step 3, you wait. You wait for the next candle, maybe the one after that, to confirm who won the fight. That's when you have a real signal to act on. All right, let's pull all of this together into a super simple guide, like a little cheat sheet that you can use to start spotting these footprints on your own charts. Let's recap the key signals we've talked about. Okay, here's the rundown. You see high volume, but the up candle has a tiny body. That's hidden selling. You see high volume on a down candle with a long tail at the bottom. That's hidden buying. You see a high volume doji. That's indecision, your signal to just wait. And hey, if you see the price just chopping sideways on super low volume, that means the pros aren't even playing. Best to just stay out of the way until they come back. And at the end of the day, this is why all of this matters so much. Learning to read volume isn't just some other technical trick. It gives you real, genuine confidence. You get the confidence to pull the trigger when a signal is strong, the conviction to actually stay in when a winning trade when it gets a little choppy. And maybe most important of all, it gives you the discipline to say, nope, not today, and just stay out of the market when things are unclear. So it turns out, all that chaos on the 15-minute chart, it's not so random, is it? There's a story being written, candle by candle, and volume is the language it's written in. The footprints of the market makers are right there, plain as day. The only question left is, where are you going to let them lead you? All right, let's get right into it. Today, we're basically becoming financial detectives. Our mission? To crack the code hidden inside every single price chart using something called volume price analysis. So let's dive right in. So have you ever looked at a financial chart and just thought, what is going on here? It just looks like a bunch of random chaotic noise, right? I get it. But believe me, it's anything but random. See, every one of those charts is actually telling a story. It's a story about a huge battle between buyers and sellers. And the main characters? Well, they're the big players, the market makers. We're talking about the huge institutions with enough cash to literally move the market. And the best part is, they leave clues behind. Today, we're going to learn exactly how to read them. The whole secret boils down to just 2 key pieces of evidence. First, you've got price action. That's pretty straightforward. It tells you what happened. Did the price go up? Did it go down? But then, and this is the important part, you've got trading volume. Think of this as the effort behind that move. It's like seeing a punch thrown versus knowing how much power was behind it. When you put those 2 together, suddenly the whole story just clicks into place. So yeah, think of this as your official detective training. We're on the hunt for fingerprints, the ones left behind by the insiders, those market makers we were just talking about. These are the folks pulling the strings, orchestrating the big moves, and volume price analysis, or VPA, is our magnifying glass to see exactly what they're up to. Okay, first up in our training manual, how to spot a trend that's basically running on fumes. We're going to look for those telltale signs of weakness, the clues that are practically screaming that a price is about to take a nosedive. And our very first signal of weakness is a total classic. It's called the upthrust. You might have also heard it called a shooting star candle. Whatever you call it, it's a massive red flag, and you'll often see it pop up right at the very peak of a market rally. Okay, look closely at that candle right at the top. See how the price shot way up, but then, bam! Powerful sellers came in and just slammed it right back down. That leaves that long, skinny wick sticking out the top. And that huge volume bar below, that's our confirmation. It tells us the big players were dumping their positions, selling like crazy into all that buying excitement. All right, our next clue is a big one. It's a major anomaly, the kind of thing that should make you sit up and go, wait a minute, something's not right here. It's what happens when you see a ton of effort, a massive amount of activity, but you get almost no result. This is a huge sign that the insiders are secretly working against the trend. So, check out those two candles right before that big price drop. See how they have nearly identical, super high volume? But look at the price. It barely moved. It went nowhere. Think about that. All that buying activity, all that effort, and it couldn't even push the price to a new high. Why? Because the market makers were on the other side, selling, 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 and soaking up all that buying like a sponge. So why does this matter to you? Well, spotting these signals early is like getting a warning light on your dashboard. It's telling you that the upward momentum is fading fast and reversal could be just around the corner. It's a major clue to get cautious, maybe think about protecting your gains. Okay, we've looked at weakness. Now let's flip the script and talk about spotting signs of strength. These are the clues that tell us a downtrend is getting tired and a potential bottom might be starting to form. And the first sign of strength we're going to look for is something called stopping volume. I love this analogy. Imagine a car that's just barreling downhill and then someone slams on the brakes hard. That's exactly what stopping volume is. It's this massive surge of buying that just brings a falling market to a screeching halt. And this is a picture-perfect example. So the price is in a free fall, right? And then, boom. Check out that one candle with that monster volume bar underneath it. You can see the price tried to dive even lower, but buyers just flooded in with so much force, they shoved it all the way back up. That long tail, that lower wick, that's the evidence. That's stopping volume, right there, in action. Okay, next up, we have a pattern that, honestly, looks super chaotic at first glance. But it's actually an incredibly powerful sign of strength. It's called the buying climax. And this is where the smart money, the insiders, are quietly building up their positions, getting ready for the next big leg up. Take a look at that messy, choppy price action over on the left. It's all over the place, right? This is what traders call whipsaw action. The price gets shoved up, then slammed down, all on really high volume. Now, this isn't random chaos. Oh no. The market makers are doing this on purpose. They create this volatility to scare out all the weak, panicked sellers so they can scoop up their positions on the cheap right before the real move starts. So what are these signals really telling us? They're clues that the sellers are exhausted, they've run out of gas, and a bottom is likely forming. For a trader, this can signal a potential low-risk spot to get in on the action before the next big rally. Okay, so being able to spot these individual candle patterns, that's a fantastic skill to have. But the difference between a good detective and a great one is seeing how all the individual clues connect to tell the bigger story. To do that, we've got to zoom out and look at the whole crime scene. And you know, the author of our source material really nails it with this quote. It's so important to occasionally step back from the magnifying glass, stop analyzing every single candle, and just get a feel for the broad trend and how the volume looks across that entire trend. This chart right here is a perfect example of what we're talking about. I mean, at first glance, what do you see? An uptrend, right? Price is going up. But now, look down at the volume. As the price is climbing, the overall volume is actually decreasing. It's falling. What does that tell us? It means there's no real power, no conviction behind this rally. The whole thing is built on a really weak foundation, and it's probably not going to last. All right, so let's pack your new VPA detective kit. Here are the three main tools. Number one, always compare the effort, that's the volume, with the result, that's the price. You're hunting for those strange anomalies. Number two, get really good at spotting those key signals of weakness and strength we just went over. And number three, and this might be the most important, be patient. Seriously, one clue is just a hint. A good detective waits for multiple clues to line up before they make their move. So the next time you pull up a chart, I want you to ask yourself, are you just looking at random noise? Or are you seeing the clues? Can you now see the story that's unfolding, the footprints that the market makers are leaving behind just for you? Because trust me, the story is always there. You just have to know how to read it.
Welcome to The Explainer. Today, we're diving into a Forex chart that, honestly, drives a lot of traders crazy, the 4-hour time frame. It's so often misunderstood, but what if I told you there's a hidden pattern in it? A pattern that once you see it, might just change how you look at the markets for good.
So, what's the deal with this chart? Why is it such a head-scratcher? Well, according to our source material, it's because most people are looking for the wrong thing. They're missing a key piece of the puzzle, and that's why they can't seem to find any reliable signals in all that noise.
Okay, here's the thing you hear all the time. Oh, the volume on the 4-hour is useless. It's always high for London and New York and dead during Asia. It's just a cycle. And most traders just dismiss it. But what if that predictable cycle is the signal? The source we're looking at today says that's exactly it. It's not noise, it's a rhythm. We just need to learn the dance steps.
And that brings us to this whole new way of thinking. It all revolves around a really cool concept the source calls the delayed reaction effect. This is the key, you guys. This unlocks the entire thing.
So what is it? Well, this is the idea that changes everything. We're so used to looking for a signal and expecting a result right away, in the next few hours. But this theory says, nope, that's not how it works here. A big volume spike in today's London session might just be the setup for the real move in tomorrow's London session. It's an echo.
And when you stop and think about it, this makes a ton of sense. The market has a pulse, right? It has a rhythm. When London is open, everyone's focused on the euro and the pound. So a big move might get started, but it often needs that same spotlight, that same liquidity the next day to really get going and follow through.
So how do you actually spot these echoes? It's pretty straightforward. Step 1, you see a candle with unusually high volume during, say, the London session. Step 2, you take a close look at that candle. Is it showing strength, weakness, indecision? And then step 3, and this is the absolute game changer. You wait. You patiently wait for the next London session to see how the story continues.
All right, enough theory. Let's see what this actually looks like on a real chart. We're going to look at some examples from the source material and see this delayed reaction play out in the wild. This is where it all clicks.
Okay, check out this USD/CAD chart. Now, at first glance, you see that big blue candle pushing higher, right? Looks bullish, but look at the very next candle. The price barely moves, but look at the volume bar at the bottom. It's massive. That's a huge red flag. It's telling us there was a giant battle and the buyers just couldn't push the price any higher. They're exhausted. That's our first clue.
And here's where the patience part comes in. That crystal clear sign of weakness we just saw, the big reversal, the price waterfall that followed, didn't happen right away. It took 2 full days to play out. That's the delayed reaction, right there on the screen. It's a perfect example.
Let's look at another one, this time on the pound dollar. See that huge red candle in the middle? And again, look at that gigantic volume spike. That is some serious selling pressure. And what happens next? Not a sudden crash, but a steady, almost metronomic decline over the next few sessions. It's like the echo of that first big sale just keeps pushing the market lower and lower.
So let's just nail this down because it's so important. The trick isn't to look at the very next candle, it's to compare apples to apples. You're comparing what happened in the London session on Tuesday to what happened in the London session on Monday. You're following the thread of the story during those specific high activity times.
Ultimately, this all leads to a totally new way of trading. A new framework we can call the patience principle. Because in this model, patience isn't just something you need to have. It's actually your main strategic weapon.
So here it is, your new 4-hour framework, bold right down. First, you've got to adopt that delayed reaction mindset. Second, always compare sessions like for like. After that, learn to see a high volume bar not as what's happening now, but as a clue for what's about to come. And finally, you have to truly see patience as your edge.
And why bother with all this? Because, as our source explains, this method lets you zoom out and see the real story. It helps you understand the bigger, longer-term trends that are building over days, so you can stop getting faked out by all the meaningless noise from hour to hour.
So I'll leave you with this thought. Now that you know how to look for the echo, now that you have this new lens to see the connections from one day to the next, what new stories are the charts going to start telling you?
Welcome to The Explainer. You know, when you first look at a financial chart, it's easy to see just a bunch of random jagged lines, right? But what if I told you that every single one of those charts is actually telling a story? It's a story about fear and greed and conviction. So today, we're going to learn how to read that story. Let's get right into it. So can a bunch of bars on a screen really tell a story? Oh, absolutely. But here's the thing. To understand it, you've got to learn the language. And this language isn't written in words. It's written in price movements. And this is the crucial part, the volume behind those movements. This is kind of the secret language of the market's biggest players. All right, so think of it like this. The two main characters in every single market story are price and volume. Price, well, price tells you what happened. Pretty simple, right? The market went up or the market went down. But volume tells you how. It's the conviction, the belief, the real power behind that move. And when you finally understand how these two interact, that's when the whole story just opens right up for you. Okay, so that's enough theory. Let's see our main characters in action. We're going to jump into a real-world currency chart and see if we can actually spot the footprints of the big operators as they move through the market. So for our first case study, we're going to look at the Australian dollar versus the US dollar on a really fast 10-minute time frame. Now, why such a short time frame? Well, it cuts out all that long-term noise, and it lets us see the raw dynamics of price and volume play out almost in real time. Okay, so take a look at this chart. It's just a perfect example of hidden weakness. See that area labeled rising price and falling volume? The price is kind of inching its way up, but the volume, the conviction, it's just drying up. It's literally like a car trying to go uphill, but it's running out of gas. Then check out what happens next. Falling with falling volume. So the price starts to drop, but again, the volume is super low, and that tells us the selling pressure is fading away. The sellers are losing your conviction too. So here's the key takeaway, the rule you really need to remember. It's this simple relationship. When price and volume are moving together, the trend is strong. So a price rise on high volume, that's a strong bullish sign. A price drop on high volume, super bearish. But when they start to move apart, that's a huge red flag. A price rise on falling volume is a big sign of weakness, and a price drop on falling volume suggests the selling is just about exhausted. But here's the thing, a single chart, one time frame, it doesn't always tell the whole story. Sometimes you've just got to change your perspective. Let's see what happens when we just zoom out a little bit on that exact same price action. So on the left, that's our 10-minute chart, and on the right, it's the same period but on a 15-minute chart. And look at that. See that signal labeled upthrust on the right? That's a failed attempt to push higher that happened earlier in the day. By just zooming out, we get so much more context. We can now see that weakness was already building in the market before the price action we first looked at even started. This just brilliantly shows how a wider view can reveal the bigger story. Okay, let's quickly define that term we just saw, an upthrust. It's a classic signal of weakness. So the market tries to push higher, often on a big spike of volume, but it fails and it closes lower. It's basically the market showing its hand, right? It's revealing that sellers are starting to overpower the buyers at that price. It's a major warning sign that the trend could be about to reverse. All right, now let's look at one of the most dramatic patterns you'll ever see on a chart. It's where selling pressure just builds, and then suddenly it collapses. We call it the price waterfall. Here on this 30-minute chart of the British pound, you can see it so clearly. The price just drops off a cliff on rising volume. And notice that little green candle right in the middle of the fall? That's a really weak attempt to rally that just gets immediately squashed. This is a market in full-blown panic mode. The source material had a perfect analogy for this. I just have to share it. It says, this is the balloon filling with water, which then bursts. I mean, that's such a great image, right? The pressure just builds and builds. The balloon stretches, and then, boom, it bursts. That's the price waterfall, a sudden violent release of selling pressure that's been building up behind the scenes. But even in a waterfall, there are always clues. Look closely at that area labeled mini repeat. We see this red down candle on extremely high volume, but look how small the candle itself is. Now think about that for a second. With all that selling activity, the price should have just plummeted. The fact that it barely moved, well, that means something really powerful was pushing back. Huge buyers were stepping in, absorbing every single sell order, and quietly building their positions at these new low prices. Okay, so we've learned the basics. We've seen a few key patterns. Now, let's put it all to the test. Let's apply everything we've learned to one of the biggest market-moving events of the last decade, the Brexit vote. So the date is June 2016. The United Kingdom has just voted to leave the European Union. And this decision, it completely shocked the world and sent these massive shockwaves through global financial markets, especially for the British pound. This is the monthly chart for the pound, and that giant red candle, that is the Brexit candle. Just look at the sheer size of it, and then look at the volume bar below it. It is by far the highest on the entire chart. But the most telling detail? There's almost no wick on the bottom. That little line you sometimes see below the candle's body? A missing wick like that means sellers were in absolute total control, from the open to the close. It was a signal of profound, sustained weakness that was going to last for months.
And this wasn't just about the pound. No way. This event rocked the entire global boat. The pound sold off against every other currency. Investors fled to safety, which caused gold, the Swiss franc, and the Japanese yen to just soar. And stock markets, they tumbled all around the world. It was a true global risk-off event.
But, chaos for some is opportunity for others. After all that panic, the smart money, the big operators, they begin what's called an accumulation phase. And that's just a period where these large, patient investors quietly buy up an asset at bargain bin prices. You can even see the numbered phases here, where they were taking full advantage of the fear that was still in the market. So from a simple 10-minute chart all the way to a historic global event, the principles, they stay the same. The key is just knowing what to look for. So let's pull all these ideas together into a simple framework that you can use on any chart you see. Here it is. This is your new lens for looking at any chart. First, just observe the price. Is it going up, down, sideways? Simple. Second, compare the volume. Is it agreeing with the price, or is it telling you a totally different story? Third, identify those specific signals we've been talking about. And finally, number 4, always consider the context. What time frame are you on, and what's happening in the wider world?
Look, the market is always telling a story. It's a continuous narrative of human emotion and financial conviction, and it's written in this universal language of price and volume. Now that you have the tools to read it, the only question left is, what story will the next chart tell you?